I really shouldn't be trading right now.
Frank, you're trading? We're on the beach. How are you even trading? Is that your laptop?
No, it's my phone.
Oh,
We got the mobile version now, remember that?
oh that's right. It's Find Your
Yeah,
Mobile.
yeah. That's some good product placement.
How did we even get a plane with our name on it like that?
I used the company card.
Frank, what? How much did that cost? Actually, you know what? We're at the beach. Don't answer that. Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right. Good morning, guys. Welcome back to another live stream. Hope you're doing well. ADP numbers just dropped, and we've got more news to come in about 15 minutes. Let's break it down. Hope everyone's doing well as we get started on the stream. Just a heads up, we are going to be streaming today for a crazy number of hours. I'm going to get to that in just a second. We'll talk about today's schedule. I'll try and line it up for you because if you are just tuning into the stream, I invite you, if you don't have anywhere to be today, if you're working from home or you're chilling out somewhere, or you're at the office, keep the stream up because the stream ain't going nowhere for a long time. We'll talk about that in a second. We have ADP non-farm employment changes that came out this morning, cooler than expected. And not so great for the dollar, but great for everything else. They revised the previous number just slightly higher, but this puts us below forecasts for the private sector, which is a way to read ADP non-farm employment change. This is like the private sector statistics. And so what we can see here is that we've got a cooler than expected jobs data print. And that's coming off of yesterday's higher than expected JOLTS job openings. But what we've got to look at here is we've got to say, okay, the private sector's coming in cool. This is probably going to be primarily bearish for the dollar. And we can see that right here. Remember that for the dollar to stay really strong, you're going to want to see economic data coming in just sticky and stubbornly strong for the US. And that's not really been the story recently. Now, if you're a dollar bull, the goalpost has changed because most economies of the world have started to see signs of slowing. So if you're a dollar bull, you want the dollar to see economic data that is slowing, but slowing slower than other economies, if that makes sense. It's kind of like you can win a race by one of two ways. You can win a race by running the fastest, or if everybody's getting injured in the race and you're the least injured person and you can finish the race, you would win that way too. I know it's kind of a weird analogy and maybe not my best one, but that's kind of where we're at. It's all about central banks cutting interest rates. And the ones that cut interest rates the slowest are going to be the ones that have the economic data that are, the strongest or supporting the most inflation. So we've got a lot to talk about. The S&P 500 pulled an Uno reverse on us yesterday, and I was so close to getting stopped out on this trade on the Nasdaq. I'm not out of the trade. I'm still in the trade, but arguably more thrilling. Well, not thrilling for me. It was not fun for me. Was the semiconductor trade that I took yesterday, which went so poorly and then so correctly because of AMD's earnings after the bell. So I got literally saved by the bell on my semiconductor position. But it's too soon to say anything because, you know, guys, here's the thing. Today is a huge day for economic data and the Fed later today. So just a heads up, guys, if you're just tuning into the stream, we are going to be streaming all the way through all of this data today. We've got a show lined up by our wonderful stream team here. They've coordinated a show for us. What I mean by that is that I'll be doing this first session and then take a look at this. Again, this is why I said don't go anywhere for the whole day, because if you take a look, it's not been updated on here. We got to update that, Chandler and James, but we will have a full list for today's Fed meeting. We're going all the way till this afternoon, but we'll get that updated on the site. You'll be able to see it at some point. But yeah, we should be going until this afternoon, so we'll be hanging out. Busy day. Fed's 2 a.m. here. Yeah, that is. You must be in Malaysia or Singapore, right? Because I always know that Malaysia is like the exact opposite time from ours. Like it's 8 a.m. here, and then probably 8 p.m. there. Your channel's like a news channel, but without being a news channel. I hope that makes sense, but it's meant as a compliment. Lee, I definitely take that as a compliment. The goal of the A1 Trading Show has been to become more of a broadcasting center, because I can only do so much live streaming before I cap out. But I have a lot of very qualified friends in the trading space who can take the stand and continue the charge when I'm gone. And so we've built out a little bit of a stream dream team, if you will. And yeah. So that makes it so that we have, you know, people passing the torch and going to get us all the way to the Fed meeting. Nick, are you still holding on to the USD CHF short? Yes, I am. Oh, and it's time to trail stops on this. Guys, we're going to trail stops on this right now before I forget. Because today is Fed day. We're going to be careful with this. I'm going to trail stops. Hold on. Let me pull up my... Let me share this really quick. Hold on. Okay. Let me pull up. I'm looking for Forex trades. Okay. I'm going to update this, guys. For those of you who are in the Discord, the VIP Discord, I'm just going to update my position here on USD CHF really quick. So USD CHF just took out the lows. Thank you, Othman. Appreciate you mentioning that, because I just checked and then that told me it's time to trail stops. Dollar yen is down 1.75%. Okay, we're taking a look at that in a moment. Wow. It's a crazy day, and it's expected to be a crazy day all day because you have the Fed meeting, which just throws a huge question mark into the middle of everything today. Everything that we're seeing could completely reverse by the end of the day or become much more extrapolated, but we don't know because the Fed, what they have to say in terms of their statement, Jerome Powell's statement and the press conference to follow, will be very, very important. Okay, guys in the Discord, I'm just going to drop this update here. Trailing stops behind this lower high following today's push lower. What a sell off. Indeed. Okay, stop loss just got trailed on the USD CHF position that I'm in. I've been in this one for a minute now. Actually, this has been such a sleeper trade for me. I've been in this trade for like 20-something days. And I've just been able to trail a stop behind this. My initial stop loss was very small. This one, what are we floating in terms of risk to reward right now? That's like almost a 5-to-1. I don't have a target on this position. I'm just letting a stop trail me out. Can I join the Discord server? The Discord server is something you have to pay for to get access to the signals. But if you'd like to join the free variation, we'll drop the link to that right now. You can join the Discord. We have a free variation where you can see analysis being shared by myself and Frank. And then if you are looking for access to the signals room, that is a paid service that we offer. You can find out information on our website, a1trading.com/VIP. a1trading.com/VIP if you want information about the signal service that we do offer. When it comes to signal services, am I a fan? Yes, if they show a track record. That's point blanks, period. That's it. If somebody shows a track record, it validates their signal service, in my opinion. Because then you know that they actually are trading real money, that you're not just like following a demo baller. That's just, you can waste a lot of time following a bunch of demo traders that don't show you anything tangible in the markets. Yep, there you go. You can join our free Discord with this link right here if you want to get involved. Good morning from Lakeland, Florida. Good morning. Good morning, Kevin, Fizzy, MCV, Pinoy, Boozy, Stand Up Archives, Devender, Todd. We got a bunch of people in here. Some new faces as well. Hope you guys are all doing well. Today is a really big day. I just want to say that to the new traders out there, they might have a rough day because, they might have a great or rough day, and they might not know it's coming because the Fed meetings are like a big question mark. It's not really like CPI day, where like CPI is like one data point. It comes out and it's expected to cause a big volatility one way or the other. Fed meetings are like a wild card. They could be absolutely crazy volatile, or they could just kind of be like a nothing, event. And we just kind of have to watch and wait and see. I've seen Fed meetings where we do absolutely nothing. And I've seen Fed meetings where we do absolutely nothing. And then all of a sudden we do crazy stuff. So you have to be really careful on any day where you have the press conferences from the Federal Reserve. So we will be streaming during that event. So stay tuned. And one great way to not miss that would be to subscribe to the channel. Talk about dollar yen. Okay, we will talk about dollar yen. Let me just see where we're at. Dollar yen is dropping down 1.86%. My goodness. Does not want to quit, it seems. Just took out this big level of support. That is a huge support level that just got taken out. I mean, look at that. We are really starting to actually break structure to the downside on dollar yen. Really impressive for the bears. And as a dollar bear myself, I actually love to see this. But what concerns me is that too much admiration of the yen also makes me a little bit nervous, because the yen is the safe haven of the world and I'm long the Nasdaq. So, I don't want to see a full risk off move because that would not be good for my trade. But we'll continue to watch that. Gold's also up. You got a lot of stuff moving today. And we got news coming out here in 1 minute to go. Let me switch over. We have some inflation statistics. The cost of labor is going to be coming out in just a second. Let me show you this. I'm going to switch over to all markets just so we can get an eye on everything. In just 30 seconds to go, we've got the employment cost index, which will be very interesting to see. Got 30 seconds to go, so stay tuned on that. All right, I've got everything pulled up here for us. We've got the indices. We've got euro, pound, dollar, gold, and oil. Breaking news. Got it coming in. All right. Pound and euro just shot up. Nas and S&P continue to push higher. Euro's higher. Gold about flat. And the dollar index just went lower. Let's see if that brought us anything interesting. Employment cost index did come down. That is going to be not particularly good for the dollar, but good for the inflation story. Remember, employment cost index. Think about what that's telling you. The cost of labor going down is good for the inflation story. If you've ever heard of the wage growth spiral idea in economics, the idea is basically if people are getting raises, so people getting raises aggressively, that's a good thing for those individuals, you would think, right? But here's the problem. If wages go up, what that usually turns into is businesses have to raise their prices. Why would businesses have to raise their prices? Well, because their cost of doing business just went up because their wages went up, right? If you have to pay all your employees, let's say you're a grocery store and you give everyone a raise. How do you pay for those raises without hurting your business performance? You raise the prices of your products in your store. And when that happens, when the business raises their wages, it can cause what to happen? Well, if the business raises their prices, then inflation happens, because that is the process of how prices go up. If wages go up, businesses raise their prices. If businesses raise their prices, that's inflation, right? That's goods inflation. That's products and services going up in price. And what does that lead to? Well, the new higher prices cause people to want wage increases, which cause businesses to raise prices, which causes inflation, which causes wage, business, inflation. You see how that works? This is what the Fed wants to avoid happening. And so when the cost of labor is there's nothing wrong with giving people wage increases, but if you have to rapidly give them increases to pay for, help them pay for their inflated prices, the problem with raising their payments is that it just contributes to the process or the problem, causing wage growth spiral inflation. Like, that's the idea. So today, this is good news. People are still getting wage increases, but they're not getting as high of wage increases. Again, not a really fun topic because people are like, well, people need to get paid more. But if you get people paid more, it also hurts the people in the end because inflation goes up. It's confusing, but it's something to think about. So also, guys, if you see messages like this, please be careful. Those are scams. I'm just going to ban that user. If you ever see people talking about like, I spoke with Mary Beth about cryptocurrencies, that's total scam stuff. So again, inflation, that was good news for the inflation story. The Nasdaq's up on that, S&P is up on that, Dow, and the dollar is down. That would all make sense based on the analysis we just did. Why would that cause the dollar to be weak? Well, because if wage increases are slowing a little bit, then that's going to help the inflation problem. And if inflation gets helped, then the Fed can lower interest rates at some point. Does that make sense? I know we're very fundamental today, but if that made sense, do me a big favor and smash the thumbs up button on the stream. Not many other streams focus heavily on the fundamentals. I'm aware of that. It's not always the most exciting topic, but if you enjoy those topics, the best way you can let me know is by hitting the thumbs up button on the stream. I actually mean that, because I go back and I look at the number of likes that live streams get, and then I analyze like, what was I talking about? If you guys are liking the fundamentals, the best way you can get more of that is by thumbs up the content. Okay, so let's take a look at some individual charts here to follow. Let's get an overview of what we're looking at today. Dollar Swiss continuing lower. Nasdaq's up 2.35%. US 30's up 0.66. S&P's up 1.5. Gold is up 0.4. And gold's looking tempting. I am bullish on gold. When I say tempting, what I am looking for preferably would be something like this, like a breakout through these highs. If we can break through this area where I previously was long and then it rolled over and stopped me out. If we can take that area out, I might be willing to take another attempt on the long side of gold, but I'd like to see momentum carry on a little bit, which would be great. Why would the Dow be down? The Dow is up today by 0.65%. It's a good day for the Dow, good day for the Nas, good day for the S&P so far. So the Russell's also slightly higher today. Look at this Russell pattern, by the way. This is RTY, which is a reflection of the Russell 2000. If I trade it, I usually trade the symbol IWM on the stock market. Other traders might trade, if you're a CFD broker trader, you might trade like US 2000. Depends what the symbol is on your broker, or you might trade futures contracts. But anyways, so the Russell looks really strong. Higher lows here. You've got resistance overhead. But if we can pop through that today, the Russell might be on to next. Shout out Chandler for removing scammer bots today in the chat. Thank you very much. How likely is a Fed cut today? Devender says very, very unlikely. But if it happens, the markets are going to go crazy. Stock market would be up like probably 4%, 5% on the day, like the Nasdaq. But very unlikely to happen. The market's giving it a 3% chance of a Fed cut today. So very unlikely, but possible. But, today, again, some more positive economic data in the form of looking for rate cuts, which is good news. Silver's up 1% today. I'm a little bit cautious with this silver pullback because, we've got a technical level of resistance forming here. In fact, I'm really not loving the chart. I was so bullish on silver and I rode this move. I actually bought silver here. And many of you guys might remember that trade. And I was feeling so good about it. We broke through this high. We looked so good. And I trailed my stop loss up to here. And price just couldn't do it. It couldn't make that final push. Rolled over, broke to the downside, and fell apart. Microsoft sold off heavy despite an earnings beat, something to do with cloud underperforming. Yeah, Lee, I saw that too. So Microsoft earnings came out yesterday, better than expected. On the top and bottom line, the stock goes down. Again, it can be a very confusing topic for traders who are looking at stocks and might say, oh, stocks are manipulated. See, they had good earnings and the stock went down. But to your point, what you just mentioned, Lee, I believe, I didn't follow it very closely, but I believe there was some, as you mentioned, like cloud stuff, their forward-looking, or their performance on some of their more AI-specific stuff was a little lackluster. And the AI trade is really sensitive. As much as I am bullish on the AI trade, why I'm long the Nasdaq, you have to be careful with it because it is a sensitive topic. Now, what kind of saved the day yesterday for tech stuff was actually AMD. AMD came out and after market close was up 7.3%. AMD is Advanced Micro Devices. It's a semiconductor stock. And I actually went long yesterday, the semiconductor ETF. I mentioned this earlier in the stream, and it was a terrible entry. But we avoided getting stopped out. The market reversed for SMH when AMD's numbers came out. And you can see right here what AMD's numbers were. They beat earnings, they beat revenue, and must have guided something optimistic. And when I say guide, what I mean with stocks is they guide their expected earnings. It's like if you ask me, A1 Trading, what are A1 Trading's expected earnings? And I told you that they're expected to be better for the rest of the year, like substantially better, you'd be like, oh, that's great. But then if I told you, yeah, we're expecting a slowdown the rest of this year, then it would be not so good, right? So same thing for, big companies like AMD and like Microsoft, where they guide themselves forward, like where they guide their earnings are likely to be, is really important to the market. In fact, more important usually than the actual earnings themselves is the forward guidance that the companies give, right? AMD, the team there at AMD know very well their own company plans, statistics, product drops. So them saying we expect earnings to be very good for the rest of the year and giving us numbers that are higher is going to make people really bullish about the stock. But if people hear the stock coming out and saying, or the company, the management of that company on their earnings call saying, we expect things to be okay, we'll see some growth, but not a bunch. Like, for example, Nike. Look what happened to Nike when they guided poor forecasts going forward. Horrible, right? The stock got absolutely pummeled. So this is the thing about stocks, is if you're going to get into stock trading at all, which I don't do a whole lot of individual stock trading. I usually trade stock ETFs or like the whole broad index, right? I trade the Nasdaq a lot. If you're going to trade individual stocks, you better know intimately well the company that you're talking about. I don't consider myself an expert on Nike or AMD or really many things at all, many individual companies. There's a lot of stuff to dissect with a singular company. And for me, I personally prefer to trade at the index level because I feel more confidently I can be accurate about the general theme of the market, the general direction of the market based on the macro data. I can look at what institutional money is doing, right? We talk about frequently the institutional money, the COT data. I can get a lot of information on the macro level about the index as a whole. That being said, we got 458 people here right now. I'm going to let you in on a little secret. We do have a product that is in the works right now, specific to individual stocks. It's going to take us some time to build. It's a different product than the Edge Finder, but it is in the works right now. We don't have an expected deadline for it to come out, but a beta version we are hoping to come out either end of this year or next year at some point. But stocks are cool. I've invested in stocks for a long, long time. But stay tuned on that. I'm not going to give you any more information at this time, but just know it's like an Edge Finder sequel for stocks, and it's coming. The Dow is up 0.7% today. I am long the Dow. I'm long the Nas. Both of these positions are back in the green by a miracle because they were, well, the Dow was always green. The Dow's been really good. The Nasdaq has been just a wild trade because I was very close to getting stopped out on my position, and then we reversed on AMD and Microsoft earnings. But today's the big day for these stock moves to make a decision in my view, because you have so much stuff happening today. If you are a stock index trader, today is your day. Same thing if you're watching the yen today. The yen is crazy. So I would say today's big focus is the yen and stocks, because today, and the dollar, because here's the thing about today. Today, for the index traders, specifically the Nasdaq especially, we have the Fed, and we have another blockbuster earnings report. Excuse me. I didn't want to sneeze on the mic. You guys would explode. And then we have Meta earnings, right? So Meta earnings are going to be huge, just like Microsoft's were, especially for the AI trade. So to say that today is bullish or bearish for the stock market, I think it's too soon to call. Even though the market is up a whopping 2.44% today for the Nasdaq, which is a very bullish move, I just have a hard time really saying for sure if today is going to end bullish or bearish because of the ginormous events that we have happening throughout the rest of the day. Cheryl says, bless you. Thank you. Ben says, hope you're doing well. I took a buy. I see that you're still in the NAS trade. What is your take profit? I don't use a take profit. I trail stops. So any updates that I make to my position in terms of a trailing stop, so I don't actually have a take profit order. I do have a stop loss in place, but any updates that I make to the Qs trade that I'm in, the QQQ is a index or an ETF that tracks the Nasdaq. Any updates that I make to that trade will be shared inside of our Discord channel. We dropped the link to that earlier, but if you'd like to join the Discord, we'll drop it one more time for you. The Discord, there's a free version and there's a paid version. If you want to get updates to the trades, it is not a free service that we offer. This is my life's work. So if you want to get all of the notifications of things that I'm trading, there is a fee attached to it. There's also a lot of time that we spend on the education side each day. You know, I answer a lot of questions from members. So if that's something you're looking for, if that's something you're interested in, you can join our Discord channel. If you're interested in the VIP version of the Discord, I'm going to just drop this link really quick. So here is if you want to join the trade room and you're serious about it, there's the link, a1trading.com/VIP. You can get access to all of the trades that I'm sharing, as well as Frank's sharing. We trade live accounts, no nonsense, no demo accounts, no nonsense. NQ moves a lot back and forth. You don't find you getting stopped out a lot? Well, you just have to adjust, right? You have to adjust to the volatility of the instrument that you're trading, right? You just reduce your position size. If it moves a lot, that's a good thing if you're on the right side, and it's a bad thing if you're on the wrong side, but you just reduce your size to make it more appropriate to your own personal risk, so on and so forth. Let's talk about gold. So again, I am bullish on gold, but I would like to see what I'm a little bit cautious on with gold is this back and forth choppiness that we've seen. So I'd like to see at least a break of this structure point here. And then I may get a chance to actually go long. But I like gold on the fundamental side. If we take a look at the top setups page, we did get a gold bullish reading pop back into the edge finder. Seasonally, it's a strong time for gold bullishness. Actually, let me check this really quick. I want to go to the month of the years thing and check it out. Does the edge finder work on stocks also, or Forex only? The edge finder is not a Forex tool or a it's a pretty much a macro tool for lots of different charts. We have on the edge finder, we have currencies, we have even crypto, some crypto, we have indices, so stock market indices, you have commodities like platinum, copper, gold. In terms of currencies, currencies are one component of the edge finder, but the edge finder is not really meant to be like, oh, this is a Forex tool or this is an index trading tool. It's really meant to be a macro tool for both futures and FX traders. Okay, so let's go back to this for a second. I want to take a look at gold and just break this down. So why is gold now getting a bullish reading of +6? Well, we'll see if this page loads. Okay, here we go. Check this out. So here's the gold reading on the edge finder broken down using our data scanners page. The commitment of traders data is giving us a mixed result. Why is that? Well, because look, COT long is very heavy. So institutional money are very long on gold. But in the recent change, the last weekly filing, they sold some gold. So that's why we're getting a mixed reading on the COT report component of the edge finder scoring. Hopefully that makes sense. I'm just going to run through this really quick. Retail sentiment is 55% of traders are long, 45% of traders are short. It's too mixed to give us a reading, so give us a +0 on the score. Seasonality. The month of July is historically a bullish month for gold. That's held up pretty well this month. Trend is to the upside. GDP statistics. Take a look at GDP. Let's look at the statistics on GDP for a moment. The current reading for GDP, the latest data came out at 2.8% compared to the forecast of 2%. That's a strong beat for GDP, and that is a bearish reading for gold because remember, strong economies, not particularly optimistic for gold. So that goes against gold bullishness. Let's keep going. We're going to break this all the way down, and then we'll move on. All right, so ISM PMIs. Let's talk PMIs for a second. The latest PMI data came in at 48.5 for manufacturing compared to a 48.7 forecast, lower than forecast. That's, slowing in the economy, bullish for gold, right? We'll repeat it with services PMI. The services component of the economy came in lower than expected, giving us another bullish reading for gold. Retail sales came in better than expected, and that gives us, what actually came out relative to what was forecast gives us a bearish reading on gold. So we're going down the list, and you can see as I'm saying these, all the scores are being reflected there. Inflation has been cooling, which will likely lead to the Fed cutting interest rates. Bullish for gold. Employment change. Let's do employment change. We had less jobs created than expected. And then we had unemployment go from forecasted 4%, came in at 4.1%, a rise in unemployment, positive for gold, right? So overall, we got a score of +6 on gold, giving me a bullish lean on this chart. So as it comes up to this level, the next thing I'm looking for on a technical basis is a breakout and a possible retest. Also, if you are interested in getting access to the Edge Finder, I'm going to just plug you guys with our discount really quick. So we don't have anybody here in the office right now to answer questions. I think Hallie is running a little bit late and we're short-staffed this week. But I'm going to just give you a plug on the discount that we're running right now. So give me just 1 second. I'm going to send you guys, if you are interested in getting the Edge Finder, the reason I want to just mention this really quick is that we have a huge discount going on right now. And here's the information. Okay, so if you're interested in getting access to the Edge Finder, which is the tool that we've built painstakingly over the last few years to help traders and, selfishly speaking, ourselves first, Frank and I, who have been designing this tool together for the last few years with the help of our team, you can get access to this product for a huge discount right now. It is the primary vessel, the primary engine behind my trading strategy, as well as, many other traders who are using this tool to help spot and scan fundamental macroeconomic data. So if you would like to get yourself a copy of this tool while the discount is still available, we track in our tool everything from currency pairs to indices to commodities. And the best part is it is a one-time payment that is currently half off. So our summer sale is ending pretty soon. Don't miss out. If you've been thinking about it, click this link that's just been dropped in the chat and write down that code YTVIP to get a nice discount off of the tool, and don't miss it. Finished by high school, thinking of doing a degree in finance. I've been trading for 3 years and I've been profitable for a year with technical analysis only. And I want to learn fundamental for my future in finance. How do I learn? So in terms of a degree in finance, it kind of depends what you want to do. Truthfully, my background is computer science. That's what I went to school for. I use it obviously every day because my business, A1 Trading, we're all about building software tools. So I use my CS degree all the time and learned to trade without getting a finance degree. So I think that, the finance degree component is optional. It really depends if you love this stuff enough to learn it. But you also have to remember that being an economist or a finance, grad or something like that doesn't necessarily equate to being a great trader, because, economists are different than traders. Traders are able to weigh the economic components, but also seek out trends, both the kind of thematic trends, like, for example, like the AI trade. If you caught on early to the AI trade, you probably made a lot of money. I did, but I was also really early to the trade. So I was long like technology in 2022, which led to some of my biggest drawdowns I've ever experienced. So, point being, I think if you really love this stuff, you should get a degree in something that is useful to your trading and investing career as well. But also understand that if you don't have that degree, it's not going to hinder you from becoming a trader. Again, I've never got a professional degree in economics or finance, but it is something that obviously I've learned a good bit about just by doing this stuff every day, studying it. The best way to learn is not in a classroom, in my opinion, for this stuff. It is listening to commentators. It is practicing. It is back testing. It is, reading a ton of stuff. As boring as it might sound, I still to this day spend a lot of my time just reading, articles on stuff and listening to the Fed speak stuff. Later today, I'll be actually listening very intently to what Jerome Powell says, not just looking for spikes. You are going to get your spike junkies that come in and just want to, trade the excitement. But you also have to remember that what Jerome Powell is speaking on, he's like the master of economics. Him and his team are like the best. They recruit the best talent in the Fed in the world. Just like Wall Street hires the best programmers to build all their quantitative trading systems, the Fed hires the best economists of the world to try and forecast and better make decisions, because there's a lot of money on the line. So, yeah. Have you gotten any big firms, companies looking to buy the Edge Finder off you? We have a couple different B2B partnerships and companies that like white label the tool from us. So we do have more like agreements, but we're not looking to sell the entire rights to the tool. I'd be really bored if I didn't have the Edge Finder. Trading takes up like an hour of my day. And then I genuinely love building software all the time. Like that's my day job. And I don't think I don't really see at this point in my life a time in my life where I will only trade. It just sounds boring. Trading is enjoyable, and I love learning about the markets, but I also need something else to like sink my teeth in that's kind of real. Because here's the painstakingly frustrating thing about trading. I might have a bullish bias on the Nasdaq or the Dow or something. And if I'm just completely wrong, there's nothing I can do to change that. But if my code's not working, or I'm trying to build something and it's not working, I can figure that out and I can control it. The thing about the markets is you can't control it. You have to control your risk and just let edge play out over time. But it can be frustrating when you're like, I want this thing to go up, but I can't control it going up, right? So you kind of have to be able to, in my view, what's really been helpful about having a day job running this business is I can then go focus on other things and just say, look, the trading's happening in the background. Some days are going to be good. Some days are going to be bad. Over the long term, it's going to be better than it's bad, if that makes sense. I think having something else to do is a low-key, really important thing when it comes to trading. Don't sit around and watch charts all day. It's dangerous. Anyways, real quick, guys, we're going to take just a short break. The show is going to be rolling on. We got Forex James going to take over for a little bit. We're going to be streaming all day long. We will have this updated on our website pretty soon. We've got a live stream schedule. It's just not yet been updated, but we'll have that updated pretty soon with the full day schedule. So stay tuned. We'll be right back after the short break. James is going to take over the show for a little bit, and show rolls on. Keep the stream up all day long. We've got a all day stream going on today, so it should be a lot of fun. Stick around. We'll be right back. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Hey guys, how is everyone? Just sort the camera out here. There we go. Hope you're all doing very well. So I noticed some talks about degrees, finance, and wants to work on a trading floor and things. So if you want to be essentially a professional trader, it's a very easy way to go in terms of it's sort of a fast track, rather than being a retail trader, finishing your education and then wanting to go into the professional finance world or professional trading world. You're at a pretty big disadvantage then. So if that is what you want to do, it's definitely a great way to go about it. So the reason I say that is because my analyst is currently interviewing at BlackRock. He's doing a series of interviews there, and he got that because he is a graduate of finance and economics. My trader that I hire at Elite Traders, he has a Series 7 license by the SEC, so he can manage people's funds as a retail trader, and that's because he has a bachelor's degree in finance as well. So essentially, if you want to take trading as a more serious thing, and what I mean by that is trading other people's money, working on trading floors, and working as sort of like an investment manager or trader, then it's kind of the way to go. If you want to, just trade by yourself, like myself and Nick do, then it's not really necessary. But yeah, as Ivan said, it definitely helps. FX World, good day. James finally using dark mode on his charts. That white background is blinding. Yeah, well, I like to change colors. I have a very short attention span, so I change things up quite often. You'll see my chart colors change every 2 to 3 weeks. Even my, I switch between light and dark mode on my computer all the time as well, on phone. But yeah, I'm just going to catch up on the chat. I concur with what you said. I have a finance degree and knew nothing about trading before venturing on my own. My degree led me to becoming a bank regulator. Yeah, so this is another thing. Education tends to be more theory. So as Nick said, which I agree with as well, it's a lot of the times better to learn on the job by doing something hands-on. So for example, if you were studying finance and economics, they're not going to teach you about how to enter into a trade. That's just not part of what it is. They teach you how to forecast things, sort of domino effects and all that type of jazz. And then you need to take that and apply it on your own. Whereas if you were on the trading floor, for example, that's where you would then learn how to do that hands-on. So just by studying finance and economics doesn't make you a trader, really. It just makes you more educated in a sense. So anyway, enough of the boring stuff. Let's go to the charts. Just realize my camera's still a little bit off. There we go. So you might have seen this trade on the screen. This is my Euro Pound trade. I entered this at the start of the week and it looked really, really good to get in on. So if we, the way I trade, draw the fib from high to low, we had this 50% pullback and the 618 level here that was rejected really strong. Actually, let me just delete this so you can see. You can see this daily candle here, huge rejection to the upside and closed bearish in a really nice way. So I entered once we saw a slowdown of the bullish momentum. It was a huge spike actually. It was very aggressive quite quickly. You can see it here. And then I entered once we had a closure of this H4 bearish candle. Now we are seeing a little bit of drawdown. Obviously, that's sometimes how it goes. However, the reason I'm still in the trade is because the economics are still there. I really, the fib level here is still completely valid, where the 200 moving average is now met price as well. So overall, looks fine. From a technical standpoint, From economics, I showed you guys this, my economics board that I put together every week. So you can still a short in my eyes, although the entry might be a bit early. This is a 6 to 12 month forecast. So if you want to read it, you can see the euros here, the pounds there. I'll leave that on the screen for a second. I'm not sure if you can see it, it might be too blurry. I just told my son your background is in, I guess that's to Nick. Hi, James. Your take on the dollar yen and the impact rate decision we'll have today. So dollar yen, I am actually still in my long positions, unfortunately. So you can see the two very dark lines here are my entries. Now, was I on the wrong side of this? Absolutely yes. Should I have closed out? Probably yes. However, overall, I still stand bullish on the dollar yen. I mean, you know, we might have had a hike and things at the moment might not look very optimistic for the short term. However, nothing has really changed in my eyes. I mean, yes, like I said, we've had some news, but it's not necessarily enough to then make the yen start reversing the whole trend that it's been on. So I'm quite happy to stay in this for now. I may just cut losses very, very soon. And when I say very soon, I'm maybe even by the end of the week or even by the end of today, depending on the FOMC. So we'll see. But yes, you know, I'm not ashamed to admit that I was definitely on the wrong side of this. You know, the reason that I entered in the first place was it was just an intervention at first. This was just a you know, run-of-the-mill intervention. There wasn't anything out of the ordinary at the time, and I was fully expecting this. That's why I waited. You know, I wasn't buying it here because I wanted to see an intervention. Because, you know, if we look at the intervention last time, which was here, we can see we did have a bit of volatility and we did have quite a significant drop. However, we did sustain the uptrend quite nicely. You know, it was just a really great place to get into buy positions. And I basically expected the same thing to happen. And it just didn't. And that's just the way it goes sometimes. So, you know, this does look like quite a nasty position, but the risk is managed, so it's not a problem. But yeah, overall, I'm looking to actually flatten positions. So obviously it's the end of July today, so I'm looking to basically close out of everything that I can as soon as possible. And I am moving and allocating capital towards a new broker that I'm with on MetaTrader, so I can open my FX book. Because at the moment I'm with IG Markets, I'd use a spread betting account, which is their proprietary software for trading, so it doesn't have any ability to connect to my FX book or anything. So it's a bit unfortunate, but that's the way it goes. You're stuck in longs too. Oh yeah, it's one of those things, but if you can, you know, if you can manage your risk, then it's not an issue. Trades go wrong sometimes. That's just what it is. James, what MAs are you using and why? Well, I use 4 moving averages actually. So I use 2 on the daily and upwards. So daily, weekly, and monthly, I use 2. And then on the H4 and downwards, I use 2 as well. So on the smaller time frames, so on the H4 and downwards or lower time frames, I use the 200 and the 50. On the daily, I use the 21 and 8. And the reason is because they're actually mainly from my day trading, mainly for my day trading strategy. So the reason I use faster moving averages on the daily is because when I'm day trading, I don't want, you know, you can see I've actually got the 200 here on the daily as well. But when I'm day trading, the 200 is actually not very relevant because I don't need to see the overall trend of the market for the past 200 days. It just doesn't, it's not relevant for a trade I'm holding for a few hours. What I do want to see is the immediate trend, the trend that the market is in right now. And you can see it's relatively accurate. So if we have bearish fast moving averages on the daily and we have bearish slow moving averages on sort of the hourly or the 4 hours, then potential shorts and vice versa. But recently I just added the 200 back because I'm actually not really day trading at the minute. I'm focusing much more on swing positions. But there's no real reason for that. It's just I sort of go through 2 phases. It's 2 strategies I have. I sort of flick between them as the market calls for it. US 30, I'll go into US 30 in a second. use the same EMAs on those timeframes. Good stuff, Jamie. So let's have a look at US30. Speaking of the indices, actually, I'm in a long position on Nasdaq. Again, I showed you this one not too long ago, but don't worry, I won't forget about your US30 request. I'll just cover this while it's on my mind. This, unfortunately, is actually the only blue position I have at the minute. It's the only position I've got that's in profit. And the reason I say it's unfortunate is because this was a starter position. So what I mean by that is I placed this with very low risk. And when I say very low, keep in mind this was taken basically due to the daily time frame. So the stop is pretty large for my book anyway. And I took it at, off the top of my head, it's about 0.2% risk. So this essentially is nothing. Even if it is take profit, it's you know, a drop in the water. Whereas the other trades I've taken are at normal risk and they're in drawdown. So it's one of those moments where I'm just a bit facepalm, but there you go. So US30, these actually don't represent any positions on this one. These are just levels I marked out. So let's see. I was actually considering going short on the Dow. And when I say I was, it wasn't necessarily my trade idea. It was, I've got a friend that works in a hedge fund in London, and he gives me little tips now and again. And he was doing some research on the Dow, and he was saying that the PE ratios on the companies that make up the Dow are quote unquote too far-fetched. So he's currently looking to go short. And I've seen his trades before, so I wouldn't, I wouldn't trade against it. But from the way I trade at the moment, I would stay out right now. I was looking at this level, so I was in Dow. I think I was in right here, and I was just trying to target the previous high. Stop was somewhere around here. It was quite a tight stop. I got stopped out, and I didn't re-enter. I missed the re-entry, but this would still have been valid. So it's a bit of a shame, but what can you do? It's hindsight. But yeah, I think to be honest, I am very bullish on the Dow from my personal perspective. Let me just pull up the Edge Finder. So I'm not sure if Nick's already shown this. He probably has done, because I think he's in a Dow position as well. But yeah, the data overall looks great. I mean, look at the seasonality over the past 10 years. It's really strong. The only negative things are manufacturing PMI and services PMI. And then we are quite clearly in an uptrend, especially on the H4. You can see we created a higher low, and we could now potentially be on our way to create a higher high. So we'll see. So overall, I'm bullish, but right now, not quite a good entry, really. It's kind of in the middle of a potential zone to go long from. Pound dollar, for sure. We can have a look at pound dollar. Let's see. Let's get rid of these. So I'm still looking for my short position on pound dollar. You can see it's marked up here. Now there's quite a long thesis behind this trade idea, so I'm not going to bore you all with the whole thing, because this trade is more planned for sort of the whole year of 2025. This isn't a day trade or a swing trade. This is more of a position trade over the long term. However, the general idea that I have is that the UK is already in disarray. I think it's overvalued in terms of the pound is overvalued. And I don't think the current situation that the pound is in, or the economy is in, or the population is in, I should say, has really hit yet. I don't think it's quite sunk in as how bad things are here. So when that does happen, I'm ready to lock in some shorts. However, moving on, for the short term, it looks great to go long. I'm not gonna sit here and be too pessimistic. I think the pound definitely has some steam left. I think we could see at least a run into the resistance I've got marked up. We're bouncing off this 200 moving average. Let's just see if this is a fib level. And it is, actually. It's quite a nice 50% level here that we've shown quite a lot of respect from. So I'd be targeting something like this. So nothing crazy, just a nice 1 to 2. However, something you need to keep in mind is obviously we do have US news tonight, so be very cautious. If I was you, I wouldn't be looking to open any dollar positions right now. I'd sort of let the news hit, let the market digest, and then take it from there and then reassess. But just from a technical standpoint, that doesn't look too bad. Now we can refer back to the economics board that I've got here. So you can see the pound and the dollar are both signaling bullish. So, and this is more of a forecast rather than the current situation. So that's also a bit of a red flag for me right now. Hey James, do you keep correlations in mind when taking entries? I was looking for charts correlating with indices and oil. Correlations are a tricky one because it comes down to exposure. Now I'm just going to pull my sheet up again just to show you something that I've got here. Now this is my exposure board. Now actually I don't keep this updated really, to be honest. But if I was more focused at the moment towards one asset. So for example, if I was super bullish on the dollar and I was looking to take essentially every trade against dollar, so pound dollar, euro dollar, Australian dollar, for example, and I needed to keep track of my exposure because it was very important at the time, then I would use this. And this is essentially making sure that my exposure to any one currency is not too high. And that's, kind of relates to correlation. So for example, if you were trading oil in the CAD, you would have exposure essentially in the same place. So if you were shorting oil and shorting the CAD, then you would, at 1% risk each, you'd essentially have 2% risk on one trade in theory. So correlations, I don't really keep in mind because I never really take more than one position on one thing. So for example, if I'm long on pound dollar, I'm not then going to go long on euro dollar. And if I was going to do that, let's just use an example here. If I was, for example, let's say in a long position like this, and then I now want to go and open a long position on euro dollar, I would have to move my stop to break even on the initial position, which in this case would be pound dollar, and that would then set my exposure essentially to zero to reset it to then allow me to get back into the dollar euro dollar. Hey, coming from the rant video, which rant video? I've done a few different rants on social media, so it'd be interesting to know which one. What's your thoughts about Bitcoin? Bitcoin, now I say this every time, but I really the last person you should be asking about crypto. I don't claim to be a crypto trader at all. In fact, the only thing that I really analyzed on crypto was this area of daily resistance. So we can say what we can do is what the gurus do. Like, I told you about this level, and I can draw up my short position here. I'm like, I just caught a 1 to 3 trade on Bitcoin. You need to follow my signals. Anyway, that's a little rant for you there. But yeah, anyway, for Bitcoin, I don't know, to be quite frank. I don't know what drives Bitcoin, really. I mean, I know the surface level things that everyone else knows, but I don't really know what the deeper things are with Bitcoin. However, if I was coming into this from just a technical aspect, I would be looking to buy, just because, look at the trend. It's clearly a bullish market, especially at the moment. We are having a little range here, so this could be a range for sort of just waiting for a breakout. Now that breakout could be either way. Again, I don't know. So we could then potentially look to go long off here. I think in this case, I'd need a stop, quite a wide one, at the previous low just to allow for this range. Because what you don't want to do is have a stop a bit tighter to account for just the fib and the moving average. But then the range is still in play and you get stopped out when we retest the support, or if we retest the support. So I would like a slightly wider stop. And this would then in turn, of course, reduce our risk reward. But that's just a very basic take. So please take it with a pinch of salt. Don't take any trades just because of what I've said there. Like I said, not a crypto trader. Having buyer's remorse. How do you think rate cuts today will affect indices? Well, first of all, I don't think we're going to have rate cuts. I think it's pretty much out of the question. I've seen there's not a single person that's reputable or credible that I've seen that expects a rate cut today. So I think if we do get a rate cut, indices will go mad. I think that there'll be some pretty crazy moves that I would definitely not want to be involved with. And to be honest, if there is a rate cut today, I will not be a very happy chicken. Let's put it that way. Hi, James. I think gold is going short. Oh, God. I look really bad this month. All I have this month is losses. But to show you, this is one thing I want to do because I have, I like Nick. I like what he stands for. I don't want to then come onto his channel or, not even just that, but as a human, I don't want to come on here and just start showing analysis and not showing trades that I'm taking. So for full transparency, I've had a really bad trading month and it's unfortunately still continuing, which is one reason I'm looking to sort of get out of my positions at the moment and sort of just start fresh when I get back from my holiday. And actually on Friday, I leave. So gold, I am also in shorts. Now, I sold possibly the worst place I could have sold. Sold right at the bottom here, and this was a momentum trade. So this was actually taken on the hourly time frame. And again, you could say in hindsight this was awful, and I would completely agree. At the time, we had a really strong move down that I profited quite nicely from. It was just a 1% gain. Then I went long here, and the reason I went long is because if we draw now, the chart might look a bit messy here, but bear with me. Draw the fib from low here to high. This level at the time was a really nice 618 pullback. So I just took a stab with a very tight stop loss and got stopped out. And this was only a 0.1% loss. It was a very, very low risk trade. However, had I held, it would have been great. But that's the way it goes. However, I am still looking for a lower price on gold. Now, we did see the tensions rising a little bit in the Middle East, and that's what, well, as far as I'm aware, that is what has caused the recent bullish moves on gold that you can see here. We did see a huge, well, not huge really, but quite a nice run on gold to the upside. So we'll see if that does escalate, then we will more than likely see gold run up to all-time highs again. Previous all-time highs, I should say. But the reason I'm looking short is I think as we head into the end of the month, when I placed them, we were heading into the end of the month. It is the end of the month now. I was looking for profit taking. I was looking for, obviously we're at all-time highs. I was looking for price to come lower as people start taking profits, A, because of all-time highs, and B, because we're closing out of July. Now, clearly that hasn't quite happened as I expected. It did happen, but not as much as I thought it would. Now, using the fib again, if we draw it from the current, previous high to the current low, on more of a short-term outlook, we are currently consolidating at this 50% level, and it's almost perfect. So the result here will be very dependent on FOMC. So at the moment, nothing else really matters. You can see there is essentially no movement on gold. ADP had, it was nothing. It's had absolutely no effect. So yeah, just be very cautious about FOMC if you are in any dollar pairs. Sorry, Slugmeister, you said no rate cuts. My apologies. Well, I don't really think anything's going to happen, to be honest. And the reason I say that is because, as I said, it's very, very expected that there's not going to be rate cuts. So as far as I'm aware, it's already priced in. So I'd be very surprised if we do see any large movements today. The only thing I can really see is if we do get an announcement of rate cuts either today or in August. But, I think, it's September, November is kind of the target really from everything I've seen. Jonas, I know Nick is biased long. It looks like it's long, but I feel it's short. Well, Jonas, if you feel, then you're more than likely wrong, because feelings, unfortunately, don't really drive trades. You need to have a full reason. As I said, mine was more just looking for a loss of buying power as we came into all-time highs, looking for that profit taking. And like I said, I did profit from that, but it's just if we can get that move to the downside again. Because if we look at the past 2 times we hit all-time highs, we had essentially the same thing. We had the dip, and then a pull back up. So you can see it here: dip, pull back up, dip, pull back up, and then the sell-off. And looking now for another sell-off. But again, we'll see. That's a very loose reason. And as I said, if things are starting to escalate again, even further in the Middle East, this could be a pretty nasty short position to be in. Let me just catch up on what's been said. Okay, really no hate, but what's the point of trying to short gold with the recent economic data, global rate cuts, Hamas lead being executed? Yeah, KDX, that's what I just said. Things have escalated. I was in the position before that happened. So, unfortunately, I can't tell the future. But yeah, we'll see. Like I said, when I trade like this, when I'm more in sort of DCA positions, I use a very, very low risk. So it doesn't matter. I can close out now and it's not really going to hurt. It's less than 1% exposure, less than a 1% position. Does EU correlate with EG? Well, they're both euro positions. Yes, sorry. Slugmeister is losing trail of thought sometimes. Yes, there is no FOMC in August. You're right. Market Champ is the best guy. His analysis is unbelievable. Will thank me later. Never heard of him, but fair enough. When is the news event today? Let me pull that up for you so you can see the economic calendar. Now, this is UK time, so you might need to adjust it for you. Santosh, if I'm a noob, that's fine. If that's what you think, brother, that's fine. Mind looking at USD CAD? We can definitely look at USD CAD. I assume this was the CAD news that came out today. I'm not in CAD, so I wasn't really paying attention to it. Let me just take a look. Yeah, CAD GDP month on month rose by 0.2%. Yeah, okay, interesting. So the CAD gained some nice strength here. H1, let's look at the H4. So the the dollar CAD's not really an asset that I like to trade. And I say this quite often. I put out a tweet the other day saying I think it's probably the worst chart, or one of the worst charts anyway. If you just look at this, it's disgusting. It's just sideways. Especially for me, I like to follow clean trends, and this is not exactly a clean trend. However, ideally, I would be looking for a potential long position here, just at 50% pullback. This would meet 200 moving average, which is quite nice for me, and then potentially just take it back up to this previous high. But yeah, we'll see. Again, it's not really a pair I trade. I just really don't like the way it moves. So never really presents any opportunities for me. As I said, it's like just a very range-bound market. Is a CPI a buy or sell? Michael, if I could tell you if CPI was buy or sell, I'd be a trillionaire. I personally think we could get a surprise cut from the Fed. I mean, anything's possible. We definitely could, but I just don't see it as likely. Which pairs are trendy? Which pairs are trendy? Well, euro dollar, pound dollar, gold, US indices. Yeah, a lot of the dollar pairs, really, except for dollar CAD. Or major, G10 currencies tend to be quite trendy, I should say. If there's no rate cut, does that mean gold will? Gold will sell. Anybody, please. Anybody help? Or anybody, please. Gold, if there's no rate cut, I just don't see anything happening, really. And the reason is because when we have, so for example, if you ever traded, well, not traded, but you ever seen NFP or CPI, PPI, any sort of major news release come out and it's just not really done anything, that's more than likely because it came out as expected. And when news is expected or, you know, heavily expected, like it's quite a large consensus at the minute that the Fed's not going to cut, that's already priced in. And what I mean by is priced in, people have already placed positions expecting that to be the result. So it's not like when that comes out, people are going to be closing out positions and adding into positions, opening new positions and things, causing that volatility. I'm long GP USD based on daily time frame pullback. Very nice, Eric. Lee James, worst chart FTSE. I never traded. Yes, actually, I completely agree. The FTSE is also horrible. Now, I've been looking to short the FTSE for a while. And again, that's just going back to my short the pound thesis, or short the UK thesis, I should say. However, it's just not quite there yet. I'm not really ready to, but it's, yeah, a very similar thing. I actually showed this when I was live with Nick not too long ago. But if we look at the FTSE line chart and compare it to the S&P, we can see the difference here. So it's, which one would you rather invest in or trade in general? It's clearly the S&P. It's, you know, no shadow of a doubt, really. Mitch, how long did it take for you to become profitable, if you don't mind me asking? Mitch, I've been trading for 7 years. It took me about a year of losing a lot of money to then realize I needed education. So then I got a mentor. I studied for about a year, and then for about 6 months after that, so now at the 2 years, 6 months period, I was sort of demo trading and starting to gain confidence and build things and work things out for myself, and sort of work from there. So it was essentially, you could say, about 2 years it took, or two to 3 years, I guess, because that sort of second year period was still the learning and adapting and building phase. So I wasn't necessarily making money at that point. Gold is too hard to trade. You know what? I would actually disagree. I think gold is one of the easiest things to trade. And the reason is because it's quite simple. Anything that scares investors, gold goes up. Anything that gives investors hope, gold goes down. Now, obviously, that's very broad. Don't take that quite literally as a rule of thumb, but it's a general idea. So risk on market, sell gold. Risk off market, buy gold. And then obviously you need to dig deeper into what causes those things, and then you can take it from there and start liking gold. What's your average yearly percent? Roughly, you know, over the past sort of 5 years, it's been around 20 to 30%. It obviously varies, but it's roughly around there. Brother, will Bank of England make or break? Your view on GBP/USD is correct for the long term, but what if that level never comes? If the view is really for the long term. So that's a good question. The idea I have on the pound dollar at the moment is just, let me get rid of this. It's just a rough idea at the moment. This isn't a, you know, it doesn't matter if this level's not hit. So the target is a set target. That's where I would be looking to close out of this position. But if we don't see this level hit, then fine. But I won't be entering this. The sort of first date for this trade is when we get a cut from the Fed, because that means the market can digest that. We might see some bullish movements on pound dollar. And when we see those bullish movements, that might then allow me to start averaging into short positions. And again, this might, well, more than likely will be a DCA trade rather than just a set entry and stop loss. And that's because it's, again, a long-term trade. I want to be able to catch fluctuations, as it more than likely will go into drawdown at some point. Gold is the easiest trend. Trends, you just need to be patient. Yes, I have quite a few friends actually that are in brokers that only buy gold. They will never go into short positions. It's like I only buy the indices, so S&P, Nasdaq, all the others. I will very rarely sell them unless it's a black swan event. Are we buying pound dollar for the rest of the year? Are you buying pound dollar for the rest of the year? What's your idea there? Bank of England willing to cut interest rates? Yes, I think, but again, I'm not really looking at the short term on pound dollar. The point of entry or execution for this is ideally around November. What is the most you are willing to risk doing DCA? Well, that's a good question. I start in with small lots, and it's very, very similar to a martingale style. And this is why I never send them to my Discord. I very rarely talk about them on social media, because it's very, very difficult to pull off. If you're following, if you were following me, for example, it's more than likely you would probably lose money, because it's just quite mentally taxing. So here, let's say, for example, I was going short. Let's say we started here, price came down, I scaled in twice, then we started coming back up, draw down here, scale in again, and then we start sort of doing this. So I would have 4 positions. So this initial position here where we start would be very, very small. I like to start and then build positions as we go. So this would be with, obviously there's no hard stop, so it's very difficult to really say that it's a percentage risk, but it would more than likely be looking at like a 0.1 or 0.05, so very, very small. And then the scalings when in profit would be very similar, so this might also be a 0.05. And as we come into drawdown, this one might be a little bit bigger, so this one might be a 0.1 or a 0.2. And then I would probably leave it there. I don't scale, it's not like I'm constantly adding in positions. It's normally anywhere between 2 to 3 additional positions, and that's it. And then after those positions, if we're still not doing well, I'll look to close out and refresh and then come back in at a higher price or a lower price, depending on the direction. The Dow, in fact, indices in general can be difficult to trade. Yes, actually. What's DCA? DCA is dollar cost averaging. So it's averaging in as a trade moves against you or with you, depends. It's just averaging into positions. Yeah, Nasdaq's doing quite well so far. But yeah, I think indices actually are probably the easiest thing, because all you really need to do is buy. Obviously, if you cut out the effort of trying to go in for buys or sells, so let's say you're on a currency pair, you need to account for buys and sells. You need to sort of account for a lot more. Whereas with Nasdaq or any of the indices, if there's something that's looking a bit bearish, I'll just stay away. All I need to do is wait for a signal to buy, and I will go in, and obviously then wait for the technicals to also align. But overall, it's a lot easier in my opinion. But yeah. Christian, Christian, I actually don't have my FX. I was saying this earlier. So the broker I use is IG Markets, and I use a spread betting account for tax reasons. And that means I use their proprietary trading software, which it doesn't have any link to my FX book, unfortunately. So I am allocating capital. As I was saying earlier, I'm looking to flatten positions, and I've just opened a new account, a new brokerage with MetaTrader that uses MetaTrader. So I will have a MyFX book possibly next week. Depends when I can get out of my current positions. I bought Dow, SPX, and NAS, all three of them at the bottom, but my NAS position was wiped out yesterday, but good gains on the rest. Great stuff, Slugmeister. I also really like your name, Slugmeister's. Yeah, good name. But yeah, I think indices are one of those ones where there was a lot of panic. We saw a lot of people worrying about the drop we saw on the indices. But to be honest, as myself and Nick were saying, that this was actually a very healthy pullback. It's nothing so far. There was nothing really to be concerned about. It's still overall a bullish market. So yeah. Prem, fair enough, brother. But where GPUSD taking support is took bullish a structure for it to hold. My personal view will be that the pound tank from these levels with the help of rate cut from the Bank of England. Prem, you could be completely right. Maybe I'll get in too late, and maybe the drop will already start happening. But I'm just going off the way that I've already planned the trade. I don't really want to mess with it too much, because as I said, the information I've got and a lot of the data I've collected to back the position up, it's been collected from bank reports and institutions. And their forecasts is for the end of 2025. So I don't really want to end up holding the trade for a year and a half. I'd rather try and get in a little bit later, cut that time down. And yeah, that's it really. Do you use limit order or market price? I use a mix. I very rarely use limit orders. So let's actually use Nasdaq for an example. If I was doing a limit order here, I would, let's say, the only reason I would use a limit order is if I couldn't be at the charts, but I saw a trade coming, or a trade that I wanted to get in. So let's say price was dropping, it was around here at the 19,300 level, and I was away. For some reason I couldn't be on the charts. I would set a limit at 50% with a stop below 618, and that's it normally. And I'll set alerts, and that way I can see the reaction off the level, because I like to enter on engulfing candles to confirm the direction. I don't really, in this situation, I don't really want to enter in on one of these big red candles, just because I don't want to enter while the market's dropping and it just goes straight to stops. It's a bit painful. So I'd rather just cut a little bit of the risk to reward off, just to have that bit more of a confirmation. Do you enter in positions based on price levels or candle patterns? Price levels, really, I don't tend to use. The only thing with a candle I'll really account for is if it's bullish or engulfing. I just want that final small confirmation. Although it's quite arbitrary, really. Sometimes you won't have a huge candle or a nice candle to buy from, and it'll still work out. It's more of just a pedantic thing, rather than a necessary rule. 20% to 30% gains, good for you, better than Ray Dalio, who averages 12% per public records. Yeah, you know what? Props to him, because I could sit here and tell you I get 70% a year. There's no way you can prove me right or wrong, unless I showed you a MyFX book, which at the moment I don't have. Like I said, I will have one very soon. But anyone who's willing to show public records is, even if they lose, even if they're unprofitable, is a big person. They've got some big testicles. Because it's not easy, it's not easy to sit in front of people, whether it's Twitter, YouTube, Instagram. It's difficult to show your finances, show if you're losing money or making money, have criticism, because you will always have criticism. You could be an amazing trader. Let's say you get 50% a year. You will still have people saying that your entries are too bad, or your risk reward's too small, or whatever it may be. There'll always be something. Yadesh, yes, I'm a swing trader. I also day trade, but not quite as often now. As I said earlier, I sort of fluctuate between day trading and swing trading. It really depends on the market conditions. So, for example, if there's nothing, if my portfolio is relatively flat, and there's no swing trades I want to get into, I might then go down onto sort of the hourly time frame and look for some intraday positions. Slugmeister, I'm already in this trade. I executed here. Well, obviously you can see it right here. So yeah, but again, it's very, very low risk. I would like to scale in, but I'd probably scale in once I've moved account. So essentially I'll actually just be reopening it. So I'm actually, ideally, I don't really want it to move too far, actually, so I can then get in when I've moved over to MetaTrader. Nardo Forex. Yes, I'm bullish on gold in the long term. At the moment, I just want to see a little bit of downside movement, but that's not happening right now. So I may just close out of gold. But yeah, I just want to see a little bit of a pullback off of this fib level. However, to be honest, I think this trade may be washed out now. I think I need to just realize the loss on this one, and then maybe reevaluate. But yeah, I think, to be honest, let's just see, actually, don't think there's much on the watch list. There's New Zealand dollar. I was actually on the webinar it was Monday, so just 2 days ago. I was saying I was looking to buy New Zealand dollar because I was looking for a little bit of a correction. I thought it was just quite overextended. I was looking to buy off these lows, but as I already said, I'm in some drawdown at the minute, floating drawdown. It's not realized, but I just wasn't really willing to open more positions. But this one would have worked out quite nicely, just for a little bit of a correction. Overall idea is to potentially get to this 50% level, and then short from there. If obviously at the time, if things still line up to go short. However, not a huge fan of the New Zealand dollar. I think New Zealand has quite a few issues. Same thing with the euro dollar. Looking to sell, looking for this 50% level here. Well, a golden zone pullback. Would quite like to enter somewhere around here, which would also line up quite nicely with this level throughout here. Just fix that. There we go. So that's it. There's also I think I've got rid of it. There's Credit Agricole target on Eurodollar for 1.05. As far as I can remember, is somewhere around here. So again, if I don't get into the pound dollar position for 2025, it may be a euro dollar position that I will look to trade into sort of Q2 to Q3 of 2025. I'll re-enter on NAS once the H4 downtrend structure breaks towards the upside. NAS was brutal yesterday, wiped out, then went up. Yeah, this is another reason I like swing trading, is because you can really not worry about day-to-day moves, really. And obviously that's quite general. You know, there are things that can happen that wipe out swing positions quite quickly, but normally you can sort of sit on a swing position and sort of let it run without too much of a concern about noise. Whereas when you're day trading or scalping, it's like you can just get taken out any moment. Pretty much all it takes is one very volatile candle. Bro, if the daily on UJ closed below the resistance, can we look for more sells after a retracement? Sure. If that's how you trade, then yeah, do it. I am staying away from yen pairs for now. I'm already in 2 positions. I don't really want to get into more. I also think that the yen pairs are very extended. So although we've had positive data for the yen, I do think just from a technical aspect, we need to see some sort of bullish movements just to have a little bit of a pullback. Actually, I wonder if I can find it. There was a report today. Just give me a second. It'll be here. Okay, there we go. I hope you guys can read this. So I won't read all of it, but essentially, this is Credit Agricole, and they are saying that the yen pairs are now back at a fair value price. So they use what's called a FastFX model. And what this does is it finds a fair value for every currency, or the currencies they want. So for example, if, you know, dollar yen had a huge run to the upside, it may not be the fair value price that Credit Agricole view it as, because they were shorting euro yen for, I think it's probably 3 weeks before this current yen move has happened. And I was very confused why. I just couldn't work out the position, why they would take the position, and they were taking it just due to the fair value. They didn't see it as a fair price for the asset, and now they are saying that it's back at fair price. So we'll see. We could just see some fluctuations around the current price. I don't know. But yeah, the yen's not something I'm too bothered about getting into right now. I want to let the yen settle down. So I think I've got around 10 minutes left, I think. Not totally sure. I'm sure the A1 guys will pull me off when my time's up. Now, the dollar NOK is also one that I really want to short. And again, this is a very long-term position. So I've got a lot of long-term things in my watch list at the moment. And the reason is I quite like to have some things running in the background. So if I'm not swing trading, there's nothing on the day trades, I still have positions running in the background, and I can just leave them, as long as the outlooks and the forecasts and all the data still supports them, I can just let them run. I don't need to do anything. And that way, theoretically, always making money. And of course, I'm not saying that all my trades win, because they definitely don't. But yeah, that's why I like to have some trades running in the background. So this is the weekly time frame. You can see I've got an alert set here. So I'm just waiting to see either the current weekly candle close bearish, or this this current candle come up a little bit further to, you can see my alert set. Stop loss above these weekly wicks, and we'll see if we can come down. Of course, this is quite a large target, so we'll see if that is realistic or not further to the time. But this is also an asset that is viewed as very undervalued in terms of the NOK. It's viewed as quite oversold, really. So there's a lot of forecasts at the minute saying that we could see the dollar NOK start to come down as the Fed starts to cut rates and the NOK starts to gain some value. It could be quite a good one to keep on your watch list. Australian dollar. Now, this is another loss I took this month. Was on the wrong side at the time. The dollar looked quite bearish, and the Australian dollar looked quite nice, but those two narratives flipped very quickly once we got the Chinese, I think it was the Chinese rates that came in as a surprise. We also got the US dollar that seemed to show quite a bit of strength. So that wasn't a great trade to be in, actually. However, still watching this one for a potential position. Not really too bothered about catching it, but yeah, still something here. So let's just take a look at the econ board again. So yeah, here AUD USD is still registering as short. We've got high US rates continue to pressure AUD USD. Despite the RBA's tightening bias, Australia's persistent inflation problem, and the wide US-Japan rate spread weigh on the AUD. Additionally, China's weak growth impacts Australia's commodity prices. Now, again, this is a 6-month forecast, so maybe it's not ready yet. We'll just have to wait for a bit of a pullback. But yeah, for now, something I'm keeping an eye on. AUD CAD. Did we already look at AUD CAD? Or was that dollar CAD? Can't remember. But yeah, let's see. Not really a fan at the moment, to be honest. Again, let me just quickly take a look. So seeing the CAD is quite neutral. Australian dollar is quite bearish. So to be honest, I'd be looking for a continuation of sells. Let's just see if we've got anything here. Not really. The fib doesn't really work here. I'm not going to try and force it. But yeah, I would be looking for a continuation of sells, potentially just around here where we had consolidation. Then we could see the 200 moving average come and meet price. Take profit would be potentially just back down to the lows down here. So that's the approach I would take, but it's not something I would actually take. You know, I'm not a fan of this one really. You were in AUD USD longs too, got wiped out. Sometimes even the best setups fail. Yeah, well, that's the thing. One of the reasons I like to mix the economics board I've shown you a few times now, and the edge finder, is because it can give quite a good edge. So edge finder is great for finding trades pretty quickly in terms of it shows the current unemployment, current GDP, and obviously the previous as well. Whereas when I make my econ board from bank reports and articles and all that type of thing, I can then get a look into the future or an idea about, what I expect over the next 6 months to a year. And then I can filter out. So if the edge finder is bullish on something and my analysis is bearish, then I can wait until the edge finder flips bearish and I can make sure I'm not getting in too low or too high. But yeah, on this situation, didn't work out. So let's see. That's it for the watch list. Open positions. Don't really have anything too interesting. I'm still in my euro pound shorts. I think I showed that at the start of the stream actually. Gold. I think I'm going to close out of gold after I get off this stream actually. Not really liking how it's going so far. Seems to be a bit too bullish for my liking, so happy to cut that loss. Let's see. Euro CAD, I'm in that one. I can't really give the details on that one right now. Maybe when that trade's done, I can, or in the future. But if you want a little hint about Euro CAD, look at seasonality and look at how Euro CAD has performed from July to sort of the start of September, and that will give you an idea. And look at where Euro CAD is technically as well, and sort of the higher time frames. That would give you quite a good trade idea to work from. So guys, I think my time is coming to an end. So if you've got any final questions, let me know. I'd be more than happy to answer. Okay, so yeah, cool. Got 3 minutes left. 3 minutes to answer if anyone has any questions. If not, that's fine. We'll call it a day. But I think I've given everything I've got, to be quite honest. So yeah, I think euro dollar could be probably the best potential one coming up, but yeah, we'll see. Like I said, I'm pretty flat now until August. I'm not too interested in placing any new trades. But yeah, I hope you all. Oh, it's Wednesday. I thought it was Thursday. I was going to say have a great weekend, but it's a bit too early for that. Slugmeister, I appreciate you. Happy trading for you too. Zen, you want to talk about the Swiss? Oh, dollar Swiss. So I'm in dollar Swiss, and again on the wrong side of this one. I've had a really bad trading week. Actually, just got stopped out, which is fine. So I was saying on this one, the reason I was going long is because we've had another rate cut and dovish forward guidance from the S&B. Have halted the Swiss rebound. Persistent political risks in Europe and global uncertainties could challenge the Swiss in the near term, while lower inflation differentials will depress the Swiss real valuations. Will depress the Swiss real valuations in the long run. So I'm still looking to buy. This was just clearly an entry too early, and I know Nick was on the other side. So Nick, well done to you. But yeah, I'm still looking to go long. But like I said, I think I was just a bit too early on that train. So let me just check. Yeah, so that's why I entered actually is off this 50% level. I thought this was quite a clean technical setup, but clearly didn't work out, unfortunately. News is coming. Is news coming? Am I behind? I didn't see any news for now. Maybe I've missed something. Let's see. Oh, it's only pending home sales. Year on year, month on month. We also have crude oil stock exchange coming up in half an hour, but relatively unimportant, I think. Lee James, thank you. I appreciate you. I see you in the chat all the time, so thanks for always being a viewer. So yeah, guys, I'm going to head out. I appreciate all of you once again, and I think I'll see you in 2 weeks. I'm not streaming next week. So yeah, have a great weekend. Have a great rest of the week. I'll see you all very, very soon.
Man, Frank, we finally made it down to the beach this year. What do you think?
I think this is a really great setup.
No, Frank, we're at the beach. We came all the way down here. What are you doing on your phone?
But check this out. It's a really great setup on gold right here.
Our Edgefinder summer sale is now live. Get 50% off all of our tools like commitment of traders data, economic data, and our top setups algorithm for 50+% off using the link being dropped in the chat right now or the description down below. Don't miss it. This is our biggest sale of the entire year.
Hey everybody, happy Wednesday. It's July 31st. We have a pretty wild start to the market. It's 30 minutes into opening bell. We've had futures on the rip. Everything seems to be posted higher. The Bank of Japan just raised rates by 25 basis points. Here we are looking at the earnings for the week. Last night after market, some of the big notables, Microsoft, Advanced Micro Devices. I did see this after market. I posted this in one of my Telegram channels. So Microsoft was down like $10 after market. AMD was up $10 after market, and I think that whole thing flipped. So I do want to take a look at these. Let's just take a look at these Tuesday earnings and see how things came in. We also had before market open Boeing and MasterCard today. I do have a trade running on MasterCard. I'll take a look at that. So let me move this out of the way. Let's have a look. I put on my little daily strangle on the SPX. I collected a decent amount of credit this morning. I didn't make it delta neutral. I shifted the put side up, so I did like a 20 delta put and then an 11 delta call. So I'm looking to see if this big gap just kind of pauses for the morning, allows me to take out that time decay. And then we have the FOMC today at 2 p.m., 2:30 press conference with Jerome Powell. And we're going to see if this market wants to get moving and shaking. So directionally, that's a pretty large move. I mean, to open up here around a 1.4% gap higher is quite a bit. You look at the Nasdaq, just absolute rip to the upside, almost a 2% gap. In fact, it was from close yesterday to open today. We're looking at about a 2.3% gap. That's a monster move. This is coming back in a big way. And I'm very curious. So I put in, when the week started on Monday, I put in a 460 by 459 bull put spread. I'll show that in just a moment. And then I also put in a 475 long call. So this is an out of the money call. This is I was looking to get filled at 45 cents. So I'll show you those positions right here. Well, I can just show you the whole portfolio, but let's go to the Qs. It's a little bit easier if I just show you like one account instead of all of them. So here's the Qs. Here's my 460 by 459. I have a credit spread there. So as long as price stays above 460, that was 45 cents collected on those 4 contracts. So if we stay above 460, that is 45 cents. 4 contracts, it's $180 profit per account. That's pretty decent. And then I also have a long put, or it's a naked put out to next year. That's a leap that I like to do for some income. This one should be looking better. I think I collected about $5.60. It's trading for $6.43. That just needs more time to decay. And then my 474 call, I put in the 474 call for a 295 debit, and right now it's trading for 287. So considering I'm about $4 or $5 out of the money, I mean, look, if we come back and test this level, like right now and at the money is trading for about $5. So if we can get today's move, tomorrow's move, maybe another gap higher with Wednesday earnings or Thursday earnings, we have Amazon, we have Apple. What are the other earnings we have on Thursday? So tonight we have Meta after market, after FOMC. We have Qualcomm, we have ARM. Those are decent enough to maybe be some bigger movers as well. And then Thursday, we have some crypto-related ones, MicroStrategy, which is technically not crypto, but it certainly moves like Bitcoin, Coinbase. And then after market, we have Amazon and Apple with your big mega cap. So, again, I've talked about this. I mean, after this decline, if we see the Mag 7 perform well, the Mag 7 stays intact. The Mag 7 continues to outperform. The Mag 7 probably stabilizes the market, and the Mag 7 probably helps the market lift off. Maybe it's a broad market liftoff this time because Fed's looking to cut rates in the next couple of months and possibly 3 cuts by the end of the year, September, November, December. Right. So anyway, my $3, my 474 call right here is trading for about 290. So I'm about break even on that call. If we start to drift a little bit higher, this is good. The intention with that trade is to try to turn this into, a 1 to 200% gain. On the chart itself, I mean, all I'm really looking for, this is a chart alarm set at 474. So if we come back and we sniff out that gap, or better yet, we close that gap, I could turn, a 295 debit into possibly let's say a $6, maybe a $6. And if we go up another, I mean, that's crazy if we went to 480, but if that was intrinsic value, that would be $6 to $12. Wow. That'd be a $12 credit. And I don't know if I'm getting there this week, but still, if we get to, $5 or $6, I'd be happy taking that profit and flipping the Qs for a nice little win this week. So far, so good. I'll keep an eye on things, but big fat gap to the upside, which is pretty exciting. The Dow's also still clinging to gains on the day. IWM is a little bit, softer, but still stable. I have some credit spreads on the IWM as well. I'll get into some requests and positions here in just a little bit. So there's the Qs. Here is an IWM trade for the week. So I have a 218 by 217. So far, that credit spread is looking pretty good. That one also was filled for 50 cents. So again, if I'm in 5 contracts, 50 cents, 5 contracts, that's $250. If I add that to the 180, maybe turn a couple dollars on my, let's say I make $2 and whatever, another $2. Well, it'd be 180 and 200 and another maybe 200. So, I mean, there's $580 per account on the Qs and the IWM. And then everything else is kind of longer term on the Russell for right now. So not too bad. Also, a big turn in oil today. Gold is up, silver is up. The dollar got hit really hard. Has anybody been sleeping under a rock last night and didn't notice that the Bank of Japan raised rates by 25 basis points? This is the currency strength chart overnight. It didn't happen right around the news. This is always a tricky thing. Bank of Japan, when they have their monetary policy decisions, it's like this big 3-hour window. And so from like 11 p.m. Eastern time to 2 a.m. Eastern time, it's combination of the news hits the headlines. There's press conferences as well, and then you also have like your Asia session transitioning to your London session, and that's when things started to take off this morning. It was around 2:30 to 3 a.m. Right around that London Open, things started to rip, and we're just seeing more strength in the Japanese yen. Aussie's coming back a little bit, but as one of the weaker currency pairs today, you got New Zealand, Swiss on top. The dollar's been hit pretty hard as well. So here we go. Let's take a look at, I'll just do a little top down here for my kind of macro SPY. Okay. Up on the day, if we zoom in here, just another big gap to the upside, pretty impressive. I do want to take a look at those earnings, like I said. Pending home sales, news coming soon. Yep, we have yen reversal. Russ, what direction are you talking about, dude? You looking to go like yen weakness? I mean, I talked about this morning in my trading room. So look, the yen is getting stronger, right? I mean, here's dollar yen. This is a good trade overall. Look, one trade that I'm particularly liking. I mean, I look at it this way, okay? The dollar yen at this point has kind of one way to look at a bounce, and it's right at this trend line. So we go back to the lows of, we had this 2022 correction in top. It came all the way back down about 50%. Or 38%. It was from this rally right here. So about a 50% pullback. We found equilibrium, and the trade's been off in another carry trade environment. Okay. So what I'm saying is this. I mean, from this low to this low to this low, we have a really strong trend line. Now, as a near-term buyer, I could see this high, this low setting up for a bit of a bounce. Okay. Now, that does beg the question. If we have a high to low that turns up in the short term, to me, this is just wave structure that if this market has done enough damage and taken out this high, low, lower high, are we going to see another push lower into this open space? I've said for months that if this is going to be this unraveling of the carry trade and this Japanese yen is going to get stronger, well, it starts with monetary policy. So the Bank of Japan went from negative interest rates, okay, to then 0 to slightly positive at 0.9% or 0.1%, and they just raised rates again to 0.25. It was not on the calendar with the forecast to see a rate hike. The market didn't expect a rate hike last night. They had one, so they had one. Um, it was expected to stay the same and still be a BOJ pause at 0.9% or 0.1%, but they went ahead and raised rates, and the yen got another push higher. So now the BOJ is sitting around 0.25. Let's talk about the interest rates that are higher, right? You've got the dollar likely going to cut. You've got the ECB that's already cut. You got the BOC that's already cut. You got the Bank of England Thursday that's supposed to cut. The New Zealand dollar stays the same around 5.5 right now. The RBA staying the same at 4.35 right now. That's subject to change. The Swiss is cut. So we have the Swiss, the CAD, the euro, the dollar, the pound, all looking to cut, while the BOJ is looking to raise or has raised. Now, does that mean that this is like, oh my gosh, the carry trade is garbage? Well, this is what happens when the carry trade unravels. Volatility increases a ton. We have noticed that, right? Look at this drop in the yen pairs. We've seen 1,000+ pips in most of these yen crosses, and it is what it is. You're either in it or you're not. And I've said this, like, I'm not participating in the Japanese yen pairs. I'm not trading Forex in the Japanese yen right now. What I'm participating in is I'm trading Japanese yen futures. So that's /6J, or I'm trading FXY, which is an ETF that trades the Japanese yen. And I've been long on that like a stock. I'm long the FXY, which is like being long the yen without paying negative swap. So that's been okay. And I'm not up a ton. I'm up like, $2 or $3 a share. Not a big deal. Okay. But with some defined risk in 6J, I can use a futures contract. I can trade options on that, and I can define the risk, and I can just do some, simple short-term credit spreads, maybe out a week or two. And, it's a 1-to-1. It's like, risk $200, make $200, and it does okay. Those have been way more short-term. FXY, I'm hanging on to a little bit longer. Okay. So CAD yen short might be a good carry trade. That's not a carry trade, Slugmeister. That's the opposite of a carry trade. The CAD yen you're talking about a 4.5% interest rate compared to a 0.25. That's not a carry trade. Okay. There's nothing about the Japanese yen right now that's a carry trade. This is the anti-carry trade. This is the unraveling of a carry trade, right? Carry trade is you sit and you collect swap on the positive interest rate. Okay. So you're talking CAD yen short. That's not a carry trade. CAD yen long is a carry trade because you're going to collect that payment because you're long the CAD, short the yen. But the price and the volatility is not favoring that right now. Right now, this is a non-carry trade. This is an anti-carry trade. This is the unraveling of a carry trade. That's not the position you want to be, putting your foot in the ground and saying, like, I'm going to go long against the yen because it's a carry trade. That trade you had 2 years to participate in. This is not the time you want to talk about the carry trade. This is in front of our very eyes. The carry trade is unraveling according to the yen. There's a lot of volatility on this. So I am not trying to pick bottoms here. All right. What I would do, and this is what I'm looking to do, is I'm going to continue to participate in FXY and be long. Okay. If we see in the near term, here's dollar yen, for example. Now, dollar yen, why would this one be maybe one of my least favorites? Because if the dollar, let's go to the DXY for a second. If the dollar is going to get weaker, and I've mentioned this also many, many times, what are the levels that I'm watching in the dollar? 103.90, and this indecision around 105.50, right? Today we have FOMC. I am very curious to see how all the dust settles today when the day is done. I took a screenshot of this intentionally. Here is a currency strength snapshot. There's earnings. I'll take a look at that in a moment. Currency strength. I noted this. This should have been this morning when I wrapped up my session. So this is around like 9:45 a.m. Eastern time. Actually, no, you can see it at the bottom, 9:10. Okay, so why did I take a screenshot? Because the day is not done. We have the whole day of the stock market to unravel with these big gaps, 2% gap in the Nasdaq, 1.4%, 1.5% gap in the SPY. The Japanese yen crazy strong, currencies all over the place, dollar getting hit pretty hard. So the reason I want to take a screenshot of this right now at 9:10 is because what happens by the end of the day at 5 p.m.? Does the dollar move more? Does the Fed get more dovish? Does the Fed, just really cement the idea that they're going to cut rates in September? Does the market like it? Do we continue to see this push to the upside? Maybe. So dollar yen, I say, might be trickier because the dollar might end up taking this whole idea of the carry trade unraveling, and the dollar might be one of the least beneficial movements, right? The dollar might get hit really hard, and that gives risk appetite a chance where, maybe the the Aussie yen gets a little bit of a pop, or let's just say the Aussie comes back in some strength, and the New Zealand comes back in some strength, and the pound and the euro come back in strength, maybe, right? So if I go individually through these yen crosses right now, okay, Aussie yen has been beat up pretty badly. All right. Now I look at this as, am I trying to buy this? Not necessarily. Okay. Here's the good and the bad with this trade. If I take a high to a low on this Aussie yen, I'm not saying that the bottom is in. It's clearly not in. All right. But if we turn up in the Aussie yen, if we pull back to a 30 or 38% pullback level, or a 50 to 61% pullback level, for those of you out there that are liking the short-term stuff, if you have some confirmation to trade bullish, as long as you have stop losses in, there might be an opportunity to see this thing. We've taken out some decent levels. We broke these intervention lows over the last couple months. We're breaking a trend line that's been since the bottom of late 2023, or I should say early 2023, because we had a November to January correction in the yen, and then January of 2023, this thing started to move up again. So basically, you're taking out these like January, March lows of 2023, or the trend line that started there, rather. And here we are, like doing some damage to this trend line. So for me, I'm not that interested in looking at trying to scalp this thing, because it's too hard, and sometimes it's 1 in the morning, 2 in the morning Eastern time. That's not when I want to get up and trade. I'm those days are done. Okay, so for me, I'm looking at it this way. If I'm going to take a chance of this trade, if this thing comes up here to pull back, I might be interested in a potential swing trade, which means I'm looking to short and short, stop loss above, define my risk, maybe like 0.5% risk for a 0.5 to 1 to 1.5 upside. I do think we have a 1-to-1 opportunity. I think a 2-to-1 is fantastic. A 3-to-1 is amazing. Because if we're going to have more of this, this is a high, low, lower, high, lower, low, lower, high, lower, low. We'll probably have a 5-wave move if we're going to see this downside. Okay, so I wouldn't be surprised if the yen continues to show strength, and if so, this is how I'm looking to play it. Aussie yen does look like a pretty clean trade. Okay, does this mean that the bottom is in? Not at all, right? If this goes lower, 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 I need to adjust my fib here and drag this lower, and then still anticipate the same type of levels. I would say this could be pretty simple. If all we do is head down here, break this trend line, pull back to the backside of this trend line, head lower, right? That's an easy trade. If we pull back again and form a flat pattern, that's still an easy trade. I'm still going down towards a symmetry measurement, all right? So all these yen crosses have what's looking to be a little bit more of a probability that the downside will continue. But I do think like a pullback and a swing trade setup is likely going to be the case. So CAD yen, same type of thing, right? You can see I've got to adjust my fib. I'm not doing anything on this right now. If you're a short-term scalper, you got to be looking for some opportunities to buy. I don't like that. That's like picking the bottom. You got to have stop losses in. Don't try to dollar cost average in this thing going long. That's a stupid trade. Okay. The best trade would be wait for either confirmation that is so obvious you can get a chance to get your stop loss into break even or better, or wait for this thing just to turn up on its own, find some simple retracement levels, and then look to fade that move with the probability that this direction, this momentum is strong enough that this is sell off for the impulsive move, pull back retracement, and then another impulsive move going lower. That's it, right? And if it does it again, you go for 5 waves, you measure moves out. So I wouldn't be surprised if this unravels and unravels quickly. Notice how I'm talking about all these currency pairs that are not the dollar, okay? Euro yen, this one looks really good to me, right? I mean, we've done some massive, massive damage. We've taken out, lows here, intervention lows here, all these previous levels. If we have any type of pullback on the euro yen, I like this kind of 30 to 70% zone. So a 30, 50, and 70. I talked about this in my trading room this morning. If we have pullbacks in there, I like looking for small trade, small trade, small trade, risk defined above the highs. And all I'm looking to do is line this thing up for another push lower. If I only get filled on one of these entries, that's fine. Once this one goes in profit, I cancel this trade, move my stop losses to break even, and then go after lower lows. Okay. But I do think this is a pretty good looking setup. So high, low, we get a pullback in here, looking to swing this thing for maybe a 3 to 5 wave move and see how it plays out. That's about the only way I'm comfortable trading these yen crosses right now. Okay. Have I missed this move? Yeah. And the reason why I missed it is because I'm participating in other things. I'm long the yen with futures. So 6J is my symbol, or you're long with FXY, which is the ETF that trades the yen. That's been a much easier, much less stressful way of trading the Japanese yen, because I know for a fact that there's been a lot of traders out there that are sitting here like, oh my gosh, when's the BOJ going to intervene? It's going to happen. It's going to happen. That is a terrible plan. If you're trying to trade currencies around what a central bank is going to do, you have not experienced what it is like to be beat up in a flash crash move, or be on the wrong side of some type of intervention, or see the market move in a flashy, 500 to 1,000 pip move that you have no control of your stop losses. Nothing is guaranteed. It's a horrible position. So I'm just telling you, that's why I stayed out of the yen. And even right now, it's like, well, this is so easy. It dropped 1,000 points. I know it did. And it would have been nice to participate. But I can promise you that the majority of traders that are in the yen crosses have been getting crushed on shorting. Now it's starting to pay, and they're just happy to get out at break even. And I say that because that's been me. I've done that before. I've been in trades that have been upside down, 1,000 pips. And what do? I get back to break even, squeeze out a couple of bucks, and I get out of the trade. I don't do that anymore. It's like, that's crazy, So I've just stayed out of the yen. I've just, made some fresh batches of popcorn, watch all the fireworks, and see this thing happen. I don't care. It's easier to trade with other instruments than it is trying to get in here in Forex. Okay. So I'm happy for the traders that have been stuck, and it feels like maybe there's some chance to make some profit. But it's a weird mindset where you're waiting, and you're finally relieved that price is going your way. And the first instant you get that thing break even or better, you just want to get out of the trade, because you've already over leveraged, you already taken too big of a drawdown, and now you're just happy to get out of it. Okay. That's not trading, right? That's luck, because this could have been a lot worse. Look, I called out some intervention levels based on rate of change, and I thought, yeah, the euro yen might go to 179, 180. Well, we turned around 175. Dollar yen, I thought we'd go up to, what do you go dollar yen here? I looked at some intervention levels. I think potential BOJ intervention was 165. We stopped at like 162. So was I wrong? Yeah, I guess. But I was waiting for a turn. It's just a matter of like what happens. So we break the trend line, we've fallen. We're going towards an outer trend line here. That's fine. Like, it doesn't look bad, but now that it's kind of right in our face, Swiss yen might be one of my favorites. Why is that? Because this one has been making all-time highs many, many times over the last couple of years. And so if this one goes, let's say we test this low or test this low, this could be a really easy and nice pattern trade, where if we set up a head and shoulders or a crown pattern, I really like that potential topping pattern on the Swiss yen. Is it going to be a joyful, positive swap trade? Nope. It's going to be a negative swap trade, which is going to be annoying. But if you can line this thing up for a symmetry move of 1,000 pips, look, if I pay $100 in swap and I make $1,000 in profit, I still make money. Is it great? I mean, do you like losing 5% to your broker just on swap? Not necessarily, but it could happen. But if you make money, it's still a good trade. What I don't want to do is I don't want to sit in a trade that lasts, and oh my gosh, I'm in this carry trade that's negative, and I'm paying the broker every single day, and all of a sudden it's like, I make $1,000 and I paid $300 in negative swap. That's what I don't want to have happen. I experienced that in 2022. I was in positive swap trades that the brokers weren't translating over to me yet. That was really frustrating. In fact, I got very frustrated and kind of disenfranchised with Forex trading in general, because I'm like, this is ridiculous. Rates have changed by a dramatic amount. We're at like 5% to 0%. How the hell do I not get swap? This is so stupid. And then it was January, 2023, and all of a sudden my broker starts paying me swap. So I was frustrated. Anyway, that's why I watch this stuff. Okay. All right. So that's the plan in the yen. So give you a quick summary here. My yen crosses. If you just look at the high to low, short term, we could have a pullback. I think we will. From there, though, the 30, the 50, the 70, I'm looking to kind of level in. Stop losses above. Make sure that risk is airtight. I'm not looking to risk more than 1% on any of these positions, probably less than that even. And if we go lower, take the profit, measure symmetry, get your 1.5 to 1, 2 to 1. I'm happy getting the heck out. If you want to hold it, go to break even or better. See if you have 5 waves and then get out. To me, this is no more than a 3 or 5 wave move. Okay. Russ says, I see some plus 500 accounts don't charge swaps on yen. I don't know what a plus 500 account is. The only time that I've heard you don't have to pay swap is if it's it'd be like a religious based account. But as far as I know, most brokers standardize, you've got some swaps you got to be, if you're positive swap or negative swap. Okay. All right. Anyway, we're good on the yen crosses. All right. Let's go back to the DXY for a second. Okay. And I want to spot check this trade as well. All right. We're tipping up there. Let me go to SPX. Looking at this trade this morning. So SPX right here. We've got a 54.50 and a 55.60. So my delta is shifted a little bit to the upside. I centered this thing around 5,500, 55.05. So we just have some kind of quick moving direction today. I'll move this one over here. So SPX, yeah, we're getting a little nudge and follow through. It's okay. I mean, I'm just going to chill on this one. I think 55.60 is I suppose is doable. If I look at my gamma levels today, this is SPY. I just want these numbers to be larger. I mean, I'm only seeing a current net around 433, current net at 389. I look at my opening, my pre-market levels. That was my biggest level there around 292. I just don't have the volume and open interest that I want to say there's my magnet. But if I look at the QQQ, maybe this one loads up a little bit differently. Let me have a look here. So for the Qs, we blew through that 463. Here we are real time. So we've got in the twos on the current nets. I'm still looking to see if we can fill that 474 this week. If we do, I'll close out my long call. Anyway, it's just a big move. I mean, so if you thought the last 2 weeks of gaps, if anyone was paying attention, we had some big gaps to the downside, right? We had like a Tuesday, Wednesday, Thursday, those big gaps to the downside on the Qs. This morning's gap was bigger. There was like a 1.5, 1.3% gap to the downside the last couple of weeks on the Qs. Today's gap up was over 2%. If this, doesn't scream buy the dip, I don't know what does. I mean, this market clearly is anxious to just go up and try to go up. And so we've got some earnings to talk about today. S&P ride chip stock way before Fed verdict, Microsoft slips. We'll talk about that in just a moment. I left off here on the dollar, and then we'll go into some other stuff. Okay. So Christian, MyFX book. I mean, I've got MyFX books on some robots. They're fine. It's like I've got robots that are up like 20, 30% for the last couple of years. MyFX book, the reason I don't have a MyFX book to share publicly is because I manage money. So I'm not interested in, sharing what I'm doing with $2 million and what do you want to do with it? It's like I've been trading for 20 plus years. I'm working on some additional clients. Like here's what I'll do. My capital here, my tracker here, it's like, you want to see any trade that I take? I will show you every trade that I've taken all over the place. I track. I mean, why do I don't, because I don't care. It's like I manage money. I manage real money. I manage for clients. That's more important to me than a MyFX book that's like, hey, look at my robot trade. Fine. My robots trade in the background and they do great, but I manage real money. So to me, a MyFX book it's a testament to my trading. It's like what makes money to me is in my profitable year to date. Yeah. All right. So again, not to shoot it down. I'm just saying like, I just don't care because also I've done MyFX books for freaking a decade. And what happens? Oh, my broker switches my server and then my robots are all fudged up and disrupts my trading. And then my MyFX book looks like crap for a couple months. And it's like, it doesn't matter. It's like, all I want is the process of trading and time. And so when brokers disrupt my servers and I've got to, mix things up and I take some losses, it's MyFX book is the last thing I care about tracking. Okay. I'll just show you my account. Right? You want to see me trading? You want trades I take? I'll show you. It's on a spreadsheet. It's in my live accounts. It's in my broker statements. That to me is way more real and authentic than MyFX book. Okay. All right. Licenses. I've got a 65, and working on a Series 7. But 65 is enough. It's what I needed for the hedge fund. That is a retirement investment advisor, RIA. Yep. Okay. Sorry, let's move on here. So dollar index, Fed today, let's see what happens. I do think the dollar is ultimately the sacrifice of the market's going to continue to rip higher. The dollar probably gets beat up pretty badly, which I'm fine with. Look, if the dollar gets weaker, stock market goes up, gold goes up, oil goes up, silver goes up. A lot of things are risk appetite. I do like that narrative on the dollar. If the dollar gets weaker because the market's finally going to start pricing in Fed rate cuts, September, November, December, we're still talking about those months for those potential cuts, right? Swiss pairs, I'll talk about that. I still like the Swiss pairs. I'm long Aussie Swiss. I'm long CAD Swiss. I'm long Euro Swiss. I'm long Euro Swiss. I said that. Pound Swiss, New Zealand Swiss, dollar Swiss. I'm long. Okay. I was up about 15% in one account just on Swiss crosses and positive swap and pips. The pips have been reset to essentially zero. I'm up like 3%, 3.5% on swap right now, but I'm juggling like a neutralized positions. I've had positions that were up in profit for the entire year. They got wiped away, wiped back to essentially zero. Doesn't change my outlook, especially what it does right now. It's like in the short term, I might just look at taking more non-FIFO trades and just take some scalps and take some profits. But I'm still at 20 plus year levels and 30 plus year levels on the Swiss crosses. What would be nice, and I'll say this, what would be nice is, okay, so we have the BOJ raising rates, okay? The Swiss National Bank has cut rates to 1.25. I hope they cut again. If the ECB is going to cut once, I hope the Swiss National Bank cuts to 1, maybe sub 1. And it starts to kind of fuel that still, like, it's still a positive swap. It's not as wild and crazy as a risk off trade in the Japanese yen, and it's not the unraveling like the Japanese yen is seeing right now. You're talking about the Swiss at 1.25 offering a bit of a swap differential, but also technically sitting at like 30-year extremes. That's why I'm long the Swiss. I should say long against the Swiss. Okay, all right. Let's go to the Fed Watch tool really quickly. So today, Fed's not going to do anything surprising. They're probably going to keep the rates the exact same. Highest probability. This thing has not been wrong since 2009. There's very little surprises. The Fed is a very transparent central bank, to a fault, where it drives us crazy because there's not just tell us, man, right? There's not that. It's like they're transparent in a way that it's like, we'll do this, we'll do this. We might do this, we might do this. It's so transparent, it doesn't give us any real clear guidance. But this tool is easy to kind of sift through all the noise and find out that, yeah, they're not going to do anything today. They're going to keep rates the same. But if there's any language that suggests that they are going to explicitly cut and just come out and say, look, everything looks good, inflation's down, we're seeing improvements, blah, 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 blah. If it's a pseudo hawkish, or I'm sorry, a pseudo dovish statement today, then the market might start looking at not just the September rate decision, but also this November one, which is now going up in probability. Okay. What we had not that long ago, within the last month or so, it was only a cut expected for September and then a pause the rest of the year. This has changed a lot. Now the market's like, okay, you guys are going to cut in September and then cut 2 days after the election and then cut at the end of the year. This is now pricing in 25, 25, 25 cuts. So 25 basis points, 25 basis points, 25 basis points, putting us right there around that like 75 to 100 basis points cut by the end of the year. Okay. So that's the change, and that's the narrative we need to follow for the Fed. How does that affect the dollar? If the market starts pricing in an aggressive rate cut cycle for the dollar, I'd say the dollar finally starts to break out of this choppy garbage that I've been hating for the last couple of months and see if we get some clean direction. One thing to note, today's the end of the month for July. August is usually and historically a transition month, which means if we start to see this range breaking, a sneaky little breakout could be where this thing starts to line up for an August breakout and a September push, the dollar gets weaker. Okay. That is what I'm watching. It does need to get back below 103.90. You can say 104, but we're at 104 right now. So I want to see a fresh break of these lows and then a rejection at that resistance. I want to see this support become resistance. I don't want to short this thing down to 101 or lower. That to me would be a good trade on the dollar if we have confirmation. Okay. All right. Now, that being said, let's say that the dollar bounces off these lows. Does this change my outlook at all? Not really. All this means is we're more range bound on the dollar, right? This to me is not a spot that I want to trade the dollar. If you're looking at Aussie dollar, euro dollar, pound dollar, New Zealand dollar, dollar CAD, dollar Swiss, dollar yen, the dollar yen's the only thing that's really moving. You know, dollar Swiss is like pulling back a little bit. Dollar yen's moved a ton, over 1,000 pips from 162 to 150. Aussie dollar's garbage, euro dollar's crap, pound dollar's nasty. Nothing's really clear. Now, if we start to see some dollar weakness, okay, let's go to the dollar crosses. Dollar weakness. Well, we just came off of this little spell of Aussie weakness and dollar strength. Dollar index doesn't really show a lot, but could I see a good trade opportunity here? Yeah, I see a bit of this happening, right? We've got some lows, or we had this bit of a wedge forming, something like that. Dollar index is indecisive. Aussie dollar is indecisive. But where does this go to get bullish? Well, if we're going to see a weaker dollar, I'd love to trade the Aussie dollar above 68 and have this thing rip to the upside. Where to? Look left, look left, look left. Have this thing go up towards 75 or 7,800. You know, measure the move. If this is a low to high swing and we measure a symmetry move, I mean, this thing could be back in the 80s. But we have to see the dollar cooperate. If the dollar is garbage, these currency pairs are garbage, right? So I want to see good, clean confirmation on the dollar because I think it is going to be a much bigger trade for some clean direction, as opposed to you get a couple weeks of, you know, the dollar moves up, the dollar moves down, you make some pips if you're scalping. Otherwise, it's not giving you any real direction. All right. So do I like the Aussie dollar? Sure. Do I need a better setup? Yes. I need to see some better confirmation. So either this as a bit of a wedge that I'd be waiting to see if we can make a break for it. Okay. Not terribly difficult there. And then see where we break, above or below. Okay. Euro dollar, probably my least favorite, but you see the same type of thing. A lot of choppiness. So I'm just going to wait for the dollar. The pound dollar, this thing has been just a nasty currency pair. Fake out, fake out, fake out, fake out, fake out all over the place. I don't like it. Possibly some range bound trading. The BOE cuts rates. We might have a range where we, you know, come up here towards like 3,000 to 3,100. If we hit resistance again, you know, maybe the pound dollar starts to weaken as well. If the Bank of England is right alongside the Fed cutting rates, who knows? You know, I don't know. Probably not my favorite right now. Okay. New Zealand dollar, honestly, similar to the Aussie dollar, this one might be setting up for something pretty solid. Now, I would like, and so two things. One is we have some intermediate support right now. I don't think this is good enough to make a decision on, but I will say if we come down to this level, which is around 5,600, pretty interested in a buy trade there. Okay. And that buy trade could be relatively, you know, tight as far as risk goes and reward back up to resistance. Or, you know, and maybe we don't go much lower. Maybe this thing turns and the way that I have to trade it is we get confirmation here and this thing starts to go up. So we have a low to high, right? And we have a low to high. I'd measure a symmetry move up to here. I'd probably look at targeting all this resistance around 75. Look, if we get a breakout here, if we get a breakout around 6,300 and we go to 7,500, is that a good trade? If we find open space of 1,200 pips of movement, is that open space for Forex trading to be a good trade? Yeah, that's great, right? So if we get that trade, I like that trade a lot. Okay. And I wait for that. If we break 63, I think that's a good buy trade. It doesn't feel good to buy the highs, but that's intermediate highs. But you look at the context of this chart for the last, 7 or 8 years, this is a good trade. We've got open space. It's one of my favorite things. Okay. And the flip side of that is if we go a little bit lower, how much lower? Well, I think if we turn the corner in 2020 and we turn again in 2022 and we could bounce again here in 2024, I mean, 5,600 is a logical support level. If we see it, I think that looks great. So there's two spots. We either break above 63, okay, or we revisit 56. I like the buy out there or the buy with breakouts. I'm looking for bottoms here at 56. But to me, the upside is all the way back up towards 75. That's a lot of profit potential there, and that's a huge profit potential there. That's a good setup. Okay, dollar CAD already took profit. I was long on dollar CAD. We hit these recent highs around 38. I took the profit around 38.15 from a buyer. I think it was like 3,600, 35.95. So I took profit on this one. This is another one I'm watching closely. If we have resistance, it's not drawing that very well. Okay, we have resistance in here. If we break down and we range, dollar CAD could come back into 132 or so. The reason I'm not shorting the dollar CAD yet is because I don't have confirmation. I don't have any topping patterns. And just in case, I'm watching oil pretty carefully, but if we break above these levels, this has been a multi-year range, by the way. If we break above 140, we might actually have a breakout to 145. And that's not necessarily oil or dollar. That might be just a better currency over a weaker currency. Like the CAD and the BOC cutting rates, maybe the BOC is a little bit more dovish versus the Fed. I'm not sure. But to me, this is either we set up a top and we drop all the way to 132, or this thing breaks off the top and we go squeeze up here towards these highs like we did here. We had some ranging, right? And when this thing broke, it didn't look back. So I'm watching, right? I'm watching. And then I see the same person typing in many questions. Will gold go up? What about dollar Swiss? Just give me 5 minutes and I'll get there, right? Am I long dollar Swiss? Yes. I'm long dollar Swiss. Why am I long dollar Swiss? Because we're sitting here at 30-year lows. I think this is a pretty good looking head and shoulders trade. I like this to the upside. I'm waiting for this to form a bottom. So whether this is going to be a right shoulder or this is going to be a range all the way back to the lows that we can trade a range, or this is a reversal pattern, that when this thing finally forms the bottom here, we start measuring a move up to symmetry, get 5 waves, got a pocket, have resistance, and this is also 10 to 20-year resistance around 1.00. So am I long dollar Swiss? Yes. Where's my target? 96 to 98 or 1.00. Lots of upside potential, looking for some open space. Okay. And then gold. Okay. Gold is up. What more do you want? Look, gold is a good long-term play, period. If the dollar gets weaker, gold's going to be up. If the market's uncertain, gold's going to be up. If the central banks are cutting rates, gold's going to be up. All these things fundamentally fuel strong gold. Okay. Resilient gold, strong gold. I mean, look, we're talking about gold right now at 24.23. Is it all-time highs? No. Can it pull back to 2,300 again? Sure. Can it pull back to this trend line? Sure. But to me, unless this trend line is going to break, I don't care what gold does in here. This is hanging on. This is resiliency. And what I'd like to see is obviously higher highs and higher highs and higher highs. That's what I want to see, right? But it doesn't happen instantly, right? If you're a trader, there's no such thing as instant gratification. I'm sorry. That tends to run its course. You can get lucky, but if you want to stay in this, you want to stay in trading for a long time, instant gratification it's not a thing. Okay. Go do something else. Go buy candy at the grocery store if you want instant gratification. Trading is, you got to wait. I just did a fishing trip this last weekend. You got to cast a reel out there. You got to do your thing. Let the process take care of the process, or the process take care of the profits. This is not instant gratification. This is not about getting excited. This is about taking good quality setups with good risk management and letting it fall into place. A lot of the stuff that happens in the market is self-fulfilling. It really is. Patterns are great, right? If you're a pattern trader, it works all the time. You can trade 1-minute patterns. You can trade daily and weekly patterns. It's price action. That's the best thing you should learn in trading, is learn price action, learn supply and demand, learn these like manipulation, accumulation levels, it's all important. Okay. Is it flawless? Is it perfect every single time? No, but your risk management is what you can control, and just keep taking good quality trades. But instant gratification is not a thing. So when I get in this chat and I see what's gold doing, it's like, it's going to do what it's going to do. And what I think in the medium to long term is gold looks postured pretty solid for more bullishness. So do I like gold? Yes. Am I all in on gold? No. It is a 3 to 5% allocation for medium longer term. And I think gold is a great play. I think gold to me is, I measured when we started to get this breakout early in the year, it hit my target at 22.60. I was out with all my call options right away. I had like a 400% gain. But now that we're at this next level, it's like I measure this 5-way move to 25.25. Another leg higher in trendline support. Where are we going? 3,000? Then what? Do I sell it? Probably not. I just want to see if it gets there. So the next stage for me is if it goes higher, okay, let's see if it accumulates and then goes again, right? And then again, and then again. And if it goes ridiculous, then I'm probably going to be more protective. The more inefficient it runs, the more I'm going to be protecting those gains, because it's probably going to pull back. But if we start to see like slow and steady where it's up here, pull back, up here, pull back, up here, pull back, that's actually the type of trend you want, because that's a healthy trend that doesn't get out of sorts, right? When it goes straight up, that's when it comes straight down. That's where traders, if you're not protecting profit, you give back a ton of gains when this thing ultimately corrects. If you don't believe me, look at copper, look at cocoa this year, look at lumber the last couple of years, look at anything in the commodity space. All these ridiculous runs we've seen, they all come crashing back. Okay, and I mean, look, Nvidia, after a split, Nvidia even had a reality check, right? This is a reality check. This is a reality check. It's volatile, but a healthy bull market's a healthy bull market. We want to see some pullbacks. Okay, look at cocoa. Cocoa futures. Okay, before we had a pullback, if everyone's long cocoa, you're like, oh my gosh, I can't do anything wrong. This thing was up like 1,000%. Okay, that's crazy. For a futures market that's leveraged, that is a crazy amount. But what did it do? It goes from this low to this high, rips, finds equilibrium, pulls back to 50, 55%, and now it's choppy. Now what do you do on cocoa? I don't know. I missed it. But it's just a wild move. These markets have a way of finding some type of balance. This is also why we had a correction in the SPY. We had, all these crazy overbought conditions that technically was due, and we finally had a correction, right? It was due. All right. We good on that. Okay. So dollars weak, why are you buying the dollar Swiss? For positive swap and a pattern. Okay. So, and like I said dollar is not weak. I said dollar, I'd like it to be weak because I have better setups. If the dollar index breaks below 103.90, I think the dollar index is great for a short trade. But I like Aussie dollar long better. I like a New Zealand dollar better, and possibly the dollar CAD if it sets up a good structure. But I don't love dollar Swiss short at all, because for the last 2 years, I've been hanging on to positive swap, making hundreds of dollars a week just hanging on to this thing, and I'm not upside down. My trade when I started the dollar Swiss was here. I bought this low, okay, and I bought this low, and I bought this trend line break, and I rode this gain up. I'm just getting a little bit of a pullback. If this is going to go higher, my dollar Swiss position is fine, right? If it comes all the way back to the lows again, I'll still buy it and I'll trade the range. Not that worried about it, And just because dollar weak doesn't mean that it's weak across the board. Like Swiss could also be weak because the Swiss National Bank cuts rates, just along with the ECB and along with the BOE. All these central banks would be cutting rates, except for the BOJ, which is what we're seeing unfold right now. Okay. Professional Trader FX says, how do you balance fundamentals, price action, wave theory? I don't know. 20 years experience. I'll give you the shortcut. Price action is the most important thing. If you're trading a market like Forex, technicals, Forex trading is technical. That's it. You follow price action, that's your best thing. When it comes to stocks and options, comes to indexes, you're going to have to incorporate the fundamentals and sentiment, right? Are we in a bull market with like unwavering sentiment? This year seems to be that type of year. 2022 was the opposite. 2022 was nothing could go right, nothing was good. Bonds were down, stocks were down, nowhere to hide. If it wasn't for currencies, 2022 would have been a rough year. But fortunately, currencies were good to me. So the balance is, if you're a technical trader, trade Forex. If you're a technical trader, futures with a little bit of a bullish tilt, that helps. If you're a stock trader, options trader, nice thing about options is it's leverage with defined risk a lot of the times, but fundamentally it's like it's the sentiment. If the market is optimistic, it tends to go higher. We have like this baked in bias for a 70 plus year modern day, S&P. 54% of the time the market's up. That's already a nice little edge to take, in addition to if you've got a bull market or bull sentiment. I mean, you can throw that up to, I don't know, probably 60+%. Do you realize for the last like 5 years that the S&P all by itself has annualized like 16% a year? That's insane. The average is like 8%. It has doubled its gains the last 5 years. And you talk about 5 years, that also incorporated a crash during 2020 and a crash in 2022 with a correction. It's still annualized 16% a year. That's how bullish this market's been. You know? All right. Thoughts on oil? Yeah, sure. Oil. So I am long on crude oil futures with a credit spread. Here's one position here. So crude oil futures, I have a 72.50 by 72. I collected, it's a 0.08 credit, which should be around a couple $100. And I'm just going to let this one go to expiration. It's the middle of the month. So August 15th is my expiration. Now, there is a line in the sand. There's still some risk on the trade. To me, oil is, it's interesting. We have oil is a lot of supply and demand. It really is. There's a lot of manipulation. OPEC can always cut and try to raise prices. The U.S. is producing natural gas and oil at record levels. There's always this battle of supply and demand. So, I mean, price-wise, and I've said this for the last couple of years, once we had our COVID crash where, the futures market went to negative oil prices, which is insane. And then we came back to 130, 140 with Ukraine-Russia conflict that's still going, by the way. Here we are kind of stabilizing, there's support, there's resistance, and even for the last several months, there's no real direction. So are we just seeing more indecision? All right, Igor, you can be my portfolio manager then if you're better than me, dude. Just go ahead and you can take all my clients. Does that work for you? Or maybe you know something I don't. You on speed dial with the Swiss National Bank? All right. I think oil is indecisive for right now. Now, again, if oil were to come back down here on weakening demand, then I think this is still a good spot to be buying. Well, look, I'm not turning this into a debate. I mean, you said they will not be happy. It's like, well, I mean, I talk to my clients pretty often. I think we're doing just fine. So, all right, oil. My line in the sand is 72.50. So if we see, and this is what I thought, we're not coming down to support. I originally, when this actually ripped back up to the upside, I'm like, okay, maybe oil comes back into around 77 or so, stabilizes in here. I think oil is just due for some indecision, right? So I see resistance at 90, 92. I see support here around 65 to 67. Oil is really just kind of a stuck asset right now. And, another thing that is going to matter is ultimately supply and demand. If the U.S. is producing record high oil levels, but OPEC is wanting to cut, that kind of neutralizes everything. Obviously, what is one thing that's sticky for us with this inflation discussion is if gas prices are higher, oil prices are higher. That tends to be the energy, right? I mean, we talk about core CPI that excludes food and energy, but it absolutely affects spending power and the things that you see every single day, which is the annoyance of like, oh my gosh, gas prices are higher. If energy prices are higher, it feels like inflation is still lingering, So if oil prices are lower, all of a sudden, like, hey, it's not $3.50 a gallon in the US, it's maybe $3.25, maybe it's $3. Where I'm going sometimes in the evenings, there's two completely different prices right now. One place is $3.50, one place is $3.20. How do they do that? Well, clearly there's margin somewhere because one has been just a normal gas station that's always pretty busy, and one's a brand new grocery store that just opened up and they're doing a grand opening and they're chopping 20-30 cents off the gas prices just to let people in. So I'm like, are they losing money on their gas prices, or is that their margin? I don't know. Okay. All right. So that's my thoughts. I mean, I just think oil's indecisive. Gold I like up. Silver's come back in a pretty nice way. I would like to see silver. I mean, if anyone and I see this a lot in the chat here for A1 trading, if anyone is long gold, I would like to see you also have the same type of enthusiasm for silver. I personally think silver is a better trade than gold. It's way cheaper. I think there's more upside. There's more measured moves to it. But I get that silver's more a utility. It's not necessarily seen as like the big value play. It's not this, it's never been looked at as like, oh, it's a hedge against inflation. And it's not that. Gold's always been like the gold standard, but silver technically is a great asset in my opinion. We broke these recent highs. Having this rip from like $22 to $32. I'm looking for, again, I said this last week when we broke this level. Could silver settle back into like $26? Maybe. And if it does that, okay, fine. I'm still looking to buy silver. How am I exposed on it? I have SI, which is a futures trade for silver, and I have SLV, which is similar to trading GLD for gold. It's me owning shares. I own shares of SLV. My break even is around $24 and change. I put in a covered call at 35 because that's my measured move. So if I take a $24 ownership and I turn it into $35, I make $11 a share. I think a lot of my clients are in for anywhere between like 500 and 1,000 shares. Some are less, some are like 300, some are 600. But I'll ballpark it. I'll say about 500 shares. So if I'm up $11 a share, like that's a pretty good chunk of profit on silver for a measured move. Okay. So I like silver a lot. And I think technically silver is an easier measured move than gold is right now. Why is that? Because gold's at all-time highs. We just hit all-time highs. If we hit fresh all-time highs, that's fine. But it's harder to measure all-time highs. Because once we're there, it's like you just kind of hope it keeps going. But silver has not hit all-time highs. And this is the same thing I had this conversation around the Russell this year. Look, silver back in 1980 had a high at like $48. Back in 2011 had a high around $48, right? Almost $50. To me, I look at this as, look, gold can run, and gold can run a long ways into these all-time highs. But the reality is silver has all-time highs around 48 to $50. Right now at $28, it's easier for me to measure. If we go up to these highs again, that's a 69% return in silver. Okay. If gold goes up another 69%, that's awesome, but you're in uncharted territory. It's just harder to calculate, right? Gold can go to infinity, but it's harder to measure when it's not on your chart. One of my favorite things about looking back 20, 30, 40 years of trading is looking left on a chart. That's also what makes stocks tricky, is when stocks are blowing out these all-time highs, it's like, where does it stop? Don't try to call a top on a stock that's blowing off these highs. Momentum begets momentum, right? And it just keeps going. So I just think silver is in the space where if gold's going up, silver hopefully performs well. To me, it's just an easier measured move. So that's why I like silver. And it's cheaper. I mean, I could buy shares of SLV for $20 and I can buy GLD for $200. Big difference. If I want to control 100 shares and trade options around it, I'd rather trade silver, So anyway, just my thoughts. I just think it's important that if you're in, gold, I think you got to give silver a fair shake as well. Let's talk crypto for a second, and then I've got just a few more minutes. If I'm getting pulled off at 11, that's totally fine. I did want to do a spot check on my earnings or my options plays and earnings plays that I had this week. So Bitcoin, pretty stalling at 66. Ethereum hanging in there at 33. Nothing too exciting. Let's just do a quick rundown. So PayPal, we had earnings on PayPal. It's up to 66. I have some naked puts on this one. This is a stock that might be sneaky. I don't know if we had earnings on PayPal. Yeah, we did have earnings. Duh, I'm looking at it. So it was before market on Tuesday. Must have been something right. But PayPal, to me, if we break above this level, let me see what that price is. I think it's around $70. $71 is my chart alarm. If PayPal is up around $71, to me, this has room, especially in a falling wedge pattern. This has room to get back up to this high, which is around $100. So I might find ways to participate in PayPal, but it has tested $70 before and it has failed. So I don't want to just force the trade now because it might not go anywhere. But if we break above 71 and there's momentum there, I think this 71 to 100 is a pretty good looking play. So I'm probably going to participate there. I might do some long calls. I might do some debit spreads, but probably position this for maybe 6 to 12 months out and just let it gain over time. And not be forced to be like right in 30 days or 60 days. It's like go out, 6 months or 12 months and try to make it cost effective. So I like PayPal. That was just an earnings play this week. SoFi, everyone's favorite student loan lender that has a beautiful stadium in Los Angeles. But the stock itself as a SPAC play is garbage. I'm in SoFi. I have 600 shares of SoFi. My break even's around $10. I'm just going to wait. We come back to these levels here. There's good structure on 1350. Longer term, I mean, who knows? Maybe this thing gets back in the 20s. I do think this is another one that's going to benefit maybe from rate cuts, but maybe not, because what's in their best interest is they service at higher rates and they make more money. The problem is they're probably, if you service at higher rates, your levels of defaults and delinquencies probably go up quite a bit. So whatever. I just hope they stay in business. SPACs are always interesting because they were easy money in 2020, 2021, and they've turned into just a crapshoot after that. So now it's more IPOs, which have been on hold. Nobody's doing public now. It's very rare that you get IPOs. Everything's like, is this the right environment? Is this right to go public? So very, very skeptical. And most companies now, it's like, they'll just go private. They'll just stay private. So anyway, all right, that's SoFi. Pfizer. I like the setup on Pfizer. I've been long on Pfizer. Trying to get my chart. There we go. So Pfizer's up to $31. I do have some exposure. I own some shares. My break even on Pfizer is around $27. I also have some call options. 27. I think it's a 25 by 32. Trying to make $7 on that contract. I also have some shares of Pfizer. Have some credit spreads in. So it's looking better. We are crazy oversold. Pfizer's made an interesting pivot from COVID vaccines to weight loss. So they're trying to get into the Ozempic bandwagon in a way, doing some weight loss drugs, more cancer screening. So hopefully a little bit more beneficial as far as the bottom line goes, and maybe they can start enjoying some of that run like Eli Lilly has. First Solar, this is an interesting one. We've had a decent pullback on this. I still like First Solar for a alternative energy play, but also for U.S. U.S. companies and U.S. business. Starbucks. Stabilizing, but man, like Starbucks and Nike are right on the cusp. I don't know. I think, are people happy with Starbucks? I don't personally like Starbucks. I'd rather support something more local. We got some places out here where I'm at in Utah. There's a place called Bjorn's, which I love. There's a place called Beans and Brew, which is awesome. So I like the local places. There's a couple local places, Passion Flower, El Borca or something. Just a bunch of random coffee shops, but they're not Starbucks. That's my point. So if Starbucks came down to COVID levels, I'd buy Starbucks at $50. If Nike comes down to, we're at 74. If Nike comes down to 60, I'll buy some Nike. Nike, if we have some tariffs going on between U.S. China, Nike's going to struggle. All right, let's move to some of the big guns. I know it's 11:02. Just give me a couple more minutes, and who's ever coming on next, I'll heed the control to you. Just give me 2 more minutes. Microsoft at 417. I do have a play actually, I did get filled in Microsoft this week, but Microsoft is down. Sank on stock, but save the market. Okay, that's what the news says. I did see that this is down. So from the close yesterday at 422, we were down as low as 411. But okay, and Frank had mentioned this to me offline. He had said that he saw a negative print that was revised positive. So right here, like earnings were a beat and revenue was a beat, but man, fractional, right? There's no real big upside here. Like, yes, it did kind of stabilize and save, but Microsoft is still down a little bit. Now look at this on the chart. Technically speaking, we're sitting here in a pretty good trend line on Microsoft, where if this level holds, this could be a good thing for the overall market to still gain for the remainder of the year. I mean, I still think that first half of the year strong, at least over 10%. Second half of the year, momentum continues. We still, kind of resiliently hang on and possibly go bullish. And then AMD was the last one. AMD has jumped and kind of faded back a little bit. The semiconductor space is a little noisy. SMH is up on the day. Nvidia has a big rip from the. We tested $102 yesterday, $103 yesterday. It's up $9 or $10 from yesterday's close. So that's a big rip on Nvidia, which at $2.82 trillion is going to move the market. That's probably a big reason that the market gapped the way that it did. Q's up, SPY's up. And then today after market, we have Meta and Qualcomm. Meta, a $1.2 trillion company at 473 price right now. Does it gap higher or lower? We'll find out. And then Qualcomm is trading at 175. This is in the semiconductor space as well. We'll find out. But most importantly, what's going to happen to the DXY? There's going to be more today, this afternoon. If you want to come back and join us here, A1 Trading, we're going to do another session for FOMC. So I'll let you go. Thanks for letting me go a few minutes longer, and have a good rest of the morning. Or we're still going?
Wait a second. What is that out in the water? Is that a shark?
Yeah, thankfully he only took half off my surfboard.
The markets can be a very scary place. Don't go wading into treacherous waters without your edge finder, which gives you market data like the commitment of traders data, retail sentiment, our top setups algorithm, which generates ideas each day for you, and so on and so forth. If you don't already have a copy of the edge finder, we're currently doing our summer sale, and it is our biggest discount of the entire year, no questions asked. If you're waiting for a better discount, you won't get it. Currently, the edge finder is half off, and for stream viewers who are watching right now, we're going to be dropping a link in the chat as I speak, and that link will take you to a direct message center where you can speak to a rep on our team. That rep can get you 55% off so that you're no longer swimming out with the sharks. Get inshore and trade with the edge finder. Check it out, and thank you guys for watching. Back to the show.
Afternoon, traders, or good morning, good evening, wherever you're from, guys. Trader Tom here from Simply Forex, and I'm with you for the next 20 minutes or so. So this is your opportunity, guys, to ask me as many questions as you like about trading, right? I'm a technical trader. I've been doing it for over 15 years now. So please ask as many questions as you like, and I will try and answer as many as I can. I'm also going to show you a few things that I'm looking at in the markets. The big one today was the BOJ interest rate decision. That was better than expected. That was unexpected. The BOJ never moved their interest rate. So we'll look at the impact that's had on the markets. I'll show you a trade that I took earlier and the reasons for that, okay? And like I say, guys, we'll answer as many of your questions as we can. So don't be shy. Come say hello. Leave me a question, and we'll all be happy. All right. So let's just look at the any yen pair, right? I mean, this is the day chart. Yen pairs were just crashing, right? They had a big sell-off anyway, right? And they come to this really interesting level of support. But BOJ raised interest rates. Yen pairs are still steaming down. This hasn't represented any trade for me as yet because things are just so oversold, right? That is so oversold. If I bought up the RSI indicator, that would be well below the 30 level, right? Which suggests oversold. But you don't need an indicator to tell you that. Just use your eyes, right? That is super oversold. And that goes for any yen pair. Euro yen, super oversold. There's no value in selling this, none, right? Any of them, Aussie dollar yen. So that's the yen pairs. And just in general, guys, things are super overbought or oversold, right? If I close my eyes and just scroll up and down and pick any pair, right? This is US dollar, Canadian dollar, right? We're getting a bit of a reaction at this resistance level, and it will be interesting to see what the Fed does later and if this reaction continues. But up here, before the day started, super overbought, right? Look at any pair, right? Let's look at a euro pair, euro Canadian dollar, right? Super overbought. Okay, up here is just super overbought. Now, this can represent some opportunities for us, right? Because when things are so overbought, there will eventually be a retrace, right? There will. So a trade I took earlier was pound New Zealand dollar. And again, if we look at the day chart and stay with the day chart, right? Look at that trend. Yeah, super overbought up here. Again, that will be above the 70 RSI. Yeah, and just crazy overbought. All right. Now, I generally trade with daily direction. That's pretty much 95% of my trades. They are with daily direction. So why did I take this trade? So first of all, it was crazy overbought. Right, I've shown you this on a few pairs. The markets are crazy at the moment. Yeah, super overbought, super oversold. But at this overbought level, we've got a nice big bearish candle, right? On this trend up, we do not see a candle like that, right? The trend really starts once we get a break of this level, okay? And then, you know, that's not bearish enough to start taking some counter trend trades. It's not until we get all the way up to here that we can take a counter trend trade, because we have a bearish enough candlestick, right? And then we drop down to the lower time frames, right? Well, let's understand the target. So that blue line was my target, guys, right? And it's literally hit it intraday. I'm an intraday trader, right? And I give you all of my trade signals and all of my trade ideas on my channel, guys, Simply Forex. So please check it out. So we've hit target with this trade, but if we drop down to the H4, I want to show you something else pretty significant as well. So if I go back in time to where today started, right? All right, so we started here. On that uptrend, okay, that big daily uptrend, look at the moving average 20. So this is the only indicator I use. I will take a look at fib levels, but generally speaking, moving average 20 is the only indicator I use. And not once does price break below the moving average 20. Okay, not until today, right? Or yesterday, like late last night, right? It broke down. And that is quite significant. And then if you have that movement below the moving average 20, plus we had a structure break, right? Look at H4. This was the first structure break we've had on H4, right? You can clearly see this level through here was important. When it breaks and retests, this is a really nice entry for selling, right? As it happens, I wasn't awake when this candle happened. So all I said to myself, guys, is once we get a retrace back in here somewhere, right? I just want a little retrace. I can put my stop above this level and above the moving average 20, put my stop loss up here, right? And then I just want to take price back down to these lows, okay? And then take some profit and leave some profit to run. And that's exactly what happened, guys, right? We got that little bit of a retrace that we were after, okay? And then price has moved down and hit target. Yeah, so entered here, stop up here, took price eventually all the way down to this 1,600 psychological level. And you know you have a good target when you start seeing a reaction like that, right? Buyers could potentially enter here. And that's all I'm doing, guys, right? I'm basically trading, you know, from one support and resistance level to the next, right? If price breaks this level in a very overbought market, there's a chance, if it breaks, right, we're going to have some movement to the downside, all right? And then all I'm looking for is if we scroll left, okay, keep scrolling left, you can see there was this level over here, okay? And that is potentially the first piece of support we see. So therefore, that is my target. So all I've done is trade from this gray zone down to this gray zone and put our stop, you know, above structure, above the last high, and above the moving average 20. And it's as simple as that, guys. It's just price action, right? That's all I use, all right? So just simple price action to look at trades, right? And enter trades. And it was the same with Euro New Zealand dollar. Identical trade, right? I was looking at both of these pairs. This has come down and pretty much hit target as well. Super overbought, right? Up here. We got a nice big bearish candle. We dropped down to the H4, right? All quite logical stuff. Yeah, it's not rocket science. What I show you is there's no secret sauce. It's just reading charts, but I've been doing it for many, many years, right? We get a break of trend here, right? This is H4 structure. We get a break, we get a retest. There's a nice entry, right? And price has come down ever since. Generally speaking, above the moving average 20, I'm looking for buys, right? And below the moving average 20, I'm looking for sell. So it ticked all the boxes for an entry. All right, guys, and please, please ask as many questions as you like about any trade that you would like to look at. What else am I looking at today? Well, it's all a bit, you know, news dependent, guys. What the Fed are going to say later on, and the interest rate decision. I mean, the S&P, the indices. Let's take a look at the S&P. Where are you? There you are, right? This was at, so this level through here on the H4 is a bit of a key level for me, right? So this is the H4 chart on the S&P 500, right? But let's start with the daily chart, right? Because on the S&P, again, we were just clearly in a downtrend, right? And the idea was just to potentially carry this trend on a little bit further, right? But it's broken this high. It'll be interesting to see if this high stays broken. And like I said, this is a pivotal level. If this stays broken and we get a daily candle that looks like this after the FOMC and everything that's said there, if this stays bullish, I think the indices are coming back up to these highs, right? Because we've had a daily structure break here if that happens, and that's a big deal, okay? If, however, we end up with a candle, right, looks something like this, okay, we get a big wick rejection, something like this, and it closes back into these lows, right, then I think we have room to the downside, right, with the indices. So it's a big day today to see what's going to happen there. Right, let's take a look at a couple of questions. So I can see Slugmeister is looking at New Zealand US dollar. Daily breakout will pay great analysis, Chris. Okay, so let's have a look at New Zealand dollar US dollar for Slugmeister. I like your name. Okay, so I was looking for buys with New Zealand US dollar today. So why was I looking for buys? Again, right, we was in a daily downtrend, right? At this level, we are super oversold, right? You can see that. You don't need any indicator to tell you that. We're at a key support level, right? Plus, if we zoom in, we've had a really nice bullish candle, okay? And then all I'm looking for, guys, just as an extra piece of confluence and to cement my trade idea, I'm looking for a break of structure, right? So I then go down to the lower time frames, such as the H4, and you can see that price kept bouncing off this level, right? This level became quite important. And then we broke this level, right? You can clearly see we've broken this level, all right? I would like a nice retrace into this level. Moving average 20 catches up. And then I think this is a great opportunity to buy New Zealand dollar, US dollar. All right. So this is a potential trade, but again, it depends on what the FOMC have to say later on today. So yeah, New Zealand US dollar is a buy opportunity for me. If we look at the weekly chart, you can see that level through here, guys, right? You can see this level through here, and you can see the bullish reaction we're getting. We have some room to the upside before potentially we come back down. What else are we looking at, guys? Any other questions? If you've got any other questions, guys, please don't be shy. Please ask, and we can take a look. So royally bad. Okay, I guess it's better than being royally good. US dollar, Swiss franc. Yeah, Frank has a great scream, Hollywood-esque. Yes, I love the promotional vids. They're quite hilarious. Right, US dollar, Swiss franc. So what we're going to do here, guys, we're going to do a top-down approach, right? And this is what I suggest all of you traders do, right? You're even if you're fundamental or you're technical or you're a mixture of both, right? You must take into account multiple time frames, right? Because each time frame is going to give you a little bit more data, right? And basically, my idea of a trader is you crunch the data from the chart and make informed decisions, right? It's as simple as that. Yeah. So let's do exactly that. So I normally start with the weekly chart, guys, right? And you can see that this is clearly in a downtrend, right? It's in a downtrend, but these lows are holding, right? There is support here, okay? Now, my inclination is to still sell this because it's in a downtrend, but now is probably not the right time because we're at support. And look at last week's wick. That closed back in to this support zone, right? So I want to sell it, but we're at support. Okay, so let's get some more information. That's what the weekly's showing me. Now, if we look at the day chart, right, we're kind of back at these lows, right? Now, if we look at the day chart, right, we clearly had a break of these lows, right? You can see this candlestick here, the body of the candle, that's the important part, the body, not the wick. The body of the candle broke these lows, right? So that for me is a continuation of trend. We're getting lower lows, right? And we've come back up and we're looking, you know, we're still in a downtrend. So if you think about that, guys, we've got weekly in a downtrend and daily in a downtrend, right? So we want to sell US dollar Swiss franc. Okay, so weekly and daily give me my direction. But then you've got to ask yourself, do I want to sell where price is? And the answer is no, right? The market has shown you that there are buyers here. That's not me making it up, right? That's not me saying I think there's buyers there. The market has shown you that buyers are in here and they pushed it up, you know, almost 100 pips, right? So for me to trade US dollar Swiss franc, I need to see a break of this low. Okay. Now, if the daily chart finishes like this, right? Let's imagine FOMC, Fed interest rate decision, etc. has come out, and the candle finishes like this, right? I am not interested in this trade, right? It will not be a trade for me the next day, right? Because I'm an intraday trader, right? Because it's this level of support has held, okay? No trade. Now, if we get a big bearish red candle that looks like this, just hypothetically, right? I'll fill it in. Excuse my candlestick. That's the worst candlestick I've ever drawn. All right. But if we get a big bearish candle that breaks these lows, then yes, I want to sell US dollar Swiss franc. Okay. And then all I'm doing is once I've got my direction with weekly and daily is drop into the H4 to find areas where I can sell. Okay. And, you know, there's a couple of areas through here. Yeah. So we could sell here if price retraces to this level here, which has proven to be good support and resistance. We'll have the moving average 20 coming round. I think this could be a potentially good area for sales, right? So this would be the area that interests me. But right now, you can see this low is holding, and we're getting quite a bullish reaction. So, yeah, not a trade for me right now, but potentially tomorrow it could be. Right, what else are we looking at? Right, let's take a look at gold. Ely Nicholas. I've got a mate back in London called Ely. We always say get freely with the Ely. Right, gold. You don't need to know that. Gold. Before I look at gold, guys, yeah, if you're enjoying my analysis and you would like to receive my trade ideas every day, then please come join my channel, Simply Forex, right? You can see the name of the channel here, Simply Forex. And I can see the guys are putting a few links in the live chat. So come join us. Don't be scared. Again, let's do a top-down approach with gold. Now, at this moment, right, first and foremost, identify the market you are in. And you are in an uptrend stroke range. And this is where we are. So you can see the uptrend clearly, but now we're ranging between here and here. Okay, so bearing that in mind, we could sell from the top of the range down. A higher probability would be to buy from the bottom of the range up. Okay, but again, that's what the weekly is telling me. Let's get more information from the day chart. Now, the daily chart, right, is in a downtrend. Okay, again, identify structure. And structure is just higher highs, higher lows, lower highs. But you need to be, the trend needs to be clear to you. If it's not clear, don't trade it. Simple as that, right? So we were in this uptrend. Okay, and then price broke down. So at this point, we're in a lower highs, lower lows, right? We're clearly in a downtrend, which makes this last high in here pivotal for gold. Okay, now we can even put a bit of just a zone in here just to clarify that, right? Now it's already a very important weekly zone in here, right? Price has shown us that, and we're in a downtrend. Now it depends on the reaction at this level, right? Gold is at a key, crucial level. I couldn't use enough important words. Key, crucial, important, pivotal level, right? Because if it breaks this level, we have had a daily break of structure. We're in an uptrend, and that would suggest we have room to the upside, right? Whereas, so if that happens, I think we have room to the upside. Again, FOMC, Fed interest rate decision later on, will be crucial for this, right? Whereas if we get a nice big, let's say we get a candle that looks like, my God, my candles, when I draw them, are getting worse. Been drinking, guys, I apologize. I haven't really. Okay, but if you get a big bearish wick like this at these last highs, off the back of the FOMC, right, then I think, yeah, we've got a good potential trade to the downside, right? At least back to these lows, if not back to the bottom of that weekly range that I showed you. Okay, so yeah, it's all about this level for gold. All right, so let's see what happens. Breakthrough, bullish candle, take it higher. There's your target. Big bearish candle, take it lower. There's your target, right? So that's what I'm seeing with gold, guys. Right, what else are we? Royal, bad, thanks fam, you're more than welcome. Okay, Brent, so we want to look at oil. All right, let's have a look at oil now, guys, as well. I'm not sure how much time I've got. I'm sure somebody might come in and just kick me off in a minute. But let's have a look at oil. So same, right? Brent, WTI, right? They move pretty much the same, right? So let's have a look at the weekly chart, right? Now, again, know what structure, what market you're in. Okay, weekly chart, right? We was in this uptrend, then downtrend, back into an uptrend, right? Okay, so we have got higher highs, right? And these lows are holding. So we're in a weekly uptrend. And obviously this is a weekly candle and this hasn't finished forming yet, but we had very good crude oil inventories earlier. Let me just show you that quickly, right? Where are we? Yes, we had good crude oil inventories earlier, okay? Now, if the weekly candle finished like this, and it's a big if, yeah, we still got two and a half days of trading, right? But I would be inclined to look for buys, right? Because I'm just following weekly structure. Yeah, prices come back down to the last lows. We get a bullish reaction. I would be inclined. This is, you know, a higher time frame view. This is the weekly chart. That's what I would be inclined to do. But again, let's get more data, more information. Okay, I can see Cicchello is a regular on my show. Right, so there's this level through here, guys. Yeah, you can see it was a weekly. This was that big weekly wick here, right? And you can see price has reacted here historically. And you can see we are getting a big push off this level, right? But we're in a downtrend, right? So we're getting real conflicting information with oil, right? We've got a weekly uptrend, okay? We've got a daily downtrend. Weekly is at a support level. So just all of this is a little bit contradictory for me, right? I'm not interested in oil at the moment for that reason. So what would I need to see happen before I start looking to potentially buy, right? So I'm not willing to sell this because we're at weekly resistance, right? I don't want to sell into weekly resistance. So I would be interested in buying from this level, but I would like to see a change in the daily structure. So let's say something like this happens. Let's say it comes back down to these lows and then eventually we get a break, right? I just want to see a break in structure. I want to see higher highs, higher lows, and then moving average 20 coming round, right? And then I'd be interested. I'll be all over buying oil back up to there. All right. Now, obviously, that could take days, if not weeks, right? But so be it, right? If I don't see a setup, I won't trade the market. I have to see something like this for me to consider buying oil. All right. So that's what I would need to see, guys. But this is this 76 level is quite a key level for buyers, right? So we shall see. Right, guys, I'm going to take. Oh no. Okay.
Yep.
Guys,
hey,
all right.
Tom.
Well, thank you very much. All right. Cheers, guys. Thanks for having me.
Tom, I wanted to say really quick, it's great having you back on. Guys, if you aren't familiar, Tom is someone who used to stream with us a little bit more regularly, but every once in a while he pops back in for a special guest appearance, and we love having Tom on the show. So, Tom, thank you for helping out today and coming back on the show. We just dropped his YouTube in the chat, so go subscribe to Simply Forex if you enjoyed what you saw here today. Go support Tom, and Tom, maybe we'll see you back sometime soon.
Yeah, definitely, James. I'll see you again soon, mate.
All right, we're going to take a really quick break, guys, and then we're going to be right back with Diego. So don't go anywhere. We are going to be back right after this. Our summer software sale is happening right now, which means you can get the Edge Finder for 50% off. COT data, top setups, pages of fundamental and technical data, and so much more. Our software is constantly scanning for new data and information and is updated regularly. The Edge Finder is a one-time purchase, which means you can get it half off right now and never have to pay for any updates made to the Edge Finder software. This limited time offer won't be around for very long, so don't wait and get this incredible trading software for half off before it's too late. Check out the link being dropped in the chat now to talk to one of our team members about our huge 50% off summer software sale.
This is me. Let me share my screen. Thank you, Tom. Thank you, Tom. And good day to the chat. Good day, Nick. Good day, James. Thank you for having me once again. And I hope that you all are well, and I hope that you all are keeping safe, right? To everyone, can you hear me clearly? Can you hear me clearly? Let me know. Can you guys hear me clearly? I think sound is good over here. Cool. Thank you. So, fam, listen, I'm only trading the Nasdaq and the DXY, right? So what I'm gonna find myself doing is simply just breaking down the two pairs between each other, right? I found myself rewatching the content which we made yesterday, right? And I basically boxed out some BOBs, right? Some order blocks whatsoever, and I saw that I didn't really find myself giving you guys like an explanation of how I'm basically using it. So if you guys are seeing it in your charts whatsoever, right, I want you guys to at least have some sort of an idea of where I'm coming from when I'm looking at an order block or looking at a BOB, right? So first of all, we're going to start off with the DXY, right? And with the DXY, we basically said that if we can see the DXY have a closure below these lows, right? Well, these highs right over there, right? This area of resistance, we can see that we did find ourselves eventually had that actual shift back down, and these lows were the target, and we can see that we did have a beautiful pushback towards the downside on this beautiful pair called the DXY, right? And ultimately we can see that we have found ourselves taking out liquidity at these lows right over here as well, right? So looking at a higher time frame perspective, we can clearly see that we are finding ourselves being quite bearish in market structure, right? With us basically creating that actual low right there, with us creating that beautiful lower low right there as well, right? So with us basically being bearish in structure on the DXY, I simply would like to see a further continuation move back towards the downside, right? Maybe from this area whatsoever, maybe a shift and then have a further continuation move back down, right? And how I'm basically looking at the DXY and the Nasdaq is simply, you know what, they are inverse correlated with one another. So with overall volume being towards the downside on the DXY, you know what, I am expecting the Nasdaq to at least then have some sort of an actual shift back towards the upside, right? Because ultimately price needs to find itself creating an actual, you know what, we already do have that high, so we need to find ourselves creating that potential, you know what, lower high, so that we can basically continue in that actual you know what, bearish market, right? So going to the Nasdaq, right, heading all over to the Nasdaq. Now on the Nasdaq, I also found myself boxing out this beautiful BOB right over here, right? So for those who found themselves watching the actual the breakdown which I found myself making on Sunday, right, we basically pointed this area out as a point of interest to have some sort of an actual shift back towards the upside, right? Now when it comes down to a BOB, or how I'm basically finding myself looking at it, right, I simply want to see inside this area that we have at least a pattern like this, right, or a pattern like this inside, right? Because who of you are simply finding yourself trading break and retests, right? Because ultimately this over here is a break and a retest, right? Now in this example over here, it would basically be to find ourselves looking for some beautiful buying opportunities, right? So this example over here will be for some shorts, right, for some selling opportunities, and this one over here will basically be for some buying opportunities, right? So if we want to find ourselves looking for some buys, we at least want to see something like this happening within this actual BOB on a lower time frame, right? So if I can maybe just find myself doing the following and just go to a daily time frame, right, we can clearly see that, well, maybe let me do this for you guys, right? Before we're gonna go there, and then I'm going to do the actual breakdown for you as well. Let's do the following, right? Let's see if we can have like a nice little example, maybe right over here. This one looks nice, right? So what I'm gonna find myself doing for you is just simply show you like what I mean, right? I'm gonna give you like just like 1 or 2 examples, and then we're gonna get back to the breakdown on the Nasdaq, right? So clearly we can see that price did find itself creating that BOB right over here, right? And we want to find ourselves moving with market structure, because ultimately how I'm looking at it is that this is changing market structure from a bull market to a bear market, from a bear to a bull market as well, right? So all I'm going to simply find myself doing is head over to the lower time frame and see if there's any magnets whatsoever in price, right? So 5 minute, nothing. Let me go to the 1 minute time frame and just zoom price out a little bit. Right, so right over here, we can't see that we do have the bearish pattern, right? The bearish pattern will basically be something like that, which will be a point of interest to where we want to see price have some sort of a shift back to the downside, right? Because ultimately, we just want to see something like that. Okay, but what we can basically see is that price did find itself creating some beautiful lower lows and lower highs, right? Some beautiful, beautiful lower lows and lower highs. Now, these up close candles over here, they are also serving as an actual order block, right? And if we see a fair value gap within an actual order block, right, that is a significant area as well. And as we can look at what price basically found itself creating right over here, right, with this move to the downside, we can't see any fair value gaps basically lining up within that area right over there, right? But if we're going to find ourselves looking at this area right over here, this beautiful correction impulse, right? Within that area, what can we see? We did find ourselves creating that fair value gap right over there. Price basically came back into it, and we had a further continuation move back towards the downside, right? Over here as well, right? We had the impulse, correction, impulse, and within that actual area right over there, we also find ourselves creating an actual, you know what, a fair value gap, right? So that right there is basically serving as a point of interest to where price can potentially have some sort of an actual shift back towards the downside, right? So that is a point of interest, right? A point of interest. And here we can simply see that price then found itself having a tap within that area, and then we had the shift back towards the downside. Now, after that, right, we basically want to see a change in market structure, right? So we want to see proper corrections and proper, ultimately proper corrections that is basically being taken out, right? So this over here would be the correction. That will be the impulse. That will be the correction. That will be the impulse, right? And we basically want to see a change in market structure. Now, with this basically being the correction, right, if we can find ourselves having a closure below the body of this last down close candle, as we had right over there, you know what, I'm considering that as basically being a change in market structure, right? And there we can simply see that we retested the area, right? Maybe we can just do this for you. This will basically be serving as the breaker, right? So there we basically had the closure below. We came back for the retest, and there you could have find yourself taking advantage of price. Why I'm showing you guys this is that, you know what, you need to see it in hindsight first, go back test it, see a couple of trades, right? And then you can find yourself forward testing it. But ultimately what I'm trying to do is just show you guys like where I'm coming from with the Nasdaq, right? Or where the Nasdaq is currently. Look at this one as well, right? And then after this one, I'm gonna find myself heading to the Nasdaq. All right, look at this one as well. So once again, right, that right there, the BOB. Okay, and all I'm going to find myself doing is scale down to a lower time frame, right? And since we had the closure above and we never came back for the retest, right, I'm expecting the retest for a further potential continuation move back towards the upside, basically as we did right over there, right? Now, if I want to look for some beautiful bullish momentum, I want to simply see a nice little shift in market structure as well, right? Basically us creating that high, higher high, wait for the retest for a potential shift back towards the upside, right? Now, if we are basically going to dive into what PA is showing us right over here as well, right? Check this out as well. Check this out as well. So right there, we can see that we had a beautiful tap, right? But let's dive into what price is basically creating right over here. Okay, so right over here, just like I made mention, right? If we want to see some bullish momentum, that is ultimately what I'm waiting for. And then a retest for further continuation shift back up, right? And right over here, we can basically see that price did find itself forming something like that, right? Check this out. Up, there we went down, there we had a beautiful shift back towards the upside, right? So that low has been violated right over there, and the high has been violated right over there as well, right? So we can basically see that the pattern did find itself forming, or the pattern is inside the BOB itself, right? But the moment price basically find itself having a closure above the body of this candle, we already find ourselves coming back for the retest for that shift back towards the upside, right? So that area won't be considered as being quite significant, right? Even if you're going to find yourself looking at what we find ourselves creating over here as well, right? We find ourselves having a swing low. That swing low has also been violated right over there. We had a swing high, which was violated. We also had a closure above that candle right over there as well. We did find ourselves having that pullback, and there we can see that we had a further continuation move back up, right? So this simply means that this area is also not as significant, right? So what are you going to do now? Now, all you're going to find yourself looking at is for other type of magnets within this area, right? And right over here, we can basically see that we do have an inversion fair value gap right over here, right? Inversion fair value gap is literally, you know what happened with previous price right over there, right? So if I'm basically going to box out that area like that, right? And just simply extend it. Right? Here we can simply see that price did find itself coming back into the area. Well, did we come back there? We didn't tap into there, right? But clearly we did find ourselves tapping into that area right over there as well, right? Now, obviously, if you would want to find yourself going long right over there, it would be a high risk trade, right? It will be a high risk trade. You want to find yourself waiting for that change in market structure once again, right? So there we can simply see that price did find itself having the tap within the area, and there we had a shift to the upside. Where would I then find myself entering price? Way right over here, right? So once again, same principle. There we had a swing low. That swing low was violated, right? There we had a swing high. That swing high has been violated, right? That body was basically being taken out right over there, right? So how you would have found, or where you would have found yourself entering PA will basically be these up close candles, which we have found ourselves forming right over there, will be serving as your breaker, right? So with it tap into your actual breaker, this is where you will find yourself looking on taking price long, right? And right there, you guys can see that with us basically having the tap within the area, we did find ourselves in having that shift towards the upside, right? We can see that we had that shift towards the upside. Are you still with me? Are you still with me? Am I going too fast? Let me know. Now, let's scale to the weekly time frame at where we are currently with PA, right? Let me know. Am I moving too fast, or you still with me? So on the weekly time frame, right, once again, same thing. We can basically see that we did find ourselves creating the BOB right over there, right over there. So simply, you know what, we do want to see price basically have the impulse, correction, impulse, right? But just like I made mention, right, a BOB is basically changing market structure from bullish to bearish, from bearish to bullish, right? And over here, we basically did find ourselves creating one over here as well, right? A BOB, which we find ourselves pushing through, right? We basically violated that area. But with us basically violating that area right over there, we can simply see that we did find ourselves creating a beautiful swing low right over there as well. So you can box out that swing low just like that, right? We also had a swing high right over there, which has been violated as well, right? So clearly over here, this will basically be the bearish pattern. Check this out. If I can maybe just use it like that, and that, right? And maybe just hide the charts so that you guys can see the pattern, right? So over here, you guys can simply see that we did have that change in market structure, right? So what I'm simply expecting is some sort of initial pullback and then have that shift back towards the downside. And a potential area will basically be back into a premium area, which will basically be this region right over there. All right, so if I can get my charts back up, just like that, that it will basically be back into this area right over here, right? We do have a fair value gap lining up right over there as well, right? So we're going to box that out as a point of interest, right? As a point of interest to where the Nasdaq can potentially find itself heading back into, right? Because I am from the Western Cape, my brother, because I am from the Western Cape. Clean stuff, right? So now we already have an actual point of interest, like above price, to where the Nasdaq can potentially find itself heading back into, right? But now we do have a BOB over here as well, right? So literally the exact same thing, which I found myself pointing out earlier on the lower time frame, is literally the exact same thing which we're going to use on a higher time frame, right? So over here, let's look at price. Right, let's identify what's happening over here with price. Right now, we can simply see that we did find ourselves having a beautiful swing low over here as well, which was violated right over there. Nice little swing low, which was violated. If you want to look at that swing low, that's violated. That we also did find ourselves having a beautiful swing high right over there as well, which was violated, right? I ultimately want to look at the up close candles with this actual trend right over there, right? So the moment price basically found itself having a closure above the body of this candle right over there, our breaker was basically activated, right? So these up close candles right over there was serving as the breaker. So right there, we found ourselves coming back into the breaker, and right there, we found ourselves having a shift back towards the outside, right? So that point of interest was tested, right? That point of interest was tested. A next point of interest was basically this fair value gap, well, inversion fair value gap, which price have found itself creating right over there, right? So can you guys see? Once we find ourselves having that closure above the inversion fair value gap, we never came back for the retest. Keep in mind that this is lining up within a BOB, right? So if you see these type of patterns finding itself lining up within a BOB, these are basically points of interest to where you can be like, okay, if price is going to tap into this area, we can potentially have some sort of a shift from this area whatsoever, right? And there we can see that, you know what, over I think it was like last week, that we tapped into the area, the point of interest, and there we had a beautiful shift back towards the upside, right? There we had a beautiful shift back towards the upside. Now, over the course of this week, with us basically having a tap from this area onwards, we have faked out from this previous area of support, now basically turned into, we remained as an area of support, right? So I was expecting a push and then a shift back up. However, I also did find myself boxing out, you know what, this inversion fair value gap, which we have found ourselves creating right over here as well, right? And as you guys can see over the course of yesterday, right, what did we find ourselves do, right? So over the course of yesterday, we have found ourselves coming all the way back down, back into this point of interest right over there, right? I have found myself going long from here, but then, you know what, we also did find ourselves getting stopped out of break even right over there, right? So I basically went long right over there, right? And then on the lower time frame, we just simply had like a deeper pushback down right over there. So I was taken out right there, right? And then just after that, we had the shift. That's a nah. That's a nah. But anyhow, we basically find ourselves tapping within the inversion fair value gap, right? And there we had a reaction, and there we had a push towards the upside, right? Now, what can we basically see is finding itself happening on the Nasdaq at this current moment, right? So if we can basically find ourselves having a beautiful bullish closure on this beautiful pair over the course of the day, right, I will then expect price to have some sort of a pushback towards the downside for a potential further continuation move back up, right? So scaling to my H4 time frame, the only thing we need to find ourselves waiting for is basically a change in market structure, right? And can we see price had a change in market structure? Yes, we can, right? Yes, we can. Over the course of yesterday, what I wanted to see price do was simply take out these equal highs right over there. I think price was like fluctuating right over here. I wanted to see price have that shift back up, right? Take out those highs, then have a shift back down for a potential move back up, right? But unfortunately, we didn't find ourselves doing that. We did, however, find ourselves taking out our liquidity, our sell side liquidity, which is coming through right over there, and did find ourselves tapping within the point of interest, right? And we had that beautiful shift back towards the upside. So clearly what we can see at this current point on the Nasdaq is that we are what in market structure. Would you guys say that we are bullish in market structure? Would you guys say that we are bearish in market structure? What do you think we are? Are we bullish or are we bearish on this beautiful pair called the Nasdaq? Are we bull? Are we bear? Right? So I'm gonna mark off this area right over here as my relatively equal highs. Right now, I basically have a simple outlook when it comes down to equal lows and equal highs. Right? In Nasdaq longs, beautiful. Right? We are bullish in market structure as well. Right now, I have the simple principle when it comes down to equal lows and equal highs, right? We do have liquidity resting above and below these areas, right? So after taking out some equal lows or equal highs, I'm expecting price to have some sort of a reaction in the opposite direction, right? So that simply means the pullback. You know what? Ultimately, it's just a pullback, because now what we can see price did was we basically had this high, lower high, and now we find ourselves creating that higher high right over there as well, right? So we are bullish in market structure when it comes down to this beautiful pair called the Nasdaq, right? This beautiful pair called the Nasdaq. And since we are finding ourselves taking out these beautiful highs, right, we can't just of yet get out that Fibonacci. We can't get out that Fibonacci just of yet, right? So the moment we can see that we are having some sort of initial pullback, right, some sort of a rejection, guys, keep in mind that we can just simply find ourselves having a further continuation move back towards the upside, and then from this area onwards only have that potential shift back down, right? You also need to keep that in mind. But ultimately what I'm trying to say is that if we can see that push back towards the downside, a point of interest will simply be back into an actual discounted area, right? Because this is simply where price is finding itself being quite cheap, right? Because ultimately how I'm looking at it is that we are having that higher high. We need some sort of initial pullback for a potential shift back towards the upside, right? Now, points of interest which I am currently having on the Nasdaq will basically be these up close candles right over here, which we have found ourselves creating right there. Did we come back in this inversion? Yes, we did. We already tested it, right? So it will basically be looking for some sort of a rejection from this area onwards. But if we can see that further continuation dip back down, that right there will actually be super nice, right? Because if we can look below price right over here, we also did find ourselves creating another actual breaker, right? And this is in a nice deep discounted area, right? You can just mark it off as an area of demand, right? In a nice deep little discounted area, right? So if we can see that push back towards the downside inside this area, you know what, I won't be surprised about that. But ultimately I would like to see some beautiful long still finding itself opening up over the course of today, right? So first point of interest, will look for a rejection from this area onwards. Second of all will be this area, a rejection from from that region right over there. All right, you guys with me? You have a clear understanding. Okay, which brokerage am I using? I'm using XM as a brokerage. I think I'm turning bullish. Depends on FOMC today. Yeah, you know, I am also bullish. I am still bullish on the Nasdaq, since we did find ourselves having a change in market structure, especially that it was on our 4-hourly time frame, right? 4-hourly time frame is my higher time frame, right? So since we did change market structure to bullish, I still expect some beautiful longs, right? Another confluence to why we can potentially see price have that push to the upside is simply because we did find ourselves creating this gap right over here as well, right? And price never found itself closing up the gap. So what does that mean right there? We eventually need to find ourselves closing up the gap, right? We need to find ourselves closing up the gap. So bullish for sure. Bullish for sure. What is your view on NZD CAD or NZD USD? Well, at this current moment, it is 6. Right, Tom? James, do I still have time? But ultimately, on the Nasdaq, this is basically what I am seeing. Maybe I can just find myself in NZD. What was that? NZD CAD. NZD CAD. NZD USD. NZD USD. Let's look at higher time frame. On currencies, I always just look at higher time frame. I just look at higher time frame on currency markets. Well, I don't actually look at currency markets like in general, but yeah. Just give me a second. Let me just have a look at what's happening, what I'm seeing. I don't actually like the current PA, right? I don't like what price is presenting at this current moment, right? Over here, this is not clear PA to me, right? So this market won't be it. That one won't be it. NZD USD. These ones, they don't look nice. They don't look nice. These ones, let's see over here. Definitely some more downside. It looks like we can find ourselves having some more downside on this pair, right? Because simply we did find ourselves creating some equal lows, right? Just like I mentioned, quite simple. When I see equal lows, equal highs, you know what I'm viewing as we have liquidity below or above these areas, right? So right over here we have some equal lows, right over there. Right over here we also do have some equal highs. That's kind of strange, right? But ultimately over here, a visit back into this region right over here, a premium area, right? A visit back into a premium area. This is basically where I would then simply find myself wanting to look for some beautiful some shorts, right? Going hand in hand with that right there, we also have a BOB over there. So that can be a point of interest to where you can potentially wanting to find yourself looking for some longs, right? So maybe like a pullback and then some beautiful, beautiful longs from there. I got yesterday is a new year close. Nice. Just before the close. Nice, beautiful. GBP USD. Let's see. GBP USD. I think I have that one on my green list. Do I? I do. Right. So GBP USD. Right. Currently we can basically see that we are also stuck within this BOB. We had a tap, and now currently we are tapping back into this area, right? But since we are bullish in market structure, like overall bullish in market structure, right over there, as we can see, right? Correction, impulse, right? I'm basically looking at this right here as being the correction for a potential impulsive move back towards the upside, right? For a potential shift back towards the upside. And yeah, grabbing the FIB from that low to that high, can we see that we are tapping within an actual discounted area? We are kind of finding ourselves tapping within that area right over there. And we can see that we are having some sort of a, a back and forth, a back and forth with price right over here as well. Right. So I will then find myself in a situation like this. I would simply wanting to find myself, look at this as well, waiting for a proper change in market structure, right? If we can have that, a proper market structure bullish, right? Maybe like something like that. Then I will simply find myself looking for some beautiful long opportunities, right? Or if we can see some shorts, I will simply just be looking for some longs. But currently on the this is the H2 time frame. My bad. I thought it's the H4. On the back and forth, not the best, right? Not the best. So rather monitor price on a lower time frame, H2 time frame, right? And wait for a proper change in market structure if you would want to find yourself looking for some beautiful longs on the GBP USD.
Hey, Diego.
Good day,
I'm hopping
James.
in here real quick to thank you for coming on the show today. Appreciate you helping out with the long stream. But we have our next guest ready and waiting, so we're going to transition on over to James. He was on the show a little bit earlier. He's coming back for round 2. We appreciate him helping out as well. So Diego, again, thanks for coming on the show. I'm sure we'll see you back next week at some point. And guys, like I just said, we're going to be right back with James. But before we do that, we're going to take a really quick break and then get right back into the analysis. We have FOMC. Don't forget, FOMC is coming up pretty soon. Nick and Chris Pulver will be back to talk FOMC and react to that live. But until then, we have James coming up next. So we're going to be right back after this.
Thank you, James, and thank you to the chat.
If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hello again. It's good to see you guys. Feels like it's been a long time. I'm joking. I was here like an hour or two ago. So nothing's changed other than my euro pound position. Last time I was here, well, I'll say it like it's been a while. Earlier, it was heading pretty quickly to stops. However, it was hanging around a little bit around this 0.5 area, which is a 50% pullback. So in this case, it acts as quite a nice resistance level. And we've seen a really nice reaction from here. And now the trade's back to entry. So nothing crazy. However, it's better to be at entry than in drawdown. Nasdaq is running smoothly. Not much news there. I actually saw on Twitter when I was waiting to come on that Nancy Pelosi bought, I think it was $100,000 worth of shares in Nvidia on the 26th of July. Now, of course, it is Twitter, so that might not be true. So take that with a pinch of salt. However, if it is true, it's not surprising considering, Nvidia's up 11% today. So, when Nancy Pelosi buys, it's always a bit of a green flag in the markets, because she seems to be a bit of a wizard at time in the market, should we say. So that's interesting. So it's a good sign in general. I mean, obviously, it doesn't necessarily mean that we're going to see the markets rocket, but yeah, definitely good to see. So could be good for Nasdaq to continue to the upside. Obviously, not just because Nancy Pelosi bought, I should say, but Nasdaq's looking quite healthy so far. We've seen this 50% pullback. It got tapped into twice, seeing quite a nice rejection off here. And we seem to be currently just hovering around this 50 moving average. So it'll be interesting to see if this week we can break above and hold above. So gold, yeah, we can look at gold. So again, when I was here earlier, I was in gold shorts. I closed out of one position. I'm still in the other one, waiting for FOMC and interest rates. So we'll see how that goes. But at the moment, there's not really much going on with gold. Technically, it does look good to short. We've got this double top formed right here, and this lines up quite nicely with the fib golden zone throughout the middle here. Is called the golden zone. So looks nice, but again, it's a little bit of a gamble considering we do have quite high impact news coming out very soon. So I wouldn't be taking any trades on gold right now. But yeah, we'll see what FOMC brings really. Technically, like I said, looks good to short. But yeah, feel free to ask any questions in the chat. I ran through essentially everything that I was looking at earlier. So I guess I can take another look to see if there's any new people in here that may not be aware. So I was discussing on Monday about looking for a long position on the New Zealand dollar, or New Zealand dollar against the US dollar. And the reason was basically just looking for a correction. So we can see, this is my trading history for this month. So you can see down a little bit of money, but that's fine. So we can see the New Zealand dollar here. While the New Zealand economy is facing a double dip recession and softening labor market, the mood in natural weather conditions from El Nino is positive for the New Zealand dollar. Although China's weak growth weighs on the New Zealand's exports, the overall outlook could support a moderate recovery. So that's essentially what drove my idea to go long, although I didn't take the position. However, the fact that it worked out is good enough, so that's fine. But overall, to be honest, I would still like to see a short position. So I'm waiting for this 50% pullback to get hit, and we'll see how the market reacts around this level, because it's not really the best. Let's just see. There's not much structure really to back up this level to sell from, other than a few lows down here, but it's not the strongest. We do have the 200 moving average that could come into play if price does keep rising up. We do have the RSI that's also overbought, so we'll see. Technically, it lines up so far. So yeah, we'll see. Sell gold. If I lose for margin. It's not really the way to think about it, but who am I to tell you how to trade? NQ. Well, Nasdaq is doing well, but we are, still in earnings season. So we've got I think it's Nvidia earnings on, is it the 15th or the 16th of August? And that will be kind of the big news for Nasdaq. So We'll have to see when it gets a bit closer to the time. But for now, I'm in this buy position, sort of just letting it play out. So the stop on this is huge. I took this on the daily time frame with very low risk, so it's roughly 0.2% risk. So it's basically just a starter position, because I was saying I would like to see how Nvidia earnings come, because I would actually like to see a little bit of a deeper pullback, and that's mainly just according to the weekly time frame here. I just think we need to get a little bit closer to this 200 moving average before I'd be comfortable to say that we can go to new all-time highs. I just think we need to see a bit of a mean reversion, but yeah, we'll see. Just because I'm expecting that doesn't mean I won't go into some shorter term positions with low risk. Why are you shorting euro pound? There was good numbers on the euro. Doesn't matter. So let me show you again my thesis here. Euro pound. So for anyone that wasn't watching earlier, this is my econ board. So this is where I every week I update it with my forecasts and ideas and things based on bank reports, articles, and things such as that. So we can see the UK economy could benefit from political stability if a majority Labour government is established, pursuing a policy of gradual reapproachment with the EU. Additionally, the beginning of the Bank of England easing cycle and the ongoing recovery for real incomes could support domestic investment spending, boosting the GBP against the euro. Now, keep in mind, this is a 6 to 12 month forecast. So maybe early, maybe I'll get stopped out. But, if the thesis is there, the entry presented itself, I'm happy to take it. So that's the reason behind that trade. What do you think about gold? Alaya, we've already covered gold. I mean, there's not really too much to say about it, but essentially, technically, looks great to go for sells. In my opinion, we've formed a lower high. Looks like now we're creating a double top, and this lines up with the fib level. But it's just, we've got US news coming, so this setup's pretty meaningless at the moment because obviously news can come and it can go either way. So we'll see about that. Thanks for insight. What do you think about intraday? Let's see. So to be honest, this actually lines up with my short intraday strategy. So just to give you a quick rundown, the way I approach swing trading and day trading is very similar, but there are some differences. So the reason I've got the two fast moving averages on the daily, so I can get the immediate trend. I don't want the 200 moving average, because the trend that the 200 tells me is too large of a sample size to then apply to day trading. So I use these two faster moving averages to gain the immediate trend of the market. So the daily is bearish. The H4 is also bearish because the 200 is above the 50. The hourly is the same. The hourly is bearish. We have price at the 200 moving average here. We've got an RSI oversold. So based on my technical approach, it would be a short from here. So I would be looking, technically a short. However, there is this market gap. I think the previous guest spoke about this as well. That just concerns me a little bit, but and again, this doesn't take into factor what's actually moving Nasdaq. But yeah, just on a technical basis, that's how I view it. Silver looks good for sells. I'm already in silver sells, so I can show you those. I got in a little early. So you can see here, I've got one entry down here, and I scaled in when we got up to this this fib level. But yeah, looking basically just to hold these ones out. Pound dollar. So I've spoken a lot about my short idea on the pound dollar, so I won't go into that now. I'll move on to just the short-term outlook. But I could see a stronger pound dollar coming. I think with the Fed cuts coming towards the end of the year, and as I said earlier, with the euro pound position, we could see sort of sustained strength with the pound. I don't see that as out of the question. We are also, in a bullish trend overall. Let's see something. So yeah, we're bouncing off this 50% pullback as well, which is quite a good sign, along with this 200 moving average. So to be honest, it actually looks quite nice to go long for me. And we are on this level of resistance. This looks like quite a clean break and a retest pattern. And I trade break and retests all the time. It's like my bread and butter, really. So I'm not looking to trade this just because I'm looking to get out of all my positions as soon as possible, just to sort of rebalance and reset. But I wouldn't be too mad about taking this position here. Maybe not right now. Obviously, like I said, we've got US news coming, so I'm not saying to go and take this trade right now. I'm just saying in general, at the moment, it looks quite nice to go higher. You're looking at continuation buys, but it's always good to pick someone's brains. How do you think Trump, if he wins, could affect the US markets? Nick talked about it briefly with lower taxes. Yeah, so the Nasdaq short position I showed you obviously was just a very quick look. That normally I would do a lot more research into things before taking a trade, but I think overall Nasdaq to the upside makes a lot more sense than going to the downside. And for the Trump situation, I agree with Nick. I think you've got to think about Trump as a person and what his expertise are, and where his priorities are and what he's actually good at. And his core thing is business. So when you take into account Trump and business as president, what does that lead to? It leads to the stock market. So I think Trump being president would be pretty positive for things like Nasdaq and the S&P. Obviously, there are further details such as lower taxes and things, but overall, yeah, I think so. Although I'm not sure really how the presidential race is looking at the minute. I know when it was Trump and Biden, it looked quite heavily in Trump's favor, especially after the ear situation. But yeah, I've not really checked how the standings are recently. According to you, where is gold going today? If I could give you an answer to that, I'd be a very, very rich man. I would like to see gold go down, and that's because I'm in some short positions, so it makes sense. However, I don't know. It depends. We could get a surprise news with interest rates, and that could shock the market, and we could see gold go higher or lower. It really can't tell you where it's going. However, what I can do is tell you what I think might happen. I think if we don't get a cut, which is what's expected, it's pretty expected that nothing's really going to happen today. So if we don't get a cut, then it's not going to be a shock. No one, it's not like, oh no, what's happened? It's just, that is what it is. So I don't really see the market moving too much, but it's always good to be prepared. It's better to be over prepared than under. So to be honest, I don't really see gold doing too much. And maybe I'm being naive. I don't know, but as far as I see it, I don't really see how things would really change too much. Obviously, that also is dependent on FOMC. I completely forgot to mention FOMC actually, but yeah, FOMC could give the market some insights into what's happening in the near future, which obviously then could in turn change the course of the dollar. But yeah, we will see. I'm not in the job of trying to predict the news. You're in gold buys, good stuff. USD CAD. We looked at USD CAD earlier, and I was saying it's just not a market that interests me at all. Just look at this. It's really, really ugly. I mean, we get a trend very rarely. So you get something like this move here back in sort of September of 22 or 2022, but it's not. It's just a horrible market, really, in my opinion. But As for now, I don't really trade this. You know, it's not something I would really look at on a daily basis. However, I'm pretty neutral on the CAD. The dollar, I am bullish on. So I could see this market heading to the upside, but I would need to see a pullback to this 50% level. And that's where I would get in. Then we could see the RSI become oversold. We could meet the 200 moving average. And that would be quite nice, really, technically. But yeah, not something I would really look to trade. Is the gold market being affected by the current situation with Hamas being killed? I've not seen a good entry point. Yeah. So the move we saw on gold last night for me, this initial sort of bullish move was driven by an escalation in tensions in the Middle East, which is a bit frustrating because you obviously can't see these things coming. So if you're in a trade and that happens, then there's nothing you can do about it, that's what happened to me. But that's fine. That's not an issue. But yeah, it's definitely a factor. The world is kind of on edge at the minute. We've got, the elections coming. We've also, got tensions in the Middle East. So it's not the easiest thing to try and short. However, I think gold could be choppy in sort of the next couple of weeks until we start approaching the election. So if we look, last time we reached all-time highs, we had this drop, a little bit of a bullish push, and then a continuation of this chop. The same thing happened back in April. We had the all-time highs, drop, and then chop. So, just following that sort of idea, we could see another drop and chop, as you could say. CAD CHF. I'm fairly sure the Swiss is very bearish at the minute. Let's see. So, as I said, I'm quite neutral on the CAD. Actually, I don't really have much of an opinion there. I'm not really looking to place any trades on it. And the Swiss is bearish. So, keeping that in mind, it would make sense to go in for shorts if you were looking to take trades. So I think this would be sort of the most ideal place in my book. So we allow price to come back 50%, retest this level, these sort of highs, this range we had at the 0.64 level, meet the 200 moving average, let the RSI become overbought, ideally, and then enter in some sells. And this short position will be primarily driven by Swiss weakness compared to anything to do with the CAD. Sorry, I'm talking rubbish. If the Swiss is weak, sorry, I'm completely mixed up here. If the Swiss is weak, you'd actually want to go for buys. But technically, I think sells are in play. But yeah, I'm just not really looking at this market, really. So USD CAD Swiss, they're kind of just not great markets, really. If you look at this one as well, quite sideways ranging, although you could catch some nice trades. It looks a lot better than dollar CAD, but still not great, really. And that's kind of a similar situation with a lot of the G10 markets, actually. If you look at anything such as US dollar against, pound dollar against US dollar, and then compare it to something like the US dollar against the Turkish lira, there's quite a significant difference in terms of what type of trends you can catch. So what can we do here? Let me show you the example of this, actually. So let's go to pound. Actually, let's do euro dollar. Euro dollar is a very common asset to trade in the retail world. So this is the weekly time frame. Then let's put USD TRY, which is the Turkish lira. And this one should also be the weekly. Now look at this. This is why, if you ever speak to any professional trader, and when I say professional, I mean on a trading floor or an analyst, someone in a sort of institution or whatever, more than likely they will be a lot more interested in the exotic markets rather than the G10 markets. And the reason is because you can catch trades like this. Now, of course, this has been trending to the upside for a long time. So it's not really a case of you just buy and wait. It's more, you can wait for sort of consolidations like this and obviously keep up with the news between the dollar and the lira and find entries and then sort of just ride the wave to the upside. It's also a lot more difficult for retail traders to actually trade in the exotics market. Some brokers, or the majority of brokers, don't really allow it or don't host those types of markets. What fib levels do I use? John, I use the 50 and the 0.618 here. Let me pull them over here. So these are the settings if you want to copy them. So we've got the 618 and the 0.5. This is my entry zone. So I wait for, hold on. So if we're doing a downtrend, I'll wait for price to come back up to this 50 or the 618 level. It depends really. Not too strict on that. As long as it's this zone, it's fine. Then I'll use the negative 618 level as a longer term target. So I'll normally have two sort of areas in mind. So I'll have normally sort of the zeros, which is normally the previous low or previous high. And then if I am still in favor of the trade by the time we get to the here, then I'll hold the trade until the negative 618 level is hit. And that's kind of just the general way I use it. Now I need to sort my charts out again. Daily, weekly. This needs to be the H4. This is hourly. Cool. US 30. Sure, we can take a look at that. So I'm really sad I missed this one. I was looking to enter on here. I actually did enter, but my entry was way too early. I think I entered somewhere around this area here, or even maybe up here. I can't remember. But yeah, I got stopped out right before we had this move to the upside. And if I just waited, I probably would still be in this trade running quite nicely. But hey ho, I think US 30 has a lot more room to the upside. I don't really see any reason that we would start seeing bearish US 30. But at the moment, it's kind of in a no-go zone. Like really, you can't really enter where it is at the moment. So I'd be looking for some sort of pullback. And where that will happen, I don't know. We might need to reach this previous high first. Then we could see some sort of pullback and then a continuation to the upside. That would be kind of my idea. And if we don't get that, then I'm not really interested. So possibly even back to this fib level. Stops there and then a target potentially up here. So that's kind of what I'd be looking for. But yeah, we'll see. Obviously, that's quite a large movement in price to try and predict. So we'll need to see how it reacts at this level. It could be a case where we just break through and then use this as a retest and then continue a continuation. And in this case, like I said earlier, I really like break and retest. So I would enter on this retest. Something like this. More, yeah. There's always people live on this channel. The A1 team and Nick have set it up really well. So they have lots of different guests on and things, which obviously provides a vast amount of content for the viewers, which I think is great. If there was a channel like this when I was learning to trade, I think it would have made the process so much easier. So yeah, credit to them. Is there anything else? Actually, let me just check time here. I think my time is up. James, feel free to pull me out. I don't want to leave too early. Don't want to obviously extend on too long either. But I think I might be 2 minutes over time or 3 minutes now. But yeah, there's nothing else in my book really to show you. If anyone's been keeping up with my crypto trade, I'm still in the dumps, still down significantly. So yeah, I mean, this is a meme coin. This wasn't like a real trade or investment or anything. This was more, I did in a couple of hundred at each level and just let it go with hopes that something would happen. But it is what it is. Only invest what you can afford to lose. The yen seems to be giving up some room. Thank God. Finally, I might actually be able to get out of my yen positions. We did obviously have really good news for the yen, which gave the yen some strength. However, the dollar and the Australian dollar seem to be gaining some strength as well, which is helping the Australian dollar start to gain a little bit of footing. However, will this be sustained, or will it just be another situation like we had here, where we have a little bit of a relaxation in price and then another dump? I do see that quite likely, to be honest. I don't really see the Japanese yen losing strength now. I think it will eventually, just not yet. As far as I'm aware, there's a lot of institutions and large players that are actually closing out of their carry trades. Do you guys know what carry trades are? I'd be interested to know that. Because carry trading is actually a very, very interesting thing. And it can make you a bucket of money if you can do it properly. And the yen pairs are actually the perfect example. And you can do it on other things. And obviously, it kind of broker dependent. It shouldn't be broker dependent, really. But it can be in certain situations. But I can explain it briefly. Again, I don't know if I'm running over time. So again, A1 team, feel free to pull me out if I am going over time.
Hey, James.
Hey, James.
Thanks for helping out twice today. We got a little
no
double dose of James today. I hope you guys appreciate all the content that James brought to the table today. We linked his website, Elite Traders, in the chat right here. Oh, sorry, Chandler, I clicked on it too. We linked his website right there. Go check it out. He's got lots of useful stuff there, as well as his Discord. So, James, thanks for coming on the show. We are not done yet because we are streaming all the way up until FOMC. We've got Nick Phillips waiting very patiently in the back right there. So we're going to take one more quick break, and then we're going to be back with Nick Phillips. James, thanks one more time for coming on the show today.
No problem. Thank you for having me. Have a great day, everyone. I'll talk to you later.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
Hello. Welcome everybody to the A1 Trading Show. Hopefully you guys can hear me. If not, go ahead and let me know in the chat. Pretty sure everything is good on my end. Let me press one more button to go live for my Instagram audience. Cool. All right. So happy FOMC. Looking forward to this trading opportunity today. Going into this, I think it's important to get a little bit of context for what happened at the last FOMC meeting and where we're at currently positioning wise for the doxy. So before we touch on last monetary policy, let's go look at the dollar real quick. So we'll scale out here on a 4-hour time frame, and we can see that for most of this month, we're to the downside on the dollar. We are, I believe, we're trading lower than we were at the last FOMC meeting. The last FOMC meeting taking place on June 12th, right in here. And so we are currently trading below those levels, kind of near where we were the morning of the 12th. And then quite a ways away from where we ended up trading into after the FOMC meeting. So downside on dollar currently. Let's look at what they said at the last meeting and highlight some of these important parts here. So recent indicators suggest that economic activity has continued to expand. So we have a bit of a hawkish statement right out of the jump. The economy is expanding. Expansion versus contraction, right? Those are the two functions of the economy. And so the Fed is always looking to contract an over expanding economy and expand an over contractionary economy. And so right now we have some expansion. This is actually, I'm sorry, not right now, as of June 12th. Job gains have remained strong and the unemployment rate has remained low. So the labor market is tight. We have a lot of people getting new jobs and not a lot of people claiming that they're out of work. Cool deal. Inflation has eased over the past year, but remains elevated. So inflation in the last 12 months has come down, but it is still higher than we would like. In recent months, there has been modest further progress towards the committee's 2% inflation objective. Inflation is on the way down modestly. Let's see. The economic outlook is uncertain, and the committee remains highly attentive to inflation risk. This is data dependency. Let's see, considering any adjustments. Okay, this is some forward guidance. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. Okay, so that's the bulk of some of the most important stuff out of the last statement. And the reason why it's so important to get this last statement read through and understood for ourselves is so that we can see what the previous stance was, compare it to what the markets are pricing in currently. And we know that the markets are pricing in 3 rate cuts this year. The Fed's dot plot in June only showed enough room for 1, but the markets have begun pricing in 3. So with that in mind, we have this downside move in dollar, this significant downside move in dollar really since June, and a Fed that was previously data dependent. Inflation is doing good, but we need more confidence. Labor market is still really strong, so we're not worried about that. If we get a lot of the same verbiage out of the Fed today with their statement, I believe we're going to see a hawkish reaction out of the dollar because the dollar is so pre-positioned towards a dovish narrative. The markets are already pricing in 3 rate cuts. If the question today for the Feds is September going to be the first rate cut? Are we getting a rate cut in September? If we don't get a rate cut in September, then the market's pricing in of 3 cuts is out the window. It's so the expectation where the markets are currently sitting, this baked in expectation into the current price, it's going to have to get recalibrated to the new information. The new information being we may not get a cut in September. If that happens, if the Feds come out and they do not change any of their verbiage in the statement, if the statement is almost word for word the exact same copy as it was in June, then we're going to see, I think we're going to see a very, we're going to see upside in dollar. We're going to see upside in dollar. We're going to see downside in equities and gold, potentially. Now, to get further downside in dollar, I think we're going to need to see the statement say something like the Feds expect that it's soon going to be appropriate to reduce the target range, right? So let's write out some of these sentences for you guys. Pull in here. In case you guys want to screenshot this, feel free. So in order to get a dovish reaction, which is going to look like US dollar downside, equities, which is things like Nasdaq, S&P, equity upside, we'll go equities and gold upside. In order to get this kind of reaction today, out of the statement, the monetary policy statement that gets released at 2, We want to see verbiage like expects it'll soon be appropriate to reduce target range. We also want to see on inflation that inflation is showing consistent progress towards 2% target. Jobs have remained strong, but there are signs of weakness starting to show. Okay, should economic trends persist? Let's see, let's do, should current economic trends persist? Should current economic trends persist? How would they say this? So should current economic trends persist, that would lead to adjustments in the policy rate. So these ideas, these statements would be a shift from the previous monetary policy statement farther away from that data dependency, further away from that we're not quite confident enough, further away from that the job market is super tight, all of those lines of dialogue. Inflation is good, but we're still not confident. If that changes to inflation's showing consistent progress, cool. We, without the tag on inflation showing consistent progress, but we're not confident enough. Without that, if they say inflation is showing consistent progress towards 2%, period, cool. They're not adding in that they're not confident in its progress. If they say things like they expect it'll soon be appropriate to reduce target range, cool. That's confirmation of what the market is expecting, which may not be the best tradable opportunity, to be honest, but I think we would see dollar downside in this kind of a scenario. Should current economic trends persist, that would lead to adjustments in policy rate. So there, if they say that inflation is showing consistent progress, jobs are strong but starting to weaken, and then they follow that up with, if these trends in the economy persist, that would lead us to adjust policy. That would, that would warrant a less restrictive policy moving forward. If they start to say things like that, that's going to give us a dovish reaction. Or it should. All of this stuff, low asterisk, nobody can predict this stuff, but this is where I believe the edge would be in reading through this policy statement. I don't think that there's going to be any sort of actual rate cut or hike. Obviously, we're almost 100% priced in for a pause during this meeting, so there's no real reason to entertain what would happen if they cut. If they cut today, we'll touch on it briefly. I think if they cut today, it would obviously be incredibly bearish for the dollar. It would be a huge surprise to the markets, and I think we would see a very volatile reaction. I don't expect that to happen. Nobody expects that to happen. It's almost like a 99.9% assurance that it's not going to happen. But in the off chance that they do cut, I would expect dollar downside. I would expect it to be dovish. If they hike, again, a 99.99999% chance that they're not going to hike, right? It's almost 100% a surety that they're going to pause today. If they were to hike, surprise hike, obviously the dollar is going to fly off of the back of a surprise interest rate hike. Those two scenarios aside, you take so you get the hold in the policy. Cool, that's expected. Then we move to the statement to start to decipher some of the language. The dovish language, this is what we would look to see, or this is what we would look for in the statement. Now, if we're going to look for hawkish ideas, which is going to be USD upside, equities and gold downside. In order for this to happen, really all that needs to happen is we need them to say jobs have remained strong and unemployment has remained low, even though that's definitely not going to be said because unemployment hasn't remained low. It's actually above their target band for the entirety of the year. Inflation is, if they say this, inflation has eased but remains elevated. I mean, they literally just have to say everything that they said at the last meeting. And they say this. So basically anything less than a confirmation to the markets that we are getting a cut in September, anything less than this is going to be hawkish, in my opinion, for the dollar. I think we're going to see if the Fed doesn't come out in their statement and confirm to the market that, hey, yeah, we are getting a cut in September. If that confirmation does not happen in any regard, like they just repeat the June statement, we're really not sure, not really happy with, not confident with the data, need more confidence, blah, blah, blah. If they do not give us anything that says there's a cut coming in September, I expect a hawkish reaction out of the market because of how dovish we are priced following the last FOMC meeting. So everybody's expecting a easing in the policy, and without any confirmation of that at this meeting, I think we're going to see a hawkish reaction. Where typical with past meetings, and maybe not, maybe I shouldn't say typical, but in another world and another time, another scenario with the Fed, we would need more hawkish tones than just the previous statements repeated. But because of the current pre-positioning of the market, anything less than a confirmation that dollar downside is in play, anything less than that, I think it's going to be hawkish. It's going to be interpreted as hawkish, and we're going to see dollar upside. Let me touch on some questions here. I think I have about 9 minutes left. So let me answer some of these questions. I'm leaning towards a higher probability that FOMC hinting rate cuts in September. Yeah, that's I think, I don't want to say it's the hope, but it is the idea. Generally, the market is expecting that they're going to tell us that we're getting a rate cut in September. Like the general consensus among all market participants, analysts, traders, the general consensus is we're getting a cut in September, and we're waiting for the Fed to go, yes, the markets are right, we're getting a cut in September. That's the general consensus. If they cut rates, where do you expect USDX to target? I'm assuming you're asking me about the USDX, the DXY. I'm gonna give you guys about 15 seconds to screenshot this so you can keep it for yourself, and then I'm gonna delete it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay. Hopefully you screenshotted it. If not, scroll back on the video. All right. Let's see here. What is the question? Where do I expect the USD to target if they cut? Well, I don't expect them to cut today. The dovish reaction, the scenario I'm looking for when it comes to what a cut would signal is going to be I just deleted this, and I I want to pull it back up, so maybe I'll keep it up here. Okay, it's not. Anyways, the US dollar downside is what you would expect out of a surprise cut today. That might not always be the case. There are times where the markets are expecting a cut for 2 months ahead of time and they begin to price it in. It's called buy the rumor, sell the news. So, we expect a cut for 2 months coming into this next meeting. Like from here on out, if we expect the September rate cut or the September meeting to be a cut and markets are pricing in, a super bearish dollar, this is just a general picture of the dollar going down, not saying where it's going to be at, but let's just say over the next couple months, the dollar trends to the downside off the back of the expectation that September is going to be a cut. And then September we get the cut. Well, all of these short positions will then take, it's not guaranteed, but they could take profits at the news. They buy the rumor, the idea, the markets are forward looking. So they start buying short positions, shorting the market, selling the dollar into the September rate. And then the rate decision comes out. It was a cut. They get rid of all their short positions, dumping all their shorts back into the market. And we see the dollar actually fly up off the news. So it's a buy the rumor, sell the news play. The other idea behind that makes it maybe a little bit easier to comprehend is actually buying. So let's say it was a reverse scenario and all of a sudden, the markets are expecting hikes in September. And so the markets start to, price in a hike for September. And then September actually comes and they do hike. Well, the market was buying the news and then they're going to sell, or sorry, they were buying the rumor and then they're going to sell the news. And what's, a way that plays out for a lot of retail traders is they get an idea that fundamentals are like technicals, right? With a technical play, let's say, a lot of people are familiar with this, double top, the neckline breaks, blah, 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 blah. It comes up, retests this area, then sells off. It's very simple. This is a pattern that's repeatable. At every time the double top repeats itself, you could look for this pattern and try to make a play off of it, right? With fundamentals, it's different because the bigger picture is always changing and you have to bring things back to the bigger picture. So a lot of technical only traders will start to dabble in some fundamentals. They'll think that they can hear something like, okay, if we get a hike, that's going to be good for the doxy, right? But they're not aware that the market's been pre-positioning for a hike for 2 months. And so when the hike finally comes, the market already knew it was coming. It was buying into that idea the whole time. All this new liquidity is going to come into the market thinking that because they hiked, it has to continue up. And so all of these buy orders are now getting flooded with all the sell orders, and then the price drops and everybody's, all the retail technical only traders run around screaming market manipulation because they don't understand exactly what happened. But that's some of the nuance of trading some of these events is understanding the pre-positioning. So for me, the pre-positioning today is all about whether or not we're getting a repeat of the statement. Anything repeated from the last statement, in my mind, is going to be hawkish for the dollar. We're going to see upside in the dollar. Anything with a softer tone out of the Fed than the last time, maybe not anything, but specifically things about inflation. They're more confident in inflation. Even if they don't say we're more confident, they just say inflation is showing progress, and they don't say anything about a lack of confidence. Jobs remaining strong, but there's some signs of weakness in the labor market. They mentioned that it's going to be good. It's going to be dovish for the doxy. And then if the current trends persist, obviously this one being maybe not obvious to everybody, but if trends persist, that would lead to adjustments in policy rate and easing in policy rate. If they mention things about easing, I think anything in that vein is going to see some continued dollar downside. It might not be the biggest impact to the market, because of the pre-positioning, but there would be zero reason for me to buy the dollar off the back of that. It's not a policy change. It's not like this is what the markets are expecting out of the actual rate. This is sort of what the markets are expecting just out of the Fed, or maybe less so expecting and more so waiting for confirmation of. Once we get that confirmation, I think we'll see dollar downside. And then obviously, like I was saying before, dollar upside would be a repeat of the last statement. I think I'm running out of time here. One more minute. Let's see. As far as so on the dovish side, you asked me about the rate cut. I'm just going to go with the dovish tone. If they give us the dovish tone, where am I going to target? I mean, it really just depends. I tend to target like specific price levels based on previous price action. So, a good price level is going to be right here at 103.7-ish, and then 103.2. It's going to be another decent price level. I'm going to be in here like way lower on the time scales, looking to scalp some of the stuff off the 5-second, 15-second, 30-second charts. So I'll be getting like these micro moves and most likely not staying in for the longer, bigger pushes. So that's how I tend to trade it. I'm not necessarily going to be targeting any of these levels here, because that's a kind of a long way for me to stay in a trade. Let's say the news drops and within the first 5 to 15 seconds, price drops here. We'll just say it's dovish and price drops to this level. Within the first 5 to 10 seconds, I'm trying to get in here, and then I'll be getting out, within what would be like a 1-to-1 for me, maybe holding some runners and just seeing how long the runners can play, and then trailing stops for the rest of the day, and then closing out before the end of the day.
Hey, Nick, how's it going, man?
What's going on, man?
Good to see you. Good to, I was listening to a little bit of your commentary there. Definitely good stuff, breaking down the kind of the antics of what's going to happen with Jerome Powell. What is he going to say? What is he not going to say? And are we going to solidly see whether or not they're going to kind of indicate a cut is coming in September. So should be interesting. And before we let you go, I just wanted to mention to everybody who's listening, if you guys enjoyed Nick's commentary here the last few minutes, make sure to go follow him. Here is his Instagram link. You can see it just popped up on the screen. It's linked in the chat. We've got that all set up for you. So make sure, go show him some love. There's his YouTube channel as well. And Nick, thank you very much for helping us out on the show today and helping kind of drive us right into the final hour.
Yeah, no problem. Thank you guys for having me.
All right, man. See you next time. Thanks again for coming on.
All right. Bye-bye.
All right, guys. And big shout out to Nick and all of our other guests. We've had a really awesome list of just powerhouse commentary today. It's been awesome. I've been keeping the stream open just on one side of things while I get other stuff done. And we are now kind of coming in closer to the final hour pre-FOMC. And I wanted to just come back here, talk a little bit of charts, take a look at what I'm personally watching, as well as maybe what the market is looking for. I think Nick did a really good job in the last few minutes, just the other Nick, breaking it down for us in terms of what the Fed commentary will likely do to markets. The big thing here is that we have to think about where we're at with interest rates or where we're at with forecasts from the Fed. Right now, the market is pretty confident that we're going to see a rate cut in September. And that confidence has contributed to the drive higher in the stock market that we've seen in the last several months. So you put all that together, you say, okay, well, today is kind of make or break it hour, because what the market is sensing heavily is that the Fed is going to cut rates in September. Okay, so that's our baseline. So today, what would we expect? We'd expect when the Fed comes out, when Chair Powell comes out, and he discusses this topic, that he doesn't shy too far away from the idea or letting the market believe that the first rate cut is coming in September. Remember the start of this year, guys? Some of you might have not been paying attention to the more paying close attention to the Fed or getting into the macro so much at the beginning of the year. But if you were, you probably remember that the Fed's dot plot indicated that they predicted they were going to cut interest rates 3 times, 75 basis points total for the year 2024. So if we think about this for a moment, we've only got 3 meetings left after this one. So today's meeting is one of 4 remaining meetings for 2024. We have today, July 31st. Then we have one in September. Then we have one in November, right around the election. And then we have one in December. So John points out that they were confident about rate cuts last year too. Yeah, and that's the thing, is you have to be careful, right? Because the stock market started out this year absolutely ripping higher because they thought we were going to get 6. So now the market is pricing in 3. And remember that way back here, that was what the Fed said they were likely to do this year, was 3. Now here we are. We've gone several months. We're almost into August. We've not seen our first rate cut. Sometimes the market does have a tendency to get very ahead of itself, right? Because if you take a look at the stock market thinking that we were going to get our first rate cut in March, here we are going into August, and we're probably not going to see one today, right? Very, very unlikely that we see a rate cut today. Is it possible that you get a surprise rate cut today? Possibly, but I don't think it's very likely because nothing, at least on the main front, is showing any serious calls for concern. We'll go through some data here together. I think that's probably beneficial. Let's take a little bit of a tour, if you will. So GDP growth beat expectations. I think this by itself is a pretty good deterrent from them cutting interest rates today, because growth has still been pretty strong. Growth has come down, but then, we're getting the advanced GDP number that comes in stronger than expected. We were forecasting for a 2% increase. We saw 2.8% for the GDP advanced figure that came out. And the thing to note about that is that when you get GDP beats, that's showing that growth is higher than expected. So keep that on your radar. So growth came out, GDP growth came in strong. Services PMI did come in weak, right? Weaker than expected. Manufacturing PMI also came in weaker than expected. Retail sales data recently has been coming in not great. It missed, and then it beat recently, but the beat was just a 0% month-over-month growth. So we didn't see contraction in retail sales. What are retail sales, by the way? It's all in the name, retail sales, right? Retail spending, going out, consumer health kind of thing. So, keep that with you. So there's a couple things. GDP growth been pretty good. Services PMI a little bit weak. Manufacturing PMI a little bit weak. Retail sales data overall weak. Jobs data, which we get Friday, right? We get our latest GDP figure, the last one that came in July 5th, slightly beat, but not by much. Then you have ADP, which came out earlier today as well. ADP, the advanced, so ADP came in lighter than expected today. So when we go through this, guys, what I want you to think about, if you're trying to understand the data perspective, we can kind of go through this and we can say GDP growth beat, services PMI missed, manufacturing missed, retail sales, it kind of beat, but let's just go sideways since it's kind of mixed. NFP, is it a good place? Right. So I would say that's a neutral run because we're not seeing really hot NFP. We're not seeing really weak one either. ADP, it's been trending lower. So we'll give that as a slowdown. Claims have been slow. Job openings have been slow overall. Unemployment rate has been weakening. So what you can see here is most of our indicators, most of our data is pointing towards U.S. economic cooling. And I make the distinction when I make those points because a lot of times people will hear that and they say, oh, yeah, the US economy is crashing. Or other people will say, no, it's not, Nick. It's not crashing. Hear me clearly on that. I'm not saying that the US economy is crashing. I'm saying that economic data is missing forecasts. It's coming in light. And that is exactly what the Fed needs to see in order to begin cutting interest rates, right? They don't want to wait for something to break, because if it starts slowing a lot faster or a lot more than where it currently is, then you got a problem, right? The Fed probably wants to start cutting rates pretty soon because they don't want, jobs data to start falling off a cliff. They don't want unemployment rate to rise dramatically. So we got to keep an eye on the data. If you want to try and get a feel for what the Fed is going to do, look at the data, because that's what they always say they look at, right? They say they're data dependent. So the Fed is making up their decision based on what we see in the economic data. If we take a look at inflation rose up to 9% in the US on a year-over-year basis and then fell back down pretty drastically. And many people thought, okay, we're going to get rate cuts like crazy. But then we bottomed out and inflation went sideways, and now recently have started to see a trend lower again in inflation. Now, again, if the Fed wants to cut interest rates, they've got to see inflation data cooling. By the way, the platform that I'm using is called the Edge Finder. And if you're new to the show, if you're new to the channel and you like this sort of data, I just want to mention that we are currently doing a massive discount on the tool. It is currently 55% off for stream viewers only. So if you're watching right now on the live stream, we're going to drop a link here in the chat. If you'd like to speak directly to a member of our team, you can get access to that huge discount we're doing. It's our summer sale. The SS, the summer sale, is currently 55% off if you send a direct message to our support team who is standing by and can help you out. So get a copy, take advantage of the discount. Why use a tool like this? Well, because economic data is really important to macro traders. If you're trying to use fundamental analysis in your trading, you need a tool like this. You need something that helps you source data quickly. Not only that, the Edge Finder goes one step further. It takes the data and then it interprets based on its internal algorithm whether things are bullish or bearish based on the summary of all of the different data. This tool looks at things like GDP and PMI numbers, retail sales, inflation statistics. It's parsing through all of it and giving us a general feel for what the data is telling us. So if you don't have a copy, again, it is 55% off right now. That is the biggest discount that we do all year long. So don't miss out on that. It is, again, available using the link in the chat right now. If you speak directly to a member of our team, they'll hook you up with that discount code and answer any questions you might have about the tool. So the S&P 500, the Nasdaq, these things are just flying high today. The Dow is actually killing it, up 1.2%. And I know it's not up as much as like the Nas or the S&P today, but it's up enough to worth mention because the Nasdaq took a huge tumble yesterday and is now paring those losses. But the Dow has just been up, sideways, up, right? Nas has been down, up, right? So the Dow is really killing it. It hit this support level, and this ended up being like the simplest trade that's worked out for me, like in a minute. Like this trade took little to no drawdown. We entered the trade. The Dow Jones started becoming profitable and has just continued to push higher. This signal is an Edge Finder signal. So the Dow Jones gave us a very bullish reading. I executed the position and we are looking good. I liked the technical setup, but the Edge Finder helped me with the fundamental side. So stops are below this low here. I do need to probably trail a stop on this one. In fact, that's probably a good idea for me to do before the Fed meeting. I'll look into that. Anyways, the NASDAQ trade is also come back to life. It went against me here pretty bad. And then AMD, Microsoft earnings popped things a little bit back in the other direction. We got gold moving higher here today and testing a level of resistance. Gold's also up a little bit on geopolitics right now. There's unfortunately some more kind of violence going on in the Middle East right now. I don't know all the details. I just know that there's been a lot of headlines in the last 24 hours that have caused a bit of concern. And that may also be the same reason why oil is up 3.26% on the day. That is a huge bump for oil prices. And usually when you see oil prices moving up, gold moving up, and you also have bond prices moving up all at the same time, it's usually a little bit of a concern on that front. But what's interesting is you're having that on the same day that the stock market is flying high. You also have the yen moving lower. I don't know if you guys have been keeping track of the yen, but the yen, even if you don't trade currencies, is a really interesting movement here because, we topped out around 162. Price came down, but this time did not find that bounce back support. It really broke support big time, and it's just been in free fall for a minute now, or for like a month now. And the concept here is that this makes me a little bit nervous because I'm like, okay, why is the yen so strong? Is this a concern about global slowing? Is it also the fact that the Bank of Japan raised rates, right? So they raised rates, which is a big deal for the Bank of Japan, makes the yen stronger, yes, but is there also a little bit of fear mixed in there, right? Are people concerned about the global economy maybe going long the yen, or at least covering their yen shorts? That's possible as well. I'm short dollar Swiss. I'm still in this position. I've been in it for several weeks now, and I've trailed my stop loss just above this swing low that we saw. We took out the previous low. I went ahead and trailed my stop loss. I've trailed it a couple different times now, and this basically is the new threshold. So if price reverses today, if we see a push back, if the dollar Swiss does actually bottom out, then I'm going to take profits on this move. So that's a trade that I'm in. Shared that inside of our Discord. I also wanted to mention, if you guys are interested in getting access to our Telegram channel or our Discord channel, we'll drop the free links to both of those in the chat wherever you're watching. You can click those links if you want to join our Telegram channel. We're putting out free game all the time there. So make sure, if you're not already in there or the Discord, you can join either one and get access. Again, those are both free to join. So let's talk a little bit about the dollar. The dollar is just holding this 104 level. It does not want to break 104. And I heard Chris talking about it. He was doing the show earlier. He was the host for a little bit. I heard him talking about how the dollar index, or just currencies in general, have been a bit frustrating to trade for higher time frame. Chris trades the daily chart, as do I a lot of times. And so the dollar has been a little frustrating to trade just because it's not made a substantial directional move in a little while. So, if you take a look at the dollar index, you're seeing it cap out around 106.5 and really holding the lows at 104. I think things get interesting for the dollar index if you see a solid close down today. If you see a close under 104, we saw one over here and it was a fake out. But I'd be interested to see on a big Fed day like today, if you get a bearish USD closed on the DXY, which is the dollar currency index. If you get a big bearish close on that today, that suddenly, I think, brings in a lot of momentum traders, as perhaps that would come with news that, the Fed is going to cut rates in September. Maybe there's even a solid chance, or a more solid chance, that they cut 50 basis points instead of 25 in September. It just depends what we hear from the Fed meeting. I'm not saying that's what's going to happen. I'm just saying that's what the market would probably be looking for. If you're going to see the dollar tank under 104, it's probably going to be coupled with, because the market thinks we're going to get a rate cut in September. So unless you surprise that expectation, the dollar's not going to move that far. But if you come out, if Powell comes out in a press conference or in his statement and he says something that is really dovish, right? Let's say he says, we're very confident with where we're at. We're solidly standing on the idea of cutting rates on September's meeting, which he probably won't say it that way. But if he says something, very indicative that they're going to cut rates in September, that would tell you not about September, because September's already assumed. If they come out and say, something that's very dovish towards a September cut, what the market will assume is that there's a good chance that we're going to see 3 rate cuts this year. That would get the dollar to move lower. If you see expectations for the Fed to cut interest rates, increase probabilities 3 times this year, that's going to get the dollar to move lower. If you see something to the contrary that tells you maybe just 1 rate cut this year, Dollar's going to bottom out. So you might say, well, Nick, which way is it going to go? And as I've heard a couple different people on the stream ask that very same question to themselves, the appropriate answer for professional traders is we don't know, right? Professional traders, and I say this frequently on my show, professional traders don't know what the market's going to do. Professional traders react to what the market is doing, and they manage risk in case they're wrong. So, I'm not trying to predict what the Fed is, what Jerome Powell is going to say today. I do think that there's a solid chance that we see the dollar continue moving lower. I think that rate cuts are coming. I think that there's a possibility you see 3 rate cuts this year. And maybe that's what the Nasdaq and SP500 are sniffing out today with such a crazy rally today. But we'll see. So again, we'll have to wait and see. Nick, are you nervous? Why would I be nervous? There's nothing to be nervous about unless you're not being appropriate with your risk. If you're massively over leveraged, then that's where that nervousness is coming from, I think. If you're, risking an appropriate amount, it shouldn't kill you if the market's going in your favor or against you. This is the thing, is like, if you are playing, if you're playing blackjack with an edge and you're risking $20 per hand and you have a bankroll of $20,000, there's a good chance that you're going to win some hands, you're going to lose some hands, you're going to have winning streaks, you're going to have losing streaks. But if you're playing good blackjack, counting cards, and you have the edge slightly in your favor, over the long term, you're going to make more money than you lose. But this very next hand of blackjack isn't going to make or break your career. The same thing applies to trading. Good trades can result in losing profit. Good trades can result in making money. Good trades can result in losing money. A good trade isn't about the P&L. A good trade is about whether or not you were supposed to take that trade with your system, and that system has some form of an edge where if you keep doing it, you're going to make money. And where I have found my edge is the edge finder, the concept of approaching, finding an edge. The name is kind of purposefully designed because the purpose was finding edge through fundamental analysis, understanding the macro trends, understanding what's really going on and what's driving the markets one way or the other, so that you can make a slightly better informed decision, not a certainty, not a guarantee of what's going to happen next, a slightly better based decision. Does that make sense? If that makes sense, do me a big favor. Hit the thumbs up button on the stream. As we get closer to the Fed meeting, we'll see what we get today. Should be a really interesting event. The Fed is not expected to do anything today. They're not expected to lower interest rates today. But what makes this Fed meeting very interesting is the question of whether or not they're going to really solidly signal that rate cuts are coming. If that comes out very strong today, the market's going to love that. They're going to celebrate that. And it's going to confirm the rate cut bias that I've had, as well as other traders. But if they don't, if they push back on that, if they come out swinging with the idea of talking down rate cuts, if they're concerned about inflation, if they're concerned about labor data, these are the experts when it comes to the economic data. So if they're concerned about it, it will scare the market and go the opposite way. And I would probably take on water with some of my positions. The dollar would move higher, but I'm currently positioned personally. This is, again, I'm telling you this as I don't know what's going to happen, but I generally lean thinking that the dollar will be bearish and that indices will stay strong. Gold, I think, will also potentially move higher. But if it doesn't, we're not going to lose the farm on that idea. Diego, what's up, man? Thank you very much for the R25. Hey, Nick, I don't know if I missed it, but have you seen AUD USD? It had 9 bearish daily candles since 15th. After yesterday's Australian CPI, we're currently with a huge wick on the daily candle. Thank you very much, Diego, by the way, for the donation. I really appreciate that. That's just awesome. You guys don't have to donate to the stream ever, but it is, of course, appreciated. We've been here all day, and we're going to keep the show alive all the way through the Fed meeting. If you're enjoying the show, the best way to tell us that you are appreciating the content is to thumbs up the stream. It takes 2 seconds to do. but we really appreciate it. There's a team of people behind the scenes on this stream that make this possible, and we look for, the number of likes to give us a good indication of whether or not people are loving the show, if they're feeling like the show's helping them out. So again, take 2 seconds out of your day. We'd really appreciate it if you are enjoying the show, just hit the thumbs up button. Okay, so AUD USD. Sure, we'll do your request. Absolutely. So if we take a look at, let's start from a technical perspective for just a moment. If I'm zoomed out on the Australian dollar against the US dollar, I'm just going to start completely fresh here. On a longer term basis, the Australian dollar seems to top out around this area, 68 to 68.5. And it seems to bottom out and find support around the 64 to 64.5 zone. That is on a long term, it's like a weekly chart level of support and resistance. But let's talk a little bit closer in to recent times. So we can see that those are big levels on the long-term chart. But what we can also see is that recently, the Australian dollar against the US dollar broke a really big level of support. And this actually surprises me because I was bullish on the Australian dollar right around here. And I actually got stopped out of a trade, but I'm feeling good that I got stopped out when I did because it really slid a lot further from there. But anyways, from a technical perspective first, it does seem very bearish. It seems really, really rough to try and call a bottom on this one. That's not a certainty, of course, because you could see today something comes out and makes the dollar look really weak, and then suddenly the Australian dollar might strengthen. But that's a tough game for me to play. Now, in terms of a technical perspective, we broke support. If you make a move back up into this area, just from a technical perspective, that would look like resistance to me. Where I see obvious support on the daily chart is not until you get down to like 6,400. So are we overextended to the downside? I would say so, but I don't ever make that. That's not like part of my decision-making process. Just because something looks oversold or overbought does not mean it can't keep going, right? So if we do see this thing bottom out and we pull back up to this like 38.2% retracement level, this actually looks pretty good for a possible sell setup if you were bearish on the Australian dollar against the US dollar. We'll talk about that in a moment because I'm not actually going to be taking a trade on this, even if it comes back up to that level. In my personal methodology, I'll show you why in just a second. But from a technical perspective, that's a pretty clean bearish setup in my personal view off of the daily chart. You might get short-term a bit of a push up into this area, but we don't know because the Fed meeting is right around the corner. Could be, could not be. But if you do get a little bit of a counter trend push to the upside, I think the prevailing trend here is still to the downside. We could also take just a quick moment to look at the moving averages here and see that, we had this really strong upward trend, but it has fallen through every major long-term moving average level of support. That concerns me. And now the 200-day moving average right around this area would give me some serious concerns about further downside. This is all technicals. And so that's the technical side. But let's go take a look at why I would not touch this trade either ways. If we go over to the Australian dollar, let's do this. We'll go major currency pairs. And what we'll see is that the Edge Finder top setups algorithm is currently giving us a neutral or -1 signal on the Australian dollar against the US dollar. So what does that tell you? That tells you that when looking at the economic data, the technical data, and the sentiment data that the Edge Finder is importing, we're getting mixed readings. You got some that are positive, some that are negative, no strong conviction one way or the other. The trend is moving lower, but then PMIs favor Australia, heavily. But then GDP favors the US. But then inflation favors Australia. Then, you can see there's a mixed report here. So without that clarity of what the economic data is looking like, what sentiment data is looking like, without that clarity of a strong lean one way or the other, there's absolutely no touching the Australian dollar for me, no touching any of these charts for new trades. Now you might say, well, Nick, you're in a USD CHF short right now, which is true. But this is not when I took the trade, when I initiated the trade on dollar Swiss, I was getting a bearish reading. It no longer is a bearish reading, but it's still a -2, and I'm just trailing stops on a position. When I add a new position into my account, it almost always is giving me a strong enough reading on the edge finder to get bullish or bearish on a particular chart. Now, I trade a lot of different things. I usually don't trade minor currency pairs. This would be the full list of things. And then what I would do is I like to exclude neutral readings from the edge finder. This is my current actual watch list for setups. These are things that I would consider taking a position on. Does that make sense? This is my, this is my filter. I don't touch, even if the chart looks perfect. If we don't get an edge finder reading that gives me a confirmation of what the general economic data prints are pointing towards, there's nothing for me to do. I hope that answers your question. Again, I really appreciate the donation. Diego, thanks so much for donating to the stream. And I hope that that was helpful to you. The edge finder is, like was just dropped here by our producers here, the edge finder is currently 55% off right now. So if you do not already have a copy of the tool and you'd like to use the same engine that I use to make better decisions in the market, here's the edge finder, currently our biggest discount of the entire year, and it's ending soon. So don't miss out. 55% off. Click the link, just been dropped in the chat. And if you're watching at a later point, it'll be linked in the description. First link there as well. $30 minutes full margin on gold. Jermaine, I wish you the best, my friend. Definitely the best in the industry. Thank you, Diego. I appreciate that. And again, really, I do thank you for the stream donation. Are you leaning more on the hawkish or bullish side? I think you mean hawkish or dovish side. Of expecting what the Fed will lean. I think that they're going to lean dovish. But just because I think that, I always, the reason I'm so careful with my language, and what you'll notice is a lot of us are when we're on camera on this show, is that none of us really know, right? None of us know for certain. That doesn't mean you can't make money trading, right? It just means that if you have an opinion in the market, recognize that it's an opinion, not a certainty, right? I may be bullish on a chart or bearish on a chart, but that's not a certainty of what's going to happen. I'm not absolutely risking everything betting that I think gold will go down on, that is absolutely why people think the markets are gambling, is because somebody will come in full margin the chart, and if it doesn't work out, they say, oh, trading's just gambling. But they're not employing any sort of methodology. They're just gambling and having fun. And if that's what you want to do, then by all means treat it like a casino. But for people who do this for the long term, some of us do this for a living, some of us do it for a very meaningful amount of our income, or we're here for the long term. If you're here doing this for years, better than to go gambling on a Fed meeting, right? Nobody knows what they're going to say. So trying to make big decisions, huge bets right now on what the Fed is going to do, I think it's just a foolish approach. Any carry trades you've been interested in recently? Not really. I just haven't been trading the carry trade very much recently. In fact, I'm counter carry trade right now with a dollar Swiss short. But if I get stopped out of this, dollar Swiss, I think I know Chris Pulver plays this on the longer term basis as a carry trade. I think he has a basket of Swiss franc trades. I don't hate those at all. I like that idea a lot. Just, positive carry and kind of trading over extended levels can work well, but you have to, again, and people who do this like Chris, they know very well how important it is to position size appropriately and accept that you're going to have swings both directions. You're going to have things go in your favor, against you, so on and so forth. Silver's up 1% today, got gold up 0.7%. What I'm looking for on gold on a daily chart perspective is I'd like to see if today we can close strongly above this previous level of what was resistance. I was in a long position right here, went in my favor, did not do anything with it, and ended up getting stopped out. So what I'd like to see from a technical perspective, and my memory is, fresh on this one, I'd like to see this previous level that we failed out. I'd like to see that one break, right? Show me some strength at these areas. Then I might be willing to try again. And this one is actually a live setup for me because the Edge Finder is giving me a bullish reading on gold right now. So I really like that. The Russell is also giving me a bullish reading. So maybe if we get some pullbacks, but look at this chart, man. The Russell is just looking clean. You've got this level here. Looks like the classic kind of bull flag pattern. Even a little bit of a triangle here, right? You've just got the perfect setup for what looks like it might pop, right? But again, nobody's knowing for sure what's going to happen with the Federal Reserve today. I don't know what he's going to say in his press conference, but a pullback, I lean bullish on maybe picking up the Russell. Also, so I've got several things. I'm watching Russell for pullbacks. I'm already long the Dow. I'm long the Nas. I'm looking for gold pullbacks or breakouts, right? Breaks and retests would be good. Oil is crazy strong today. We'll see where that goes, but no setup for me on oil. Dollar yen, another really interesting one, down 1.3% today. The yen has just been very, very strong today. So should be interesting. Guys, we got Chris Pulver joining the show here in just a moment. So we're going to take just a quick break to thank our sponsors. Remember also at the same time, if you haven't already gotten a copy of the Edge Finder, it is currently 55% off. We'll drop that link one more time. Don't miss out on that sale. Should also be pinned at the top of the live chat. So with that said, we'll be right back with Chris Pulver to talk more charts as we gear up for the Fed meeting. Stay tuned. All right, and we're back with Chris. Chris, part two for both of us now. We've this is the second run back on the A1 Trading Show. We've been live all day long, and you're back to help us carry to the finish line. What's going on, man?
Well, nearing their all-time highs again in the portfolio, which is nice to see, and closed out for some profit. So I just had a little watch list this morning. So took some profit on the QQQ. I had I think on my screen, I think I've got my screen shared. So I was a little bit conservative. So I went ahead and took some profit when we were poking up here towards 470 and change. I had a 474 call. That was an out of the money call when price was trading on Monday around 462. So, that was not a expensive option, but I was up around 15% on my position. I thought better safe than sorry for a couple of reasons. The last 2 weeks, Nick, we've had some ridiculous moves in the Qs where, the average has been around $13 a week. The last 2 weeks has blown that up. And so this 2 weeks ago, we're talking about a QQQ that moved around $27 from high to low. Last week, the movement was, I think, a little bit bigger than that at $28 and change high to low. And this week, after our Tuesday low, we've already gone up around $16 or $17. So we're up $17 from low to high. Now, I could sit here and say, I think it's going to go up to this gap and it's going to fill this gap. But if it doesn't happen in the next 2 days, that call option for me is worthless. So I took the profit. I got in the debit at like 295. I closed it out for 365 today. Took the profit. I've got some bull put spreads. They're looking pretty good. As long as price stays above 460 for the week, I make some money there. As long as the IWM stays above 218 for the week, I make some money there. I've got a good looking trade on Pfizer that if Pfizer stays above $30.50 this week, that's going to make me about 17 grand. So all in all, I just did some management in between sessions, and I closed up some profits, protected some trades. I do actually, I think we talked about this yesterday on the show. I own some shares of Google right now.
Hey, nice.
Not bad. Now, I don't have to do anything at this time other than just chillax and see what the assessment is for later in the week. So if I go to GOOGL right here.
Also, Chris, just to note for people listening on Google, Meta reports after the bell, which will probably move Google as well.
Yep.
Meta's earnings, we can't forget, you got the big Fed meeting today, but Meta for stock traders will also be huge. Ad spending, the AI trade. I mean, Meta is another bombshell, just like Microsoft was. So we'll see. Just wanted to mention that, but keep going.
No, it's true. Meta is going to be important to watch today. So the reason I'm not closing out my position or taking the shares of Google is because just in case we do have a drop to the downside, I'm still protected with a 187.50 long put. So uh, here's what happens. If price on Google at 170.40, if we're down below 170 by the end of this week, I will make $1.75 per contract on that bear call spread. So I have some profit potential right there that I'm going to sit on for right now. I was assigned at the 190 and I was assigned early, but the good thing is I still have my 187.50 long put. So if price goes down, I actually have profit on the 170 bear call spread. I would still hedge with my 187.50. And Nick, I think I'm willing to own the shares and then repair it. So I'm not necessarily looking for like a long-term hold on Google, but we've already had a bit of a haircut off these tops.
I was
So
just
Google,
about to say, Chris, you telling me that is interesting because it is
yeah.
a dynamic shift. I feel like if I was employing kind of more approaches like you with individual equity names
Mhm.
2 weeks ago or 3 weeks ago, I would have wanted to avoid assignment like the plague. But now with the Nasdaq, seeing a 10% drop, maybe you have a little bit more willingness to take on some positions because I was looking at Google myself. Like, do I want to buy some shares and just stick it into the account and just wait on Google?
Yep.
I mean, I had one other one that I think is a fun one to look at. I don't know if I want to buy it yet, but CrowdStrike, which has gotten absolutely
Yeah, beat up a
ripped
lot from
apart,
that global breach, right? The data breach.
42% drawdown
Ooh,
in like
baby.
2 weeks. I mean, or 3 weeks, I guess. But
Yeah.
I've been super bullish on that space, the cybersecurity space, for some time because I really like the, just with all the AI stuff that's coming, I like it. But timing on this one is tricky and also very important because look at this. This is clearly a broken chart. If you take a look at like the, just apply some moving averages here.
Hmm.
Look how we blew through everything, right?
Yep.
The 20, the 50, the 100 day, the 200 day, everything completely did not hold one bit. It tried here just briefly, and then lawsuits came out, and CrowdStrike is in free fall. But here's a company that has really outperformed the S&P 500. It's a leader in the the software space. Not so much leading the S&P 500 now with that ginormous drop. We're back to 2021 levels, but just worth mentioning, there are some stocks out here getting pummeled, and so as you mentioned, stocks taking a bit of a breather here recently, not today, but in the last few weeks. Um, Maybe some willingness to own some stuff. I've bought this dip more than once. I've been early to the dip, so we'll see if this ends up being the bottom today, or if this has the potential to go anywhere today, Chris, for the rest of the day.
Yeah, I mean, we have huge gaps today, right? I mean, this is a monster gap to the upside on the Qs, monster gap to the upside on the SPY. We're likely not going to fill the gap today, just based on certain percentages with a 1+% gap or 1.5% gap. It's rare we're going to come all the way back and fill the gap. The one thing that I note here on the S&P or the Qs, the Qs poked the lows, which tells me that we're likely also not coming back to retest the high of last week. So, like I said, that's a big number to go all the way up and have a $28 down week and then somehow come right back and have a $28 up week. If that happens, Nick, that is a pretty wild amount of volatility for July. I mean, we're
Oh
talking
yeah.
summer trading, lower volume, and this thing's having some, 1.5 to 2 standard deviation moves. We're well above the norm of what we expect on a week-to-week basis. So anyway, I mean, I think that the good thing is, we kind of stabilized that 10% correction right there with that Tuesday low. Having a big gap to the upside today. A lot of that is credit to AMD, credit to Microsoft, with decent earnings. I know Frank is in the background trading some Microsoft earnings, and I think I disappointed him a little bit by giving him some reality. He was like, Microsoft needs to move about 16%. I'm like, I think the earnings moves on average about 4%. He's like, well, now you tell me.
Yeah,
So,
Microsoft, I mean, it was looking crazy bearish right off
yeah.
the rip, and then it just snapped back. I was, to be honest, by this move so far today, Chris, I've been a little bit shocked by it in terms of like the Qs because,
Mhm.
I see the AMD story and semiconductors are up huge today, but then Microsoft's like cloud spending or cloud growth was disappointing, and takes a little bit of the air out of the AI trade. But
Yeah.
I don't know, man. There's just so much still to go this week. It's really hard to say if today's move is real, if it's going to last, or if it's going to go much further from where it was. I mean, The Nasdaq could be up 3.5, could be 4% up today. It could be down, or not, maybe not down like you mentioned, very unlikely for that, but it could be,
Right.
could be down from where it's at now pretty easily if the Fed disappoints in any way. And I want to just talk, because we're getting closer here to the statement. We've got about 15 minutes. What are you looking for out of this this Fed meeting? I know very unlikely that they cut interest rates, but
Yep.
this is all about kind of shaping up for September, right?
Definitely. I think it's important that Powell kind of reiterates what he did last month, which is, I think last month was a pretty dovish tilt when he said, and I'll paraphrase here, but basically said, we don't need inflation to get down to 2% or lower for us to start cutting. Because if he said, if we're already at 2%, we've kind of overshot it. And so that was really the first time that he's hinted towards, like, we're ready to cut, we're willing to cut. And the market is kind of calling the bluff too. It's like, we've heard the Fed talk out of both sides of their mouth for a year plus, right? If inflation's bad and it persists, we'll be restrictive. But your best measurement of restrictive rates is going to be your core PCE, okay, versus your Fed funds rate. That's going to be what's restrictive. So right now, the core PCE, what's that on the Edge Finder, Nick? Do we have core PCE? I know we have CPI
No, but I
data.
believe it's 2.6.
Okay.
I
So
think it's
so
2.6.
right there, it's like we're talking about 5.25%, 5.5% versus a 2.6. That's restrictive. We can bring the Fed funds rate down to probably 50 to 100 basis points above the core PCE, which is also trending lower, like CPI is trending lower. And so I just think that the markets kind of sniffed it out, and the markets made a move. I mean, I think that's where we had those 6 or 7 days of all-time highs in the S&P and the Qs, and that was a bit like frothy. And so I also wonder, let's like, okay, we're going to cut in September. I think it's going to happen. The probability on the watch tool is really high. That rarely goes from 90+% and then is wrong. But we still have all of August. We still have Jackson Hole. The only thing that would be a surprise to me right now would be if we have some bigger geopolitical event in August that kind of shakes things up with Jackson Hole, and it'd have to be like a geopolitical risk as opposed to, I think the Fed's going to cut. I think the Fed's going to cut September. At this point, I don't think they care whether it's Trump or Harris as a president. I think the Fed's going to cut in November, 2 days after the election, which at first I thought that's crazy, but now I don't think the election is as big of a deal. I think that, Trump Biden was like, everyone's pissed about Trump Biden. It's a terrible election anyway. I'm not saying that Harris and Trump's any better, but I just think at the end of the day, there's not really a policy surprise by either candidate. If it's Kamala Harris, it's going to be more of the same, and that's not terrible, or maybe it is. I don't know. That's a matter of opinion. But for Trump, it's like, I don't think Trump has necessarily this big shift in policy unless he really wants to touch on the geopolitical risk. Because if Trump wants to get into tariffs and we have a trade war again or a tariff war again, guess what? That's not good for a lot. That's not good for global economy. That's not good for growth. That could actually be a handcuff to, we can talk about cutting the corporate tax rate, but if we go into a full-on trade war, none of that's going to be good, man. So I just think the market's like, okay, maybe there's some election drama later on, but right now it's like polls are mixed, or everyone's in the 40s right now. It's like there's no real clear winner. The majority's been kind of pulled back from Trump a little bit. But that's November, right? I think the Fed still cuts in November. I think they're going to cut September, November, December.
I think they're
going to
exactly
what they said, which is 3 cuts. And they said that.
I think they're gonna. I think we're gonna cut because the word that or the way Powell has phrased it several times is that we don't make our decisions based on politics. He's been very, very aggressively firm on that topic. So I think if he were to kind of solidly stake his point by cutting interest rates right around the election, because that's what the data is saying, and that might also be another thing that he's thinking about today is almost like a counterpoint to that. So think about this, Chris. So today, if you're Powell and you're like, oh man, I'm going to get in so much trouble if I cut for the first time right before the thing, we need to get one rate cut in. Right. If anything, he's going to do the opposite of it being a political move. He's going to try and make it look like less of a political move by maybe cutting September for the first time and solidly staking like, hey, we're going to cut interest rates 3 times the rest of this year. That way it doesn't look weird that the first cut happens in November. So I don't know. That's if you want to really play that game, you could make the stake that he's not going to do it politically. He's going to do it to look counter, you know, I don't know what the word
That
is.
is already premeditated. Like it doesn't.
Yeah, like we were going to do it
doesn't
anyways.
matter. We're going to do it regardless. So
Yep.
deal with it. Like we said we're going to do it. It's time to start. We think it's appropriate. So yeah, I mean, based on the press conference, I would like to see Powell just stand firm on his. Like we've gotten this far, you know, with the back and forth in the Fed. It'd be nice to see Powell just kind of stand firm and say we think it's
I think so,
appropriate.
too.
We don't need inflation to be down to 2% to start cutting. You know, we've been watching the labor market. We've been watching this. Inflation's trending lower. Blah 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 blah. You know, all the points. And then as far as the I mean, if somebody were to ask, I've mentioned this in my trading room. If somebody was asking, you know, Powell for Q&A today about the election, and it's like he can just say the same thing. It's like, you know, our decisions are not based on who's president, who's going to be in politics, what policy is.
They're
You know,
probably
our
going to
decisions
ask
are
him
based
today.
on
Chris. They're
our
probably
best.
going to ask him in 10 or in 30 minutes from now. They're going to ask him, "Are you going to in regards to the November meeting?" And he's
Correct.
probably going to say the exact same thing that we're talking about. He's going to sound not political. I want to thank really quick Raul in the chat. Thank you so much for the 20 on the donation there. Appreciate you. 20 rupees. Thanks so much. We really appreciate it. That's going right towards the trading accounts. We'll place a bet for you. Just kidding. But yeah, anyways, thank you. Yeah, I mean, Chris, yeah, it's going to be interesting because I think that that's actually a solid idea of they're going to premeditate. That's a great way of putting it. Premeditate that they already had planned, as they said at the beginning of this year. I mean, if they get it right and the whole market got it wrong, that's just going to show how good they are at what they do and how absolutely emotional the stock market actually is, right? Because if they actually come out and deliver 3 cuts as they predicted in January, when the whole market was so absolutely gun-ho about rate cuts, thinking we'd see 6, I mean, it just shows that they're the professionals. And you know, I made the comparison recently, and I'll say it again for maybe people who missed this concept. The idea being that, you know, if you're really good at sports betting, the casinos will hire you to help write the lines so that they can better price and make more money themselves. In economics, the same pinnacle of economics is working for the Fed as like a very high up, you know, hedge fund, a very high up hedge fund, or at the Fed, using your super skills with economic data to try and forecast better. So they have some really smart people at the Fed. I mean, they've got some geniuses over there in the economics data, and they still get it wrong. So, you know, that's just how hard this stuff really is, Chris.
Yeah, and I will say I'm going to give, you know, a little bit of shout out to Jerome Powell and the Fed simply because the language and the transparency and the consistency has been pretty much tip top. You know, this is you can't fault Powell for being the same guy every single month. And sometimes the market likes it, sometimes the market hates it, sometimes the market's so confused that they get nothing out of him. But month after month, when we do sessions like this and we're dissecting his statement and we're dissecting the Q&A and we're looking at what the Fed meetings minutes are reading or posting, the consensus has pretty much been consistent every single month. And to a fault, it's been like, okay, we get it, man. It's the same thing. They might raise rates. They might not raise rates. But as we get closer to wrapping up the summer, getting back into September with the high probability of that rate cut coming, I think at this point, I think the Fed's in a good spot where it's interesting, Nick, like the consumer has kind of seen enough damage where the unemployment's gone up. We've seen spending cut back quite a bit. Delinquencies are starting to happen in the background. It's like, I think that the Fed might get it right, man. Like, I mean, I think that in a historical sense, the Fed has backstopped a lot of crisis, right? And that's been, you know, the greatest thing ever. If you have the assets to buy, or you are, you know, if you have the dry powder to buy when we've had a crisis, if you bought in 2001, you bought in 2008, you bought in 2020, you're killing it, right? That's been the Fed backstop that's worked for many, many years. You know, the saying is don't fight the Fed. It's not really any different now. You just got to wonder if at some point, you know, the Fed doesn't have the backstopping power to then halt the market and then see all-time highs again. At some point, maybe the backstopping is it gets worse, it gets nastier. We have another 20, 30, 40% correction off these all-time highs. And I think that's the scary thing, is you never know. But I don't try to trade like, oh, the black swan is the only thing I'm focused on. I'm certainly not overly bearish. I'm also at this point, you know, we've had a great run for the first half of the year. I'm not overly bullish either. I think having a 15 to 16% gain year to date is pretty darn good, man. I mean, if we stretch 20%,
well, you're kind of, Chris,
here on the indexes.
Correct me if I'm wrong, but you're kind of in the camp of not necessarily outright, black swan bear, but also not, melt up either. You're kind of in like the looking for yield camp right now, because I've seen you doing a lot of stuff where you're just collecting positive credit and kind of trading with a directionless, ultimate bias. Whereas I lean more on the bearish side. I mean, on the bullish side. I've kind of let go a little bit of my willingness to only touch gold because I think that the tech trade is alive and well. I've been annoyingly persistent on that recently, but I think that you made a good point there too. It's not about the elections this year. I think, as you kind of gave a nod to Jerome Powell, he might just be the guy. He might be the guy, Chris, that can do another 1995 soft landing. And maybe we're underestimating him again, as we have for, many people have for a number of years now. He did make the mistake with the transitory inflation thing, but supply side inflation is inherently very difficult for the Fed to predict, right? The world shut down. That's really hard to predict what's going to happen with inflation.
Yep.
So, maybe he's just that guy. I don't know. Also, just real quick, another donation in the chat. Guys, stop donating. I appreciate it. But if you want to purchase anything, get coaching with Chris or come join our membership group. You get a lot more value out of it. We do appreciate the donations. Thank you so much for supporting what we're trying to do here. We got Fed meeting coming up in 5 minutes. We'll have that loaded up on the screen. I'm sure the stream team Powerhouse will get us set up with that. But Chris, I wanted to give you a chance to respond to that because I just ranted. But is that where you're kind of leaning? You're more on the yield collection, a little less bias one way or the other, or do you have a bias?
I'm just trading, dude. So if I went through my entire portfolio right now with my positions, they're tilted bullish because that's inherently what the markets tend to do.
Yep.
Oil, I'm bullish. E-mini. So this is the E-mini S&P. I've got the E-mini Nasdaq, the E-mini Russell. So basically just trading futures markets, but I'm staying out of the way. I have, bear traps. If we have a fall by anywhere between 10 to 15%, I do have a couple black swans that are, percentage wise, probably a 0.5% hedge that would pay upwards of like 10% protection, close to it. So,
there's Bitcoin.
What's that?
You got a big position in Bitcoin, right?
I do. Yep. So I'm bullish on Bitcoin, and that's more like, dollar cost averaging. I've got about a 3% stake in Bitcoin, about a 3% stake in gold, about a 3% stake in silver. I have about a 3% stake in China. So I've got some non-diversification. I've got some puts. I've got some, credit spreads. I've got some ownership. I'm all over the place, man. And I'm not saying that it's like this guy can't figure out what he's trading. It's like I've got a reason for everything that I'm in.
No, and diversification is a
place.
strategy.
Yeah,
Here I am. I'm very narrow, but that's a strategy that I'm kind of focusing on. But you're taking a diverse approach. I think I will probably slowly join you. If the market melts up again, I will slowly join you more again. A couple months back before this dip, I was super all over the place. I had, a good mix of everything. Then when the dip happened, I have narrowed back into tech again. But it's trading what you're seeing, trading what's in front of us, and I do have a bit of Dow in my portfolio. That's actually one of the better performers right now. Is just the Dow Jones, which is more, defensive in nature, more a dividend stock, more value stock based, blue chips. I've got the NAS in my account, so we'll see. But diversification, having many different things going on at the same time is absolutely a strategy, especially if you think that the market is not just going to straight melt up. Diversification typically outperforms when a market isn't going, straight parabolic up. And we certainly have seen an increase in volatility. Got another donation. Thank you so much for the 20 rupees. Our friends in India are really dropping the rupees in the house. So thank you very much, guys, for the donations.
Let me get a question out of you, Nick. Tesla. So same thing that happened to me on Google. Tesla did the same thing. So I had some in the money credit spreads, both on the put side and call side. I was assigned Tesla at 270. Okay. And I have a 267.50 running for a long put. So I'll show you what position is right here. If you can't see my numbers, here's my my assignment was 272.50. My put is at 270. So right now I have a put that I could probably close out for about $40. This is out to Friday. So if I close this position, I could close out for about 39 of the $40. The reason I'm not doing anything on this right now is I still have a bear call spread at the 230 by 232.50. So if Tesla is down below 230 this week, this becomes full profit. So if I close this out for full profit, This should be $1.75, and I'll take that profit. I could also look for repair on Tesla. Now, this is a stock that has been volatile, and I understand that. I have some ratio spreads down here. I don't necessarily want to take on more shares of Tesla, but for the, let's say, next week, if I did a assignment, I'll calculate my break even. If I own it at 270, it's going to be something to this this effect. So 270, minus $1.75. Let's say right now that I close out my put at $40. Well, I'd own the shares at 230.75. We're trading right around $230. We're trading about $230. What I want to look at next week, Nick, is if I went out to next Friday the 9th and I sold an at the money call, I could collect $7 on Tesla for a covered call. So I could own the shares at 230, lower my cost basis all the way down to 22 and change. If price stays where it is, I'll make $7 a share on Tesla.
Yeah,
That's an easy repair for me. This is a high premium stock, even
it is
though
totally.
it's a low
Yeah.
IV. Like for Tesla, it's a low IV environment. But man, getting $6 or $7 out 1 week, dude, that's crazy.
No, it's
nice.
insane. Chris, that was one of my first when I first started dabbling in options. I had a position in Tesla from 2020 lows. I mean, I had a perfect one. And I actually got called away after selling calls several times on Tesla. I finally got called away before all the big drop. I played Tesla accidentally perfectly with options. And I remember being like, dang, I got called away. This kind of sucks. And then that ended up being a beautiful, thing. And the premiums I remember were just ridiculous on Tesla. So it is a
for sure
very interesting one to watch. Chris, we got the Fed meeting here starting in just a few moments. I'm not gonna make you stick around and wait because we're probably just going to let the audio play. So before that gets started, let me just let everyone know that if you guys enjoyed listening to Chris's commentary, Chris is a regular contributor to the A1 Trading Show. At this point, he's practically a host on here all the time. So if you enjoyed Chris's commentary, let me just give a quick shout out to him. He's got his social medias. We'll drop the links here in the chat. You can find him on YouTube. You can find him on Twitter at Real Chris Pulver. And also, Chris does offer a free Discord channel, and he's got some coaching that he does. He does on one-on-one stuff. So if you're looking for any of that, if any of that would be useful to you, take 2 seconds. Make sure to go subscribe and get going there. We have Fed. Am I missing something? Do we have?
Should just be the decision that just came out. It's going to be
Okay.
a pause, nothing crazy. I'm just watching some oscillations in the S&P, but I don't see anything changed. It came out as expected.
Okay.
5.25, 5.5.
Okay, so I said that wrong. So we got a little bit of time before.
Yeah, 30 minutes for the press conference. Yeah.
Okay. Yeah. So guys, to anybody who was really hopeful for that very 4% chance that we'd get the cut today, we didn't quite get it. But maybe next time. No, but probably still on paper for a September cut.
Yep.
Also, this morning, Chris, I was looking through some of the recent data. We had ADP this morning came in a little bit light. The employment cost index came in a little bit light. There's just been a consistent theme of economic data coming in cool. And I think that supports really solidly between now and then. If you keep seeing stuff like that, a September cut, but also to your point about November, I think like November is the question one, because I think December they probably will cut because it's definitely not going to be considered as political then.
Right.
But I think November is still very much a possibility if you continue to see the data rolling in light. It's almost like September. It's weird how far this market looks ahead.
Yeah.
But you got to think it's like this market's thinking, okay, September's on lock almost certainly. But then the question is November on? That's the real question.
Yeah. Well, what's weird is, typically the FOMC has always been like the third Wednesday of the month, and it's been all over the place these last couple of years. Like sometimes we have it, first of the month, sometimes we have it end of the month, sometimes we have it right after CPI prints in the same week. That's been the difference for me is the FOMC is not the consistent, it's always the third Wednesday, whether it's FOMC meeting minutes or if it's actual FOMC statement and press conference. I'm just looking at some real-time news right here. So we see inflation remains somewhat elevated. Fed repeats, does not expect it will be appropriate to lower rates until it has gained greater confidence inflation is moving sustainably towards 2%. Attentive to risks on both sides, dual mandate. The change from June was when it said it was highly attentive to inflation risks. Short-term interest rates, future slips on FOMC decision. Traders slightly pair bets on Fed rate cuts. Also, the same thing I just said about the FOMC when it's time to stop this go around. November it's 2 days after the election. That's crazy to me that even popped up on the radar like, oh yeah, the Fed might cut 2 days after the election. it's hard to look at that and say that's not political, but it is. I mean, it's very much in the news of everything that's going on during that week. It's going to be a crazy week as it is. I'm wondering if the markets even care. I would assume that they do, but maybe they
Yeah.
don't, man. Because if we have Harris or Trump and we have some type of gridlock between the House and Senate, markets like gridlock. Markets like nothing. Markets like the same old, same old. They want the certainty. So unless we have like a sweeping Republican
I saw
side or a
some
sweeping
stat that was
Democrat,
interesting,
not going
Chris.
to
That
matter.
was like the market historically does very well when you have a Democrat president and a Republican Senate. And it was like, whoa, that's really interesting. It's almost like when there is not a whole lot of dominance, it actually is better for the stock market. Because at the end of the day, I mean, let's face it, it's all about the Fed. Are they printing money into the system, injecting stimulus, or are they not? And that is why, people will spend all day long, oh, the economy will be better under so and so and so. But you look at the long-term historical averages of the stock market under a Republican or Democrat, it's pretty dang similar. It's pretty dang close. The bigger question is what the Fed's doing. And for me, it's like if Trump does get in, I would hope that he chooses to keep Powell in the seat so long as he continues to do the job he's been doing. Because let's face it, I mean, the odds for a soft landing right now look pretty good. I mean, the economy doesn't look like it's under serious jeopardy. It is slowing, but it's not crashing. I mean, you got inflation normalizing. I was going through this earlier today, but you've got inflation back in a trend lower. You've got the economic growth. We saw 2.8 advanced GDP, which was what the Atlanta Fed now GDP now, what that forecast was. Very, very, I think they were forecast for 2.7. So 2.8, stronger than expected growth. You got inflation cooling. And the further we get from that 2020 supply side shock that we saw, and we can see inflation kind of coming down while growth is still sustained. I mean, I'm kind of leaning towards the soft landing camp, and maybe we're looking like 1995, but it scares me to say that because the second you think it's 1995 again, where we saw growth really expand and inflation normalize, that is the sweet spot for stock market gains. And so that's the question: are we going to see something similar to that, or are we going to see more of a 1999, 2000 where problems arose? So we'll see. Actually, more 2008, right? Economic slowdown would be the question. Do you think the economy?
And the thing that's uncertain would be potentially the stagflation, right? It's like if we see like stubborn or sticky inflation plus things slow down, that stagflation is what the threat was, and that's why everyone thought we're going to have a recession in 2022. Inflation is trending lower. The consumer stayed relatively resilient despite ticks up in unemployment, which I don't think are necessarily gonna stop. I mean, if you look at the jobs numbers and where they're coming from, most of the jobs that we've added have been government jobs, not private sector. Services are down, right? Manufacturing's low. It's like most of it's government jobs, and that doesn't look good either. It's like it's kind of a fluffy, a bit of a fluff for the non-farm payrolls, which we also have on Friday. A couple things I just pulled out here. So we were mentioned, is it under Democrat or Republican? It really doesn't matter. If you look at these key points, S&P achieved an annual compound growth of 9.8% under Democratic presidents and 6% under Republican presidents since the modern S&P in 1957. So we've got roughly about 70 years of that. S&P has achieved a median compound annual growth of 8.9 under Democratic president, 10.2 under Republican since 1957. Return, almost 2,000% over 30 years, which is compounding at 10.5% annually. It doesn't matter, dude. We've had Republicans and Democrats over that 30-year period. Market doesn't really care. You look at the compound annual growth rate, Democrat versus Republican. And this doesn't bring into account of who's in Congress, right? What's the House? What's the Senate? Is it split? Is it divided? Is it gridlock? I don't really think it matters, dude. I think if we have companies with room to run and there's valuations that continue to be justified, look, when we see crashes in the market, we just see an asset bubble. That's what the Fed is. That's what the Fed has created more often than not. Is they backstop. They have this kind of soft landing, or they fight off crisis, but then they create a freaking asset bubble, and then valuations get so frothy that they're not sustainable. Revenue growth can't meet the numbers that's out there for the consensus. And that's where we see crashes and corrections. Now, you pair that with all the crap underneath that's actually bubbling under the surface that should be a problem. And then all of a sudden it just like dominoes into like this horrible situation. So that's where the crisis has been. Like 2000, 2001, 2008, 2020, that's what it was. We just had the Fed step in and backstop things a lot faster in 2020.
Yeah.
So I don't know. My point is, I don't think it's really going to matter if we have problems under the surface and companies are reaching valuations that they can't justify. Here's going to be my especially for tech. I mean, tech is certainly, your space, and you like tech, and that's been a great trade for you. If we start to see tech as a whole not meeting expectations, if we're seeing growth trends plateau or growth trends going down, that's not a good
Yep.
time to be long, right? So I mean,
Yep.
there's going to be evidence in the numbers, and there's going to be evidence in the data that we need to watch. But until then, look, if Nvidia keeps popping up and Microsoft beat this week, and if Apple and Amazon beat this week, and we've got Meta today, if it beats today, it's like, look, Mag 7's the Mag 7, and it's there for a reason.
Yeah.
If it keeps saving this
Well,
market, so be it.
And that's the thing, Chris, is I'll the concept of tech, the concept of my positioning in it. It is really truly a trade, because to your point, I do also recognize that on a long-term basis, a long-term basis, tech is probably overvalued. Price to earnings wise is probably expensive, but that's why we've got stops on the trade, as you're pointing out. In the meantime, if the party's going to roll on, the place to be at is probably tech, unless we get rate cuts probably mean that there's other participation. But to me, it's kind of like, in either scenario, if the market's going to go up, tech's probably going to do well. Doesn't necessarily mean tech has to lead. But I do think that it will participate at the very least if we see an up move. The question then becomes, as we watch these earnings, I've been very vocal about, if we get something out of Meta, if we get something out of Apple and Amazon, if we see serious threats to the AI idea, I think that's the biggest threat to the trade, is beyond just, what the Fed does. Even as you pointed out earlier, good companies, good earnings, that's going to trump the entire thing. That's the question for me with the Nasdaq trade and the semiconductors trade is, can we support these multiples with good earnings and good forward guidance? If we can, then the party rages on. But if we can't, I got to get out of there.
For sure. And I think you're silly to think that tech is a space that's overcrowded, or it's too much FOMO. It's like, look, the U.S. has essentially become a tech index. I mean, if you look at the S&P 500, it's been carried by 10 tech stocks. If you look at the Nasdaq 100, it's all tech stocks, and it's still been carried by the top 10 tech stocks. So even if you're in the Russell 2000, you still have exposure to tech. So, I mean, the reason we've had such a good run and we've annualized, 9, 10, 12, 15, 16%, it's because of tech. And the reason why is also tech doesn't have the hard goods costs associated with it. If you want to make more oil and buy $1 billion rig, that's a hard expense that you can't just make up for. That's going to take years to get online and years to pay for itself. That's a much different cost associated versus, hey, we're just going to pivot to this thing called AI, and we're going to make all of our analysts use, Chat GPT, and we're going to do generative AI and run all these programs and, spend as much money as we can in this space. Well, I think that's where the issue is like, do we have an AI? Is it actually worth what the investment says it's going to be worth, or is it hyped? And so maybe that's the
concern.
Point of AI is like, is it actually worth the investments that, I mean, we talked about this earlier. I don't know if it was, this week or last week, but I mean, Zuckerberg was raked over the coals when he was going into the metaverse and going all in with Meta and Facebook on spending. And if Google is saying, look, you can't afford not to spend, and if Microsoft says you can't afford not to spend, and all of a sudden it's like you're putting a bigger percentage towards AI, that is the return on investment going to benefit investors? Because if it does, great, it's all justified. But if it's not, you don't know.
Yeah.
This is what we don't know.
No, you're exactly right. That is the biggest concern for the AI trade. And that's why I think, the biggest piece to pull out of the earnings, and why, admittedly, Microsoft very much surprised me, the market's reaction to Microsoft, because their cloud earnings were a little bit lower. And they're one of the few companies that the market points to and says, hey, look, AI is working. So when you have these big earnings occurring, the market is starting to demand, and maybe next time around will demand even more so, that these AI investments do come to roost. The one thing that I keep thinking about, though, too, is that if we say, okay, the AI trade requires, we want to see some return on investment. Well, the market may also afforded a little bit more time and leniency if rate cuts do occur, because suddenly the borrowing costs for a lot of these companies may slightly come down. Maybe the idea is that, with that reduced borrowing costs, a lot of other companies can start investing in AI too. And so is it one big Ponzi scheme that has no returns on the other side? I don't know. But my view on it, there's a lot of picks and shovels companies that I like to lean into, like the semiconductors, but also, as I've said over and over, the cybersecurity stuff. The defense for counter AI will also be a forced spending. There's no, if AI gets really good at what it does at faking things, at faking leadership, or like leadership saying something, or your cousin calls you asking for money, the demand is the spending to defend against AI will be massive, just like the spending for AI is too. So I kind of see it as like there is just going to be perpetual spending on many fronts for this. There's spending on the government level. Governments have to have counter AI and chips to do all their stuff. And then you have individuals who may need to purchase software, or at least use tools that defend them from AI stuff. And then there's businesses who need to protect their assets and also protect their customers using AI. To me, I just see the companies like CrowdStrike, Palo Alto, Fortinet. I love those companies for that reason. But those valuations are crazy if you see the AI story dry up. So you have to be careful with this stuff. This is why it's high risk, high reward to play tech at all.
Yeah, and look, I think it's pretty apparent that the Bitcoin / blockchain trade is still stable. I don't think that AI is just over and done with. I think it's big enough that
Yeah.
companies see that if they can actually embrace AI and become more productive and become more profitable, enhance their margins. AI look, it can all be under the bow tie of AI. You can call it AI, but it just means you have less people doing more work and you're just as
Yeah.
productive, you're higher margins, and like all these things are good for companies' bottom lines and profitability. So from that standpoint, I mean, AI as the blanket trade of more profitability, doing more with less, it's all good in my opinion. I just wonder if it's like when companies are over investing and not really getting the ROI, if that's
Yeah.
ultimately where this thing
Well, think
cracks.
about like the call for 6 rate cuts at the beginning of the year. Like the market
Yeah,
can get, even about something that it's right about, it can get ahead of its skis, right? So
for
I
sure.
totally understand with the tech stuff. There are some technical levels that I'm watching very closely on the cues. I mean, if
Yep.
we break that previous low, I got to get out of there. I gotta say something has not worked right on this idea,
Yep.
because this is not my first attempt either. I have taken a couple attempts at the Nasdaq. I bought once here, and this is my third attempt to get long the Nasdaq. On my third attempt, if we just break through the lows, I got to seriously consider if I want to try again. And
Sure.
if so, I need to have a good reasoning for it. Maybe a catalyst, maybe something further, because if this is going to become a 10% correction at some point on the stock market, I'm a trader. I want to be flexible enough to recognize that might be coming and get out of the way. So right now, we've got a good candle on the upside for the stock market. But again, we are just 15 minutes or so away from the press conference, which could either continue this move or completely reverse it, or just volatility is expected.
Yeah.
Chris, do you have anything? You mentioned you closed out some of your Qs trades.
Yep.
Would you say that going into this meeting, do you have any positions on the stock market as an overall, maybe S&P or Qs?
Yep.
Where are you leaning? I think you mentioned slightly bullish, right?
Yeah, so where I'm leaning slightly is I need to see, and this is just for short-term profits for this week. I need the Qs to stay above 460 this week, and they're
Okay.
right now printing what are the Qs at right now? 469. So I've got about almost a $10 head start for my line in the sand. So as long as we stay above 460, that's credit. As long as the IWM stays above 218, that's credit. I've got a broken wing on the NW or the NDX, so the Nasdaq Futures Index. That's probably 99.9% profit right now. I just have to, let it expire on Friday. So I'm leaning bullish as far as I think that the 10% level. The reason I played the Qs this week instead of the S&P is I thought, look, 10% is a pretty good correction. Now I know it's more volatile than the S&P, but I thought maybe the S&P pulls back a little bit. This was mostly a tech-led earnings week, right? You've got Microsoft, you've got Apple, you've got Amazon, which I know are in the S&P. But as far as moving the needle, just like we had back in April and May, those stocks I just mentioned are pretty much what saved the market in late April and May. Once we started to see that rally in May, that was because of Apple earnings. And Apple didn't really have a great earnings report. They just said, we're doing buybacks. We're going to kick the can down the road, and we're investing. We're looking at the AI space, and they have this big update. And Apple has been one of the best comeback stories of the year. Tesla, same type of thing. Tesla's interesting because it's still really sensitive. They keep missing the marks on some revenue or some earnings. But what Tesla's doing, and I don't think anybody really appreciates right now, is they are just cutting costs like crazy on their cars, and they're doing it better than everybody else. Like Ford was up to $14, now it's back down to $11. GM has fallen flat. I mean, your EV sales, I don't think Ford can make a $30,000 electric car. I don't think that GM can make a $30,000 electric car or make one that people want to buy. So to Tesla's credit, they still are making cars, even if they're $30,000 to $40,000. They're making cars that people want. I mean, I see them everywhere. And I mean, I'm looking at the homes and places to rent or to buy. A lot of them are putting those, Tesla chargers right in the garage. And you can have like the medium speed charger, so they sit overnight and you get a full charge by the next morning. So, I mean, it's there. It's like, and this isn't like a bullish case for Tesla necessarily, but I think even as much as Tesla gets crapped all over because like, oh, Elon Musk is crazy and it's not, the value isn't there, they're missing on I still think Tesla's not an automaker. Tesla is much more, as far as the bigger picture. Tesla is it's a skeleton for tech and energy and disruption and things that hopefully in the long run are going to be something that makes the company very profitable. So I think that right now it's like I lean towards the Qs because a 10% correction was enough to take a stab and take it, dip my toe in the water is what I did. So Qs and IWM, what I'd like to see is, one of my favorite trades for the rest of this year, and I hope it's right, would be the IWM playing catch up. And there's two things I want to talk about. This actually goes back to what I said early in the show.
Yeah, I was going to ask you about small caps. Give us your, this chart looks pretty good on IWM. You take a look at the Russell. It looks like, I was mentioning, I think right before you stepped on, looks like a really clean bull flag on the daily chart. Zoomed in a little bit here. Look at that. Just tagged support. Edgefinder's got a nice bullish reading on it too. So I'm either looking for a break and retest or a pullback into this this level here. So I don't know. What are your thoughts on small caps?
I think if we can stabilize the S&P and the Nasdaq, we can start to see a broader market lift and have the Russell actually play along with it. So rather than seeing the separation of S&P is up and the Nasdaq is up and the Russell's flat and the Dow is flat, we might see that we have all four indexes pushing higher going in towards the end of the year. Doesn't matter what the election's going to give us. Doesn't matter if the Fed's going to cut rates, even though it does matter, because I think this is why the Russell jumped the way that it did. But the reason I like this trade is if there's a catch-up trade, and this is what I talked about earlier this morning with silver, I can see a target on the small caps. If we get to all-time highs on the small caps, that gives me another 10 to 11% to the upside based on current prices. So taking this right now, getting to all-time highs in the IWM, we're talking about a move of about 9%.
Yep.
9% in an index is pretty darn good. And I know that might be a catch-up trade where maybe the 9% is, 9% for the Russell, but it's 3 to 4% for the SPY, or it's 3, 4, 5% for the Qs, but it's still an outperformance. I'll take that outperformance because that's alpha. It's probably going to outperform the Dow. So I like the small caps in that regard, but I don't think the small caps will move all by themselves. I don't think the Russell's going to go break all-time highs with the S&P and the Qs dropping. I think in order to break all-time highs in the Russell, we have to see everything be stable or up. And then the small caps can go with it. We can have like a broad market participation as opposed to two indexes up, two indexes flat, and now we're wondering which is which,
Yeah. No, I think if you're looking at the Russell, you got to ask yourself, do you see where does the growth typically do? Where does the Russell typically do the best? And what you kind of find is, historically speaking, usually the Russell does very well when you get the Goldilocks zone, where you have inflation not threatening, but not okay. So here's where you want the Russell. This is my take on it. Inflation, you want it between 2 and 3. You don't want it lower. You don't want it higher, because lower would signal the economy's slow, and higher would involve problems like we've seen with rate hikes, which crush the Russell. Then you want, on top of that, you want growth to be as strong as possible, right? The more growth, the better. But 2 to 3% inflation is seemingly attainable, and growth doesn't seem to be cracking. And we've got the final one, which is interest rates are going to become less threatening pretty soon.
Yep.
If I mean, we might be seeing the right setup for the Russell to make a big move. I don't know if I'm a Tom Lee about it, right? Tom Lee's out here saying,
15,000
100%.
SPY, S&P, yeah.
Frank and I
Bitcoin to a
always,
trillion. Do you see that one? That was a good one.
no way. Did he really
Yeah.
say that?
Bitcoin to over a trillion.
And he does this face. Frank and I always make fun of his. He does this little smirk on his face whenever he says these crazy predictions. It'd be like SPY to or SPX to 15,000. It'll just give a little smile and a nod, and it's just like, dude. But anyways, yeah, I mean, I do think that he might be a little aggressive in how bullish he is on small caps, but I don't think he's wrong about being bullish on small caps. And he's been very right about this bull market. I mean, of course, they can always drag out the biggest bull in the room and make him look like a hero when it's going up. But I don't know. I think I like the setup for small caps as well. Especially, I mean, this is one thing, not to get overly political, but if the tariffs do come into the picture from Donald Trump, I do think that kind of favors domestic small cap companies. So if you do get a Trump election, it might lean a little bit more favorable towards small caps, because think about the small cap index. It's a lot of domestic businesses. It's a lot of US focused companies, which could theoretically do better in a increased tariff environment. So maybe that's one area where the specifics, and that's one thing, if you're talking about the broad stock market's performance under a Democrat or Republican, probably not going to give much of a difference. But specific policies like clean energy policies or tariffs or things like that can certainly impact specific industries or parts of the market. So I think that is worth at least thinking about.
I listened to it was a segment on Tasty Live yesterday, and I think it was Chris Vecchio made a really good point. He said that for the most part, for us that do this for a living and do this for day to day and week to week and year to year, for us to get things right, all we really have to do is get sentiment in the sector. If we can get those right, that covers about 80% of the market direction.
I mean, if you got the right sector this past 2 years, you look like a hero. But if you got it wrong, I mean, it was most sectors down, a couple up, or not down, but the outperformance was very, very narrow, as we know.
Correct. And that's the point, is like, so, this has been, for the most part, sectors have been returning to green, but for the traders that have been, since 2020, I know a lot of smart traders and a lot of smart funds that are talking about, value. Everything's got to be like just dirt cheap. And look, give it maybe 2, 3, 5 years. Maybe those all start to play out really nicely as well. But those sitting in value and those sitting and waiting and missing out on 100+% upside and 30% gains and 50% gains, and I mean, look, I'm talking about this is a lucky pick for me this year, because I did not intend to get into this stock with the idea of jumping price.
Oh, you played MO? Congrats on that. Great dividend and a nice rebound play.
Yeah. So I bought this when I got some clients signed on board. The first thing I did for a dividend play was I started to get some MO around $39, and we had over $10 of gains in just the stock itself, and some nice gains in the actual it's like $1,000 dividend every quarter. So if I show here, I'll go to my portfolio here. Let me go to MO. So this is one individual account that's up around $6,600. If I go to the whole portfolio, it's up a decent chunk, man. I mean, the whole portfolio has got about 65 grand in MO. I've got it covered at 50. I don't really want to lose the stock if I don't have to. But if I do get it called away, it's like everyone's going to make around $8,000 or $9,000 with an extra $1,000 kicker per quarter on top of that with dividends. And so, like, longer term, it's like this is a stock that I can continue to play. And just kind of hold the cost basis around $40. I mean, my cost basis is not that far off of like COVID lows. So I don't really want to get the stock called away. If we're going to get, 94 to 98 cents a quarter, I'm all about it, man. So I just think this is an interesting play where it's like, this has nothing to do with like the tech sector. But we've seen some interesting jumps, like because of interest rates looking to get cut. House builders jumped again, like Pulte and Lennar, DR Horton, they all jumped up again. Regional banks, if you go to is it KRE? Yeah, KRE. which was, arguably one of the worst things you could ever trade simply because of the regional bank crisis. But look, you're talking about a $35 to $58 jump. That all by itself has been a nice part of this rotation. This is up 67% from the crisis we had with Silicon Bank and First Republic back in 2023. So sectors have been a little bit all over the place, but it's mostly been led by narrow tech, consumer, communication services, tech sector, and semiconductors, right? And for those value plays, it's like value's done next to nothing, although everyone's resting on value outperformed by blah, blah, blah percent. It's like, yeah, but it might have been still in a drawdown.
And
the whole market's down 50%. I don't care about value. It's like nothing is good when the market's down.
And that's the thing, Chris, is it's been, in 2023, I was super, super tech focused. I was like, that was like everything for me. So that's why 2023 was a monster year for me. Yep. 2024, I messed up. I got out of the tech stuff and I didn't mess up. I just didn't make nearly as much as I could have, shoulda, coulda, woulda, hindsight 2020. Sure. I got more into gold and I got more into kind of well-rounded stuff, which has not performed as well. But I'm back on the tech trade and I'm going to stick with it until it breaks. It could break at any moment. And, maybe we see it in quite literally in a few moments, but we'll see. Chris, we got it is a show. We got Jerome Powell coming up and doing his show in just a few minutes. I'm going to let you go this time for real. Thank you for coming on. I don't want to have to make you sit through and listen to him, the old man speak. You can listen to the show. And if anything gets really interesting, we'll bring you back. But thanks.
I'll be in the background. If you guys need me, I'll be here.
Okay. Yeah. I'm probably just going to listen. So before we let you go, let me just mention everybody, guys, go support Chris Pulver on his YouTube channel. Make sure to go subscribe. Go find him on Twitter at real Chris Pulver.
That's it. Yeah.
Yep. Real Chris Pulver. Yep. I blanked for a second. I say it every day, but it starts to, it's like when you say or read a word. James and I were talking about this, when you like type a word out and you're like, that didn't seem right. Anyways, Chris, we got to go. We got him showing up. So thanks for coming on.
All right. Thanks, Nick.
See ya. All right. We can switch over. I think we got I can't tell if he's on the stand or not from my view. I don't think he is. Oh, here he comes. The man, the myth, the legend.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate.
Interesting.
In that we will be data dependent, but not data point dependent.
That's about as close as a
confirmation
confirmation
of
you get.
responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Wow.
So you asked why not today, and I would just say again that the broad sense of the committee is that
I mean, there it
we're getting
is.
closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Now let's come about November.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby. Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions. And that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market maximum employment is one and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market. And that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris. Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like again, the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question, talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this We raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's time. It's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%. But we need to pull it back there. Progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off. Now labor market has softened. Probably the inflation is probably a little farther from its target than is the employment. But I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk basically with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just it. And then how is that affecting the outlook, and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward. Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
Yeah, so as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney. Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation. Rate sensitive, interest sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria. Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there a reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Thank you, Chair Powell. Amara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book and the hard data, do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are a lot of. It's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way: haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we need to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, Do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean. Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go around. And then this morning we have the monetary policy go around. And I think in people's economic go around and in their monetary policy go around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so, in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question that is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor
communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that.
Hey,
Is there
folks, I hope
anything
you can
say
hear
about
the video.
how
I got
we
my
judge
stuff
that?
running again. It looks like internet went out in the office. So as long as you can hear Powell, I think we're okay.
I think the reality is
We know
that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, you know, when you're saying you're going to be data driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on that, on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
All right, folks, that was good timing. It looks like Powell's done talking, so our stuff was exploding all around us. We've been live for 7 hours, so our PCs finally gave out and the internet finally decided to die. So thanks, guys, for watching. 7 hours. We had a lot of great guests on. Make sure to go through the chat. I think their links are still in there. Check out Chris Pulver. We had Forex James. We had Diego. We had Nick Phillips. We had Tom from Simply Forex on here. A lot of great people coming on and helping us out. So thanks, guys, for watching, and we'll see y'all next time.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.